So today we are going to continue with the topic we had started previously or in previous sessions on planning and decisions making and planning and decision making, where we had talked about cost heads, welcome to Manifested Publishers. My name is Mr. Mariga, and I'll be teaching you advanced management accounting. Today I want us to discuss on the concept of short-term planning and decision making, specifically one of the applications of marginal costing, which is make or buy decisions. Make or buy decisions. Now, make or buy decisions are those decisions that are made by the management of a company when the company or when that company is faced with two decisions. Number one, either they will make a component internally, make a product internally. So this basically means that the company is what? Manufacturing their own goods. Manufacturing their own goods or what? Products. And when they manufacture, they will incur all variable what? Costs. So they must incur variable costs. Variable cost of what? Direct materials, variable cost of direct labor, variable cost of direct expenses, and variable cost of fixed overheads. The second option is the decision to buy a what? A product. When they are buying a product here, it basically means that what are they doing? They are outsourcing a finished product. They are outsourcing a finished product or component. And when they outsource that finished good, it basically means that they are not going to incur the cost of production unless there is something else they will increase to it, but instead they are going to incur a buying cost. A buying cost. The cost of buying that product from a supplier. Okay? In most cases, when you outsource, the only cost you incur is a buying cost. But however, you may find that you're buying a product, yes, but you need also to manufacture it further. So you may also find yourself doing what? Incurring what? Additional production cost. You may also find yourself in these decisions of make or buy that your fixed overheads are being done what? Affected. But the fixed overheads that are normally affected here are the specific fixed overheads. So in these decisions, the specific overheads, the specific fixed overheads or incremental fixed overheads or fixed costs will need to be analyzed. Will need to be analyzed and carefully done what? Analyzed. What are incremental or specific fixed overheads? They are those fixed overhead costs that are incurred as a result of the decision that is made. They are incurred as a result of a decision that is made, and therefore they change with a decision. So these ones here change with decision made. These ones change with the decision what? Made. You may incur them when you make a product, but when you buy it, you don't incur them. You may also find yourself incurring when you buy that product, but when you make that product, you do not do what? Incur them. Okay? So we're saying you'll analyze all the what? The costs that are relevant for decision making. That are relevant for decision making. And what costs are those? All the variable cost, fixed overheads, and the buying cost when you buy a certain what? Product. Okay? Now with that in mind, I want us to do a question of May 2021. May 2021, question 3A. Question 3A. May 2021, question 3A. All right. Question 3A. They're saying Ulanda Limited is a manufacturing company based in the western part of the country. It has two divisions. One of the divisions within Ulanda Limited is currently negotiating with other suppliers regarding outsourcing a component A that it manufactures. The division currently manufactures 10,000 units of the component per annum. You have the total cost of producing the 10,000 components. Material Z is 1,200 at a unit cost of 120. Direct labor is 1 million at a unit cost of 100. Variable manufacturing overhead cost is the total cost of 100,000 with a unit cost of 10. Fixed manufacturing overhead cost, the total cost is 800,000 with a unit cost of 80. Share of non-manufacturing overheads is 500,000 and the unit cost of how much? 50. The total cost of producing the 10,000 components is 3.6 million. The unit cost of one unit is 360. Additional information number 1. The above costs are expected to remain unchanged in the foreseeable future if Ulanda's division continues to manufacture the what? The components. The supplier has offered to supply 10,000 components per annum at a price of 300 shillings per unit, guaranteed for a minimum of 3 years. If Ulanda outsources component A, the direct labor force currently employed in producing the components will be made redundant. No redundancy cost will be incurred. Direct materials and variable overheads are avoidable if component A is outsourced. Fixed manufacturing overheads would be reduced by 100,000 per annum, but non-manufacturing cost would remain unchanged. Assume initially that the capacity that is required for this component has no alternative use. Required. Advise the management of Ulanda Limited on whether the component should be bought or made. So part 1 of that question is saying we analyze whether we should make the component. Advice on whether component A should be made or bought. So this is a case of make or buy decisions. Let's analyze this. We'll have our analysis here. The first option is when you make, and when you do what? And when you buy. When you make and when you buy. Right. When you make, you expect to incur a cost of direct materials. And the material cost is known as what? Z. The material cost of Z will be how much? 120. 120. But when you buy that component A, you're buying a finished good, so you're not going to incur the material cost. So here will be 0. Just 0. The other cost will be the cost of labor. So we say direct labor. And direct labor, they are saying, note number 3, if Ulanda Limited outsources component A, the direct labor force currently employed in producing the components will be made redundant. No redundancy cost will be incurred. So the labor cost can only be incurred when you make that component, and when we make it, the cost of labor is 100. But when we buy that product, we will not incur the cost of what? Labor, because the cost of labor is a production cost that is only incurred when you produce. And there is also no redundancy cost, so that will be 0. In case there was a redundancy cost as a result of buying, we would have added it to the cost of buying, or that will be the cost of labor for buying. The other cost is the cost of variable manufacturing overheads. Variable manufacturing overheads. And your variable manufacturing overheads, those are production costs, which will be incurred when you make. How much? 10. When you buy, you'll not incur them. When you buy, you'll not incur them. Then let's talk about fixed manufacturing. The fixed manufacturing is given by note number 5, where they are saying fixed manufacturing overheads would be reduced by 100,000 per annum, but non-manufacturing costs would remain the same. So if you make this component, the fixed manufacturing cost per unit is 80. But when you buy that component, the cost that is fixed in nature is going to reduce by 100,000 per annum. Therefore, your new manufacturing cost that is fixed in nature, you're going to take 800,000 minus the drop in that cost. You divide by how many components are you making? 10,000 components. That means your new manufacturing buying cost will include fixed manufacturing overhead cost of how much? 70. So your new manufacturing overhead cost of buying is 70 because of the drop in the components, because in the drop of 100,000 of the fixed manufacturing overheads. Then you have a share of non-manufacturing overheads. The non-manufacturing overheads, we are told, they would remain what? Unchanged. The non-manufacturing overheads will remain unchanged. So if they remain unchanged, you can simply ignore them. They were 50 per unit, so you can simply ignore them, or you even indicate them. The choice is yours, but they will not change our what? Our decision. Whether you write here 50 or you write here what? 50, our decision will not do what? Change. But now, there is an extra cost of buying price. There is an extra cost we must incur when we buy that component. And note number 2, the supplier is willing to supply at a price of how much? 300. So therefore, your relevant costs. You now get our relevant costs. This is 370. This is 370. $120 plus 100 plus 10 plus 80. That will have a relevant cost of how much? 310. That's your relevant what? Costs. Then after we've determined now the cost we will incur, we then need to advise. So our advice. The advice we will give here will be the one that corresponds to the minimum cost. And I can see the minimum cost is the cost of making that component. So you will advise them to make component who? Make component A. Why? Because it is cheaper. Remember class, as a decision maker, you want to minimize the costs incurred and to maximize your what? Revenues. So you minimize your cost, maximize your revenues. All right. Let's go to the second part of that question. Second part of that question. Second part of that question, where they're saying, but 2, assume now that the extra capacity, that will be made available from outsourcing components A can be used to manufacture and sell 10,000 units of component B at a price of 340 per unit. All of the labor force required to manufacture component A will be used to make component B. The variable manufacturing overheads, fixed manufacturing overheads, and non-manufacturing overheads will be the same as the cost incurred for manufacturing component A. Materials required to manufacture component A would not be required, but additional material Y required for making component B would cost 130 required. Assess whether the division of Ulanda should outsource components A. All right. So let's analyze here. Our option again, here now, what do you want? You want to either make component A, that is the first decision, or you buy component A but make component B with the spare capacity. With the spare what? Capacity as a result of buying component what? A. Okay, so let's start with the first option. When we make A. When we make A. When we make A, we have already analyzed it. It is here. You must incur the cost of direct materials. And our material cost was for Z, which is how much? 120. Direct labor is how much? 100. Variable manufacturing overheads is how much? 10. Your fixed manufacturing overheads. They're saying as far as fixed manufacturing overheads are concerned, will be the same as the cost incurred for manufacturing component A. This is, so we can ignore them, but let's just indicate them there. Then non-manufacturing overheads, they are the same. You can choose to ignore. Let's just ignore them. They are not going to change our decision. They are not going to change our decision whether we make or not. That is that. They will not change our decision. Okay, let's go to the second option. We buy. There was a buying price here. There. We buy what? A, and make component and make component B. And make component B. The first cost we will incur is the cost of direct materials. We must incur material cost, But in this case, what material cost are you using? They're saying the material Z required to manufacture component A would not be required, but additional material Y. So here you're buying Y. For making component B at a cost of how much? 130. And then we will also incur direct what? Labor. We will need to incur direct labor costs. And they're saying all the labor cost required to manufacture A will be used to make B, and the labor cost was how much per unit? 100. Then your variable manufacturing overheads are the same. Variable manufacturing overheads, the thing will remain the same. So you can even ignore. That is also true for your fixed manufacturing overheads. They are remaining the same. Whether you make A only or whether you make B, they are remaining the same, so we can ignore them. They are not going to affect our decision. They are not going to affect our decision at all. They are irrelevant for decision making. We normally say they are irrelevant for decision making. But now, we have to buy component what? A. Why? For the only way we can make component B is when we buy A. So when we buy A, there is a cost we will have to do what? To incur. And what was the buying cost? The buying cost of A was 300. That is not going to be incurred. So buying price 300. So that now we determine our total relevant costs. Our total relevant costs, that is 200 and 30. Then let's get these costs. 130 plus 100 is 230 plus 10 to 40 plus 300, 500 and what? 40. That is your relevant what? Costs. But this particular component, what? B, can be sold. And when it is sold, it will generate a revenue to the to the organization. Therefore, it will effectively reduce the relevant cost here. So let us less our selling price of of B. When you sell component B, you're going to sell it at 340. So therefore, your net costs, so your net relevant costs, is how much? 200. Once we have determined our relevant cost, let's then do what? Advise that company. Let's advise that company. Okay. Now, when we make component A only, we are going to incur cost of 230 as our relevant cost. When we buy A at 300 but make and sell component B, our relevant cost is how much? 200. So what will we do? We are going to tell them buy what? A, and you make component what? You make component B. You buy A and make component B. Right. That is what we refer to as make or buy decisions, where a company is faced with the decision to either manufacture a component itself or to buy a component or a product from outside suppliers. Okay. There are certain factors we consider. Factors considered in decision making. In decision what? Making. What are some of the factors you want to consider? The first factor there is the effect on selling price, effect on current selling price. In case you have a special what? in case you have a special offer. Number 2 is the effect on fixed cost or fixed overheads. Effect on fixed overhead costs. The decision you make, is it going to affect your fixed overhead costs? Number 3, any legal obligations you may have. Obligations and who? Contracts. And contracts that you may have. Are they going to affect your production? And number 4 is alternative use of spare capacity. Use of spare capacity. If you don't produce a product, that spare capacity, what will you do with it? Then the quality of product to be outsourced. Product to be outsourced. Is it of the required standard, or is it acceptable to the what? To the management? Then you also need guarantee of long-term supply. Guarantee of long-term what? Supply. Where you don't want to buy a component today, then after a few days, when you want to buy again, they tell you they don't have that component. So when you decide to buy from a supplier, you expect that they will be able to handle your order in the long term. So these are some of the factors you consider when you're making what? Decisions. All right. And that means we have come to the end of our topic 3, which is planning and decision making techniques. Planning and decision making techniques. We talked about cost, volume, profit analysis. We also talked about the various decision making environments under risk and uncertainty. We also talked about the expected value of perfect information, and we have finalized by talking about applications of marginal costing. Applications of marginal costing. All right. So without further ado, I wish you all the best and goodbye. Welcome to Manifested Publishers. My names are Mr. Mariga. I'll be teaching Advanced Management Accounting, and today we will continue with the topic of planning and decision making technique. Specifically, I want us to talk about the various applications of marginal costing. The various applications of marginal costing. Now, marginal costing is a method of costing, or is a costing method that requires the user to determine variable costs, such that your variable costs will comprise of direct materials, direct labor, direct expenses, and variable overheads. Overheads. Right. This method, known as marginal costing, is also known as contribution costing, or variable costing, or direct costing, It is referred to the above names because you consider both, you consider direct cost as part of your production costs. You also consider variable cost when you're determining your production costs. So therefore, using marginal costing, your variable production costs will be made up of direct materials, direct labor, direct expenses. Then you're also going to add your variable production overheads. You're also going to add your variable production overhead. Apart from that, apart from knowing how you determine your production cost using marginal costing, it is also important that we remind ourselves how we determine contribution. So contribution is the difference between your selling price and your variable costs. Costs. So it is a difference between selling price and variable cost. This particular concept was covered when we were talking about cost volume profit analysis, both in intermediate level, and we have also covered it in advanced level. However, today I want us to talk about the various applications of marginal costing. So today I want us to talk about the various applications of marginal costing. So the applications of marginal costing is what I want us to do what? To talk about. The applications of marginal Remember, we've said marginal costing is also known as direct costing. It is also known as what? Contribution costing. It is also known as variable costing. It is also known as variable costing. Why? Because you normally calculate your production cost by considering only variable production costs, only variable production costs. All right. The first application of marginal costing, application number 1 that we will talk about, is what we refer to as limiting factor. It is known as limiting factor analysis. We have a second application known as throughput analysis. Throughput analysis is the second application. You have make or buy decisions. Number 4, you have special offer decisions. Number 5, you have drop or continue decisions. Drop or continue decisions. Let me start by highlighting the first application of marginal costing. Let me highlight or talk about the first application of marginal. And the first application is limiting factor analysis. Limiting factor is what is referred to as a scarce resource. So a limiting factor is a resource that is not enough, such that it will normally prevent the company from meeting its demand. So limiting factor is a scarce resource. This is a scarce resource. A resource that is not enough, i.e. a resource that is not enough, or is limited in its availability. It is limited in its availability. I.e. it is not enough. That resource that is not enough, it may be materials, it may be labor, it may be production capacity, it may be even space. Okay? As an organization, When you are faced with a limiting factor or where you don't have enough resources, you are going to maximize the contribution per limiting what? Factor. So when you don't have enough resources, you as an organization should decide on the units and the product of the product you're going to do what? Produce, such that these products that you're going to produce are the ones that are going to generate the maximum contribution. Now, for us to be able to deal with a question on limiting factor, or for us to be able to identify the product that will maximize the contribution per limiting factor, we must always start by identifying the what? The limiting factor. So the steps that we follow when you want to identify your limiting factor units to produce, steps to follow. Number one, start by identifying your limiting what? Factor. You determine limiting what? Factor. Once you've determined the limiting factor, the second step is determine your contribution. You must determine your contribution per unit, per product. You determine your contribution per unit, per who? Per product. Number 4 is you're going to determine your contribution. Determine your contribution per limiting factor. Per who? Per unit. Per who? Per product. Per unit, per who? Per product. Next step after that is to determine your to rank, or to determine the rank of your products. And the rank here, or the products that you're going to rank, will be ranked that the product with the highest contribution per limiting factor will be ranked first. Will be ranked what? First. And remember that the contribution per limiting factor per what? Per unit will have been computed by note number 4. Will have been computed by step number 3, not number 4, by step number 3. So we are saying you rank according to the highest contribution, per limiting factor per unit. That should be your order of what? Rank. Then step number 5, you determine your optimal who? Output. And this optimal output will be according to the rank above. According to the rank what? Above, in step what? In step who? D. This step here above. Right. That are the basic steps, or those are the steps that are going to be used when an organization is faced with a limiting what? Factor, a scarce resource. And we can have an illustration. And our first illustration, the illustration I want us to talk about, is a question of April 2022. April 2020. Question 2A. April 2022. Question 2A. The question states, Zinc Limited is a local manufacturer of 3 products, namely X, Y, and Z. The management of the company is unhappy with the current production mix and is seeking advice on the most optimal arrangement. The current production is 10,000 units of X, 5,000 units of Y, and 6,000 units of Z. The management accountant has provided the following information relating to the three products. You have your details, you have the product X and Y. The selling price per unit of X is 1,200, of Y is 2,000, of Z is 2,250. Your production cost of materials is 300, of Y is 900, of Z is 600. Your variable overheads of X is 150, of Y is 400, of Z is 450. Additional information. Each type of product passes through three departments in which a different type of labor is used. The labor requirements in each department are given below. Department 1, your rate per hour is 20 shillings per hour, where X requires 3 hours per unit, Y 4 hours per unit, Z 6 hours per unit. Department 2, the rate per hour is 40 shillings per hour. Your labor requirements are 1 hour per unit in X, 2.5 hours per unit in Y, 4 hours per unit in Z. Department 3, your rate per hour is 30 shillings. Your labor requirements per unit of X is 5, Y is 7, and Z is 9. Number 2, if there is a shortage of labor in Department 2 and it is not possible to increase labor input hours beyond the fully utilized current hours. Fixed overheads are budgeted at 5 million shillings per annum and are expected to remain constant. A recent market survey disclosed that the maximum sales potential for the company is 12,500 units of X, 7,500 units of Y, and 8,000 units of Z. Advise the management of Zinc Limited on the most profitable production mix and the optimal profit using limiting factor. So I want us to tackle this question of April 2022. Question what? 2A. Let me have that here. We will follow the steps as I have indicated. It is limiting factor, remember. Okay. So the first step is you first determine the limited what? Resource. So here we compare our available what? Resource with your required resource. They are saying currently, note number 2, that there is a shortage of labor in Department 2. So here you're going to say your available labor hours in Department what? 2. Your available hours in Department 2, we're going to have to calculate them now that you've not been given how many hours are available. But additional information number 1, each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. The labor requirements per unit of X in Department 2 is 1 hour. But for you to produce X, yeah, you currently are producing how many units? 10,000. Currently are producing 10,000 units. Therefore, for you, the normal or the available labor hours will be dedicated to produce X are how many hours? 10,000 hours. Why? Your labor requirements per unit is how much? 2.5, and your current production is how many units? 5,000 units. Therefore, the labor requirements of what? Of Y will be what? 2.5 by who? By 5,000, which in this case will be how much? 12,500 what? Hours. The third product is who? Z. And to produce Z, you will use 4 hours per unit. You multiply that by your current production, which is 6,000 watt units. So for you to produce Z, you require 24,000 watt labor hours in department what? 2. Then after that, you now determine all your total labor hours that the current department 2 has. All the labor hours that are available in department 2 for zinc limited. And how many hours do you have available? 46,500 who? Once you've determined your available labor hours, what do you then need to do to determine your who? You will need to determine your required labor hours. Your required labor hours in department who? In department who? Again, you will need to produce X, you will need to produce Y, and you also need to produce who? Z. For you to produce a single unit of X, you need 1 hour per unit, but the market demand, according to a survey that was conducted, is that you have a potential to sell 12,500 watt units. Therefore, you require 12,500 who? Hours to be able to fulfill that particular what? Demand. Why? You have 2.5 hours per unit, but the market demands that you produce 7,500 who? Units. Therefore, you require how many hours? You require 18,750 hours. Then Z, you require 4 hours per unit, or you'll be using 4 hours to produce a single unit, but your demand in the market is of 8,000 units. Therefore, your total required labor hours are 32,000. So you add this 12,500 plus 18,750 plus 32,000. So here you will need, or you require, 63,250 hours. 63,250 hours in which department? In department 2. Then let's see how much deficit we have. Let's see the deficit. You available labor hours are 46,500 labor hours, but what you currently require is 63 what? 250. Therefore, you have a deficit or a shortage or a shortfall of 46,500, 63,250. Therefore, you have a shortage of 16,700 and what? 50 skilled labor hours in department what? 2. Labor hours in department. Now, because you don't have enough hours here to produce all these units of what? X, Y, and Z, you must decide of the 3 products, which one am I going to produce first? Which one am I going to produce last? Apart from deciding the order of the products you're going to produce, you also will need to determine the units of each product that you are going to produce in that particular what? Period. For us to do that, now that we've determined our limiting factor, we will determine our contribution per unit per who? Per product. But before we determine that, let us therefore here say, therefore, your labor hours in skilled, in department 2 rather, in department 2, it is the limiting what? Factor. The limiting who? That is a limiting factor. How do we know? Because here we have a what? A shortfall or a deficit. You require for 63, but you only have what? 46. You can only use what you have, okay? So therefore, your limiting factor per unit X is who? 1 hour per unit. Y is who? Is 2.5 hours per unit. And Z, lastly, is 4 hours per who? Per unit. 4 hours per unit. That is the limiting factor per who? Units. And that is also how you determine your limiting factor. Remember, we said a limiting factor is a scarce resource. Those hours of 16,750 represent the scarce hours you don't have. Step number two here is to determine your contribution per unit per who? Per product. So let's determine our contribution per unit per product. Contribution per unit. To determine contribution per who? Per unit. Let's determine contribution per unit. How do you determine contribution per unit? The contribution per unit is normally calculated by taking the difference of your selling price per unit and your total variable cost. So we can start with the first product. The first product is known as what? Again, you're going to take your selling price per unit. The selling price per unit of X is 1200. You less your variable cost, and the first variable cost is the cost of direct materials. And your material cost is how much? 300. You have another variable overhead cost, is your other variable cost, which is 150. Then you also have a cost known as direct labor cost. And your labor cost was in department 1, department 2, and department 3. Department 1, you are using 3 hours. Department 1, you are using 3 hours at a rate of how much? 20. So that your labor cost is how much? 60. Department 2, department 1 is being paid at how much? 20 shillings per hour. So if you work for 3 hours, you're going to be paid 60 shillings. Department 2, you're being paid at 40 shillings per hour. And department 2, they worked for how many hours? 1 hour. So therefore, they were entitled a cost of how much? 40. Department 3, they're working for 30 shillings per hour. And they worked for how many hours? 5. So 30 by 5 must be 150. Then we determine our contribution per unit. We've said the contribution per unit is simply the difference between your selling price and all your variable what? Costs. Let's go to Y. Your selling price per unit ni ngapi? 2000. Your material cost is 900. Your variable overhead is what? 400. Your labor cost in department 1, which was paid at 20 shillings per hour, but they worked for 4 hours. So 20 by 4 is 80. Department 2, they worked for 2.5 hours. They worked for 2.5 hours, but each hour is being paid at how much? 40. So therefore, they will be paid how much? 100 shillings. Department 3, they worked for 7 hours and each hour is being paid at 30. So that they will be paid how much? 10. The other department is department who? Z. Your selling price 2250. Material cost 600. variable overhead cost 450, labor cost of 6 by 20, 120, department 2, 40 hours per hour by 4 hours is 160, 30 hours, 30 shillings per hour by 9 must be 270. Then we now get our contribution. The difference between what? Selling price and all your variable costs and all the variable costs. Okay. So let's calculate it now. Let's calculate it. Remember, we are determining our contribution per who? Per unit. 1200 minus 300 minus 150 minus 60 minus 40 minus 100 and what? 50. The contribution per unit of X will be 500. 2000 minus 900 minus 400 minus 80 minus 100 minus 200 and who? 10. 210. 2250 minus 600 minus 450 minus 120 minus 160 minus 270. That must be 600 and what? Step number 2 is done. So let's go to step number 3. Step number 3. I hope we are together. We have successfully determined the contribution per unit. The next step on dealing with limiting factor is to determine your contribution per who? Per limiting factor per unit. So let's go to step number 3. Factor per unit. Determine contribution per limiting factor per unit. You have X, you have Y, and lastly you have which product? Z. To determine the contribution per limiting factor per unit, you're simply going to take your contribution you divide that by your limiting factor. And your limiting factor, remember we said, is your labor who? Hours. So you're going to divide this by your labor who? Hours. You're going to divide that by your labor what? Hours. Your labor hours. Per unit. X, Y, Z. The contribution per unit is as per step 2, 500, 310 and 650. 500, 310, and lastly how much? 650. You divide that by your labor hours per unit. That is the limiting factor. Remember, these labor hours per unit are the limiting factor. X is 1 hour, Y is 2.5, Z is 4. So you say 1 hour per unit, 2.5 hours per unit, and 4 hours per unit. So this will give you your contribution per labor hour per unit. Per labor hour per unit. 500 divided by 1 is 500. Then 310 divide by 2.5 must be 124. 650 divide by 4 must be 162.5. 162.5. We have determined the contribution per limiting factor by simply doing what? By taking the contribution, you divide by your limiting what? Factor. And remember, your limiting factor was the labor what? Hours. It was the labor hours. The fourth step is to rank, or what we simply denote as priority ranks. When we say priority rank of production, it is basically you want to identify of the 3 products you want to produce. Which one will you produce first? Which one will you produce second? Which one will you produce the third one or the last one? You want to produce X, Y, and who? Z. Now, the ranking here is normally based on what? It is based by the maximum, or you compute it, or you consider your maximum contribution per limiting factor. So once you've determined your contribution per limiting factor, you're going to look at the one with the maximum what? Contribution per limiting factor, that you're going to rank it as number 1. Then the second, you're going to rank it as number 2, and so on and so forth. Our contribution per limiting factor, which is your contribution per labor hour per unit, was how much? 500 for X, 124 for Y, and 162.5 for who? Z. Then you do what? Rank. According to the contribution per limiting factor above, the first rank should be product 1. Product 1, which is what? X. Let me write that using a different color pen. Product 1. Then product 2 is Z. Then product 3 is Y. Because the one with the highest contribution per limiting factor is X. Then the next highest is Z. Then the least highest is what? Y. That is step number 4. Step number 5 is now to determine the units of output of each product that you're going to do what? That you're going to produce, what we refer to as optimal production mix. Optimal production what? Mix. So here we want to identify according to the ranks here, and now that we only have 46,500 hours, how many products of each product are we going to produce? How many units of each product are we going to produce? So you're going to start here by identifying the products according to the rank here. Then have your available limiting factor, and we know what is our available limiting factor. Your available limiting factor is your labor who? Hours. Your labor hours was the limiting factor. Then your required labor hours, which is now your required limiting factor. Then lastly, you have your output. And your output is in what? Units. Your output is in units. Wonderful. The first product we want to produce according to our rank is what? X. So here we write product X. The available hours that organization currently have is 46,500 hours. So here you write 46,500 hours. For you to produce product X, the required labor hours here are how many hours? 12,500. 12,500. And then now we need to identify our output. Okay, but remember that X, for you to produce a single unit, you are using how many hours? 1 hour. So if you have 12,500 labor hours, how many units are you going to do what? To produce. So what will you do? You're simply going to take your required hours, 12,500, you divide by the labor hours per unit, which in this case was how much? 1 hour. So at the end of it all, you will need to produce 12,500 units. 12,500 units. The next product according to our rank is product Z. We write here product Z. Now your available hours will have to do what? To change. Why? Before production of X, you had 46,500 labor hours, but you have used how many labor hours? 12,500. So for you to produce Z and Y, you only have how many labor hours now available? 34,000 labor hours, which is simply 46,500 minus 12,500 to give you 34,000. Then we ask ourselves, for us to produce Z, how many labor hours do we require? And we require how many labor hours of Z? 32,000. 32,000. So here we are going to write how many hours? 32,000. Then let's identify the units we want to do what? Produce of Z. For you to produce a single unit of Z, you required how many hours? 4 hours per unit here. If you currently have 32,000 labor hours, how many units are you going to use to produce? So you'll take 32,000, you divide by by 4. So you're going to produce how many units? 8,000 units. 8,000 units. The last product that we will produce, that we should produce, is product Y, because it is the one that was ranked number 3. For you, before you produced Z, you had 34,000 labor hours, but you have used 32,000. So therefore, how many hours are remaining? 2,000. But for you to produce Y, you require how many labor hours? 18,750. Now that you don't have 18,750, how many hours are you going to use? 2,000. Remember, you can only use what you have. Okay, so here, even if you require 18,750 hours to produce Y, what do you currently have available? 2,000. And these 2,000 labor hours are the ones you're going to use to produce a certain number of units of Y. And how many units are you going to produce? You're going to take your hours that are required, 2,000 hours, then you divide that by how many hours each unit is producing. For Z, for Y, which is how much? 2.5.
So you divide this by 2.5. So you should end up producing how many units? 800 units. You will end up producing 800 units of Y. Now that is clear, we have determined the units of each product that will utilize our contribution margin. This question also required us to determine the optimal production mix. This is your optimal production mix here, but they were also telling us to determine our optimal profit. Now your profit here we know is given how? How do you determine your profit? Your profit is determined by taking P minus V, you multiply by the units minus your what? Fixed costs, minus your fixed cost. But remember, P minus V is your contribution what? Margin. You multiply by your units minus your who? Fixed cost, minus your fixed cost. Then, so let's determine our contribution. Our contribution, which you know it is your contribution margin. You multiply by your who? Units. But now, these units here, we are going to use the optimal what? Output units. Because they're asking us for the optimal profit. Therefore, the optimal output units here are the ones we're going to multiply by the contribution of each product to determine our total contribution. How is that we're going to do? Let's start with product X. Product X, your contribution margin of X is how much? 500 per unit. You multiply that by the units of X that are optimal. And the units of X that are optimal is how much? 12,500. So you multiply here by who? 12,500. The next product is who? Y. And Y, your contribution margin is how much? 310. Then 310 you multiply by your who? Optimal output, which is 800 here. So what? 310 by 800. The next product is who? Z. Your contribution per unit is 650. You multiply by the optimal output of Z of 8,000. So 650. You multiply by who? 8,000. You multiply by 8,000. So let's determine that. 500 by 12,500. That should be 6,250. Return by 800, 248,000. $650 by 8,000. You now get the total 62,50,000 plus 248,000 plus 5,200. $11,688,000. This will give you your total contribution. But then we need to subtract our who? Fixed costs. Your fixed cost. And how much was your fixed cost? Your fixed cost was given by note number 3, and your fixed cost by note number 3 is saying fixed overheads are budgeted to remain at how much? A constant value of 5 million. So we are going to subtract 5 who? Million. So hapo here your net profit, your net profit will be how much? 6,698. So therefore your optimal profit is how much? 6698 what? 6898,000. And that is how we did with limiting what? Factor. With limiting factor. Now, in case they had asked us, let me just highlight this. In case they had asked us for your maximum profit, sometimes they may also ask for your maximum profit. In case they ask for the maximum profit, yeah, you're going to determine your maximum profit here by taking your contribution margin or your contribution CM by your units of Q. But now these units here are Q are the units that correspond to maximum what? Sales or maximum what? Output. So these Q units here, should be what units? Your maximum units sold. Your maximum what? Sales demand here. And the optimal production mix, when they ask for optimal profit, I hope you've realized and I know you've noticed that these units are the optimal units produced. Optimal units produced here. And these are these units here. But now, when they say what? Determine maximum profit, your contribution will be a product of your contribution margin. But now the units are the maximum available what? Sales. Let me even use this question to show you how, what I mean by that. We can start with X. No changes to the contribution margin, 500. Then your maximum sales demand was given by additional information number who? Number 4, where X, your maximum sales is 12,500. Y, your contribution margin is what? 310. With the maximum sales demand of who? 7,500. Z is 650. With a maximum sales demand of how much? 8,000. 8,000. So let's calculate this. Let us calculate this. 500 by 12,500. That is 6250. $310 by 7,500. 23 to 25,000. 650 by that is 5.2 million. Your total contribution $62.50 plus 23.25 plus 5.2. 13,775,000. Then you less your fixed costs. And your fixed cost, remember, do not change with output. So therefore, they will be how much? They will remain a constant of 5 million. Your net profit is 87,75,000. Therefore, maximum profit is how much? 87,75,000. 87,75,000. And that is how we deal with limiting what? Factor. With limiting factor a scarce resource. Right. Now that we're done with limiting factor, or we have covered the limiting factor successfully and exhausted that, in the next session, I want us to cover throughput counting or throughput analysis. And throughput analysis is very, very close to limiting what? Factor. It is very, very close. So they are more or less related. Still, you want to determine the number of units that you want to produce when you don't have enough what? Resources. All right. So thank you. See you next time.
Welcome to Manifested Publishers. My name is Mr. Mariga, and I'll be teaching you advanced management accounting. So today we are going to continue with the topic we had started previously or in previous sessions on planning and decision making, where we had talked about cost volume profit analysis under conditions of uncertainty. Specific items we discussed during the previous sessions is number one is cost volume profit uncertainty model using expected value approach, using simulation approach. So today we will discuss using sensitivity analysis and maybe using statistical analysis. But let's start using sensitivity analysis. So C is sensitivity analysis. Now, sensitivity analysis here is basically where you want to measure or you want to identify or to determine the percentage change in factors affecting profits as a reason of changes in what? In profit. Let me explain that. You want to determine how sensitive one of the profit is as a result of changes in what? One of the factors affecting what? Profit. And we can have an illustration given your selling price per unit is 200, your variable cost per unit is 50, your fixed cost in total is 200,000, and your current sales is how much? 2,000 units. Then required, compute the percentage change in each input
input, variable in each input variable, which will cause profit, to drop to what? To zero. So determine the percentage change of each variable which will cause the profit to drop to what? To zero. We can start by determining that and realizing that your profit, which we denoted as P, as pi rather, is P minus V. You multiply by your units minus your what? Fixed costs. Minus your fixed cost. So you want to analyze what change will the selling price change by for the profit to be zero? What percentage change will the variable cost change by to give you a profit of zero? The fixed cost and also the units. Let's start with A, percentage change in what? In P. In selling price P per unit. Remember, P means your selling price per unit. Your current profit is going to be zero. You have to determine a new selling price. Your variable cost is 50. Your units sold are not going to change. Will be how much? 2,000 units minus a fixed cost of 200,000 minus a fixed cost of 200 what? 1,000. So this will be 200,000 is equals to 2,000 P minus 10. That is what? That will be your what? Your equation. That will be your equation. What we've done, we've simply taken 200 to the other side, then opened this bracket by taking 2,000 by P, that is 2,000 P, then 50 by 2,000, that should be 100,000. Then you're going to say 300,000 is equals to 2,000 P. So that means your new selling price for it to result in a profit of how much? Zero, means your selling price will be what? 150. But remember, we want our percentage change. So you're going to take the current or your new selling price, which is how much? 150. You subtract your original selling price of 200, divide by what? Original selling price of 200. Then you multiply by who? 100%. You multiply by 100%. So it basically means that for your profit to fall to zero, the selling price will need to reduce by what percent? 25%, if all the other factors are not being done what? Affected. That is a percentage change in what? Selling price. Let us also do the same for variable cost. Percentage change in variable who? Cost. Again, you want your profit to be zero. All the other factors apart from what? Variable cost will be the same. Your original selling price is 200. You want a new variable cost. How many units are you selling? You're selling 2,000. And your fixed cost is still originally how much? 200,000. 200,000 is equals to 2,000 by 200. That will be 400,000 is equals to 200,000 or 2,000 of what? V. So 200,000, if you work it out, is equals to what? 2,000. So your variable costs will be how much? 100. So for your for your variable cost to give you a profit of 0, it will need to be set at what? 100. So let's determine our percentage what? Change. Your percentage change, which will be your original or rather your new 100 minus the original, which was how much? 50. Then divide by the original, then times what? 100 times 100. So therefore that is 50%. 50%, which basically means that your variable cost will have to do what? To increase by 50% for the cost to do what? For the cost to have an impact of making the profit to be what? 0, of making the profit to be 0. That is your variable cost. Then the other factor that we want to analyze, say percentage change in what? Units. So percentage change in what? Units. So we want to identify what change will result in profit being what? 0. What change in units will result in profit being 0. So you will say 0 is equal to, your selling price is 200, your variable cost is 50. The units, you don't know, but you know your fixed cost is how much? 200,000. So therefore, your units will be 200,000 divided by who? 150. Divide by 150. 1333.33 units. So for the company to gain a profit of 0, which is where your revenue and your cost are equal, you have to sell how many units? 1333.33. 1333.33. Let's now identify the percentage what? Change. Your new units minus your original units, divide by your original units, times 100%, times 100%. So we want to take the percentage change. So it basically means what? That your units will have to fall by 33.33% for the profit to be what? 0. Let's analyze your fixed costs. Percentage change in fixed costs. The percentage change in fixed costs. Again, you want a profit of 0. Your selling price will be as original 200. A variable cost of 50. Your units are 2000, but you know you don't have your what? Fixed cost. So therefore, your fixed cost will be what? 150 by what? 2000. When you work that one out, that will give you 300 what? 1,000. What we've simply done, we've taken this fixed cost to the other side. Then open that bracket. Alright, so your percentage change in fixed costs will be your new fixed costs minus your original fixed cost, divide by your original fixed costs, times 100. So it basically means that your fixed cost will have to do what? To change by 50%, or it has to increase by 50% for the selling price or for the profit to be equal to what? To 0. To be equal to 0. That is what we refer to as sensitivity analysis. Simply analyzing the percentage change in one variable as a result of another variable. All right. Sensitivity analysis is that. Let's go to the next method known as statistical analysis. The next.
Hello candidates, and welcome to the Advanced Financial Management Learning session. The topic is mergers and acquisitions. In our today's lesson, we're going to discuss the regulatory framework for mergers and acquisitions. Regulatory framework for mergers and acquisitions. And in this lesson, we're going to highlight some of the regulatory bodies and legislation govern mergers and acquisitions in Kenya. And the regulatory framework for mergers and acquisitions in Kenya is designed to ensure fair competition and also to protect the interests of various stakeholders where companies choose to merge or when a company decides to acquire another one. That decision is likely to affect many stakeholders like the employees, the management, the shareholders, the investors, the members of the public, and so on. And therefore, it's important that these transactions are regulated. That's why we have regulatory bodies in Kenya that help in ensuring that the interests of the various stakeholders are protected. So the first regulatory body is the Competition Authority of Kenya. One, Competition Authority of Kenya. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisition activities in Kenya. And the mandate of the CAK is derived from the Competition Act. It is derived from the Competition Act. This is an act of parliament that stipulates that there ought to be a Competition Authority of Kenya, which has been put in place since the year 2010. It is the principal legislation governing mergers and acquisitions, right? The Competition Authority of Kenya. It is the principal governing body. And the role of the Competition Authority of Kenya is to prevent anti-competitive practices that may arise from mergers and acquisitions. Do you understand? That is the primary role of the CAK. Is to do what? Is to prevent anti-competitive practices that may arise during these transactions, the mergers and acquisition. The second body is the Market Authority. Capital Market Authority, CMA. CMA, the Capital Market Authority, regulates mergers and acquisitions involving companies that are listed on the Securities Exchange, companies that are listed on the Nairobi Securities Exchange. So if the companies that are listed on the Nairobi Securities Exchange choose to merge or to acquire or to take over other companies, the Capital Market Authority has to be involved. The CMA has developed regulations, what we call takeovers and mergers. that is capital market takeovers and mergers regulations. These are regulations that guide the acquisitions and mergers involving companies that are listed on the Nairobi Securities Exchange. You understand? These regulations provide the framework for such activities. And the CMA ensures that there is transparency. The CMA also protects investor interests and so on, particularly the interests of the companies that are listed on the Nairobi Securities Exchange. You understand? So the Capital Market Authority, through the takeovers and mergers regulations, ensures that there is transparency, ensures that the interests of the public, the interests of the various stakeholders are protected. So this is the second body, the Capital Market Authority. The third body is a Central Bank of Kenya. The Central Bank of Kenya regulates mergers and acquisitions in the banking and the financial services sector. Banking, and financial services sector. Mergers and acquisitions that occur in the banking and financial services sector are regulated by the Central Bank of Kenya. And the Banking Act also requires that financial institutions should obtain the central bank approval for mergers and acquisitions. So we have again here the Banking Act as another piece of legislation that guide mergers and acquisitions in the banking and financial services sector. So the companies that operate in the banking and financial services sector that would wish to merge or to engage in acquisition activities, they must seek approval from the Central Bank of Kenya. The Central Bank of Kenya. Number 4, we are currently discussing the various bodies that regulate mergers and acquisitions. And the third one here is the Communications Authority of Kenya. Communications Authority of Kenya. Communications Authority of Kenya regulates mergers and acquisitions of companies within the communication sector. Within the communication sector. The fifth body is the Insurance Regulatory Authority. Insurance Regulatory Authority. Insurance Regulatory Authority, the IRA, regulates mergers and acquisitions of companies within the insurance sector. I can go on and mention such bodies and mention other acts of parliament like the Companies Act, the Companies Act, the Companies Act of 2015 provides the general regulations. They provide what we call general regulations for companies within Kenya, and it impacts how mergers and acquisitions are carried out. How mergers and acquisitions are carried out. You understand, candidates? Regulatory framework for mergers and acquisitions in Kenya. These are 5 bodies and the Companies Act. And in this lesson, we've learned that the regulatory framework for mergers and acquisitions is designed to ensure fair competition. It's also designed to protect the interests of various stakeholders, like the Competition Authority of Kenya. We've said this is the principal body. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisitions. And we mentioned that its mandate is derived from the Competition Act, which is the principal legislation governing competition and mergers and acquisitions. We've stated here again that the Competition Authority of Kenya, the role of this authority is to prevent anti-competitive practices that may arise from mergers and acquisitions. So this is the principal body, principal legislation. This is the principal body, and the principal legislation is the Competition Act. The second body is the Capital Markets Authority. The Capital Markets Authority, we've said, regulates mergers and acquisitions of companies that are listed on the Nairobi Securities Exchange. And the Capital Markets Authority has developed regulations that are referred to as the Capital Market Takeovers and Mergers. Takeovers and mergers. Takeovers and mergers, which provide the framework for mergers and acquisition transactions. Number 3 is the Central Bank of Kenya. We've said regulates mergers and acquisitions in the banking and financial services sector. And we've stated that the Banking Act, which is an act of parliament in Kenya, the Banking Act requires financial institutions to seek approval from the central bank. Okay? Requires that companies within the banking and financial sector seek approval from the Central Bank of Kenya before merging. The number 4, we have the Communications Authority of Kenya, which regulates mergers and acquisitions in the communication sector. We've gone ahead to identify also the Insurance Regulatory Authority of Kenya, which you've said regulates mergers and acquisitions of companies within the insurance sector. So that marks the end of the lesson, where we've discussed briefly the regulatory framework for mergers and acquisitions in Kenya. Here is today's assignment. Number 1, what are the key objectives of anti-competitive regulations in the context of mergers and acquisitions? And how do these regulations aim to protect market competition? Number 2, how do cross-border mergers and acquisitions create complexities in regulatory compliance, and what international frameworks exist to address these challenges? I repeat, how do cross-border mergers and acquisitions create complexities in regulatory compliance? Number 3, how does the regulatory framework regarding disclosure requirements impact the transparency and fairness of the mergers and acquisitions process? Thank you for attending the lesson. We'll meet in the next lesson, where we continue to share knowledge in advanced financial management. Bye-bye.
Hello learners, welcome today to our session 3 or lesson 3, where we want to look at long-run analysis of costs. Long-run analysis of costs. Long-run run analysis of costs. So in the short run, we said that this is normally a period where at least one factor must be fixed and the other should be variable. In the long run is where all factors can be varied, and therefore we do not have any like law of diminishing returns to variable factor, because we are assuming that all factors can be varied. Varied meaning we can interchangeably vary the proportions of different factors. Why? Because they will not remain constant, as in the case of short-run analysis. So what operates in the long run is the economies or these economies of scale. So when the firm factors can be varied, the firm can either experience economies of scale or these economies of scale. So in this lesson, we want to look at economies of scale in relation to internal economies of scale. So what are economies of scale? Economies of scale are simply those advantages that a firm enjoys after it has expanded. We normally have what we refer to as an optimal size of a firm. And an optimal size of a firm is simply that efficient size that a firm can have so that it's able to produce at the minimum or the lowest production cost per unit, so that it has no option of either increasing or decreasing its level of output. So in that case, we say that the firm is operating at its optimal size. And that's when economies of scale will come in. So in economies of scale, we want to begin with internal economies of scale. So what are internal economies of scale? These are those benefits, or I refer to them as advantages, that a firm can experience that are coming from within. They have nothing to do with the outside. What are the happenings that are happening in the organization, like when the firm has expanded, that can be a benefit to the firm? That's what we refer to as internal economies of scale. So they are as follows. We have what we refer to as technical economies of scale. So technical economies of scale, like when a firm increases in its size, it is normally able to use sophisticated or modern technology. And when it is using modern technology, it will be able to increase its level of output than that firm that has not expanded. And under technical economies of scale, we have such benefits like what we refer to as indivisibilities. So what are indivisibilities? Indivisibility is simply where a firm is able to take advantage of a process that cannot be reproduced on small scale. So one of the technical economies that a firm will enjoy is what we refer to as indivisibilities. And indivisibility is simply where a firm is able to take advantage of a particular process that cannot be reproduced on small scale. So that simply means this firm will have a process or a particular process which a small firm cannot have. Like, for example, when a firm has a particular machine that can enable it to produce, and when it is producing to in large scale or in large quantities, which a small firm cannot be able to produce. Why? Because a small firm produces on small scale. We say it is enjoying a benefit of indivisibility. We have another one which we refer to as increased dimension. Increased dimension. Increased dimension is where a farm can increase its equipment, can increase the capacity of its equipment so that it is able to produce a larger output without increasing costs. That is increasing without increasing production costs. So increased dimension is where when a farm has a particular equipment, it can decide to enlarge or to increase the capacity of that equipment so that it's able to produce a larger output than what it has been producing before without necessarily increasing the production cost. I can give an example like for these commercial services, you've been having or owning a matatu. A matatu has one driver, and then because your business has enlarged, you now decide to bring in a bus. So a bus still will need one driver, but the capacity is more large than that of a matatu. So in that case, that benefit is called increased what? Dimension. You are producing more, but you are not necessarily increasing the production cost, and if it is there, then it is very minimal. And then number 3, Roman 3, still part of technical economies of scale, we have another benefit of linked processes. So linked processes is simply where a farm can link up its processes that can enable it minimize its costs. So linked processes is where, like, we have farms that buy raw materials, and once they buy those raw materials, they use the raw materials in the production of goods and services. And then once they have produced goods and services, they again market for those goods and services before they are sold. So linked processes is simply where a farm can decide to supply for itself raw materials as well as produce the goods. It can even go up and do the marketing by itself so that it is reducing costs such as fuel cost. You don't need to get raw materials from another supplier, bring them before you produce. You simply have a portion where you are supplying raw materials. So instead of buying them from outside, you simply use what you already have, and then you will be able to do what? To produce using minimal costs. Why minimal costs? Because we will cut costs to do with transportation, etc. Those are called linked processes. And then we also have another one still on technical economies called specialization. So specialization can be where a farm can specialize, like in terms of machinery and labor, so that it produces what's quality, so that it produces what is quality. So specialization is where a farm can simply decide like to specialize on a particular machine. So it buys a special machine that will enable you to produce what is quality, or have a specific class of workers who are able to help in production of that which is quality. So like when we talk of competition, what happens? Because they will be producing what is quality, their products will be more competitive than of those other farms. And then we can also talk about research, still under technical economies. Research is like when a farm has grown, it has an ability of conducting a market research. Like whenever it wants to introduce a new good or a new product, it can be able to know what are the needs, what are the tastes and preferences of the people before it can design and produce what is to satisfy the need of its customers, which may not be so with small farms. So research is where a farm will be in position to conduct a market research, which can enable it to produce that which satisfies its customers. And when that happens, that means profitability of the farm will increase. When customers are satisfied with what you produce, they will buy more, and when the more they buy, the more you'll do what? The more you will make profit. That was number one. Then number two, we have what we refer to as financial economies. So financial economies is where when the farm grows or enlarges, it normally has more in terms of assets. And for example, whenever it wants to raise like a loan or funds from a financial institution, it is in proper position to provide security or what we refer to as collateral. And because of that, they will always raise funds at a lower rate, like in terms of interest, than those that are small farms. So financial economies is where a farm is able to raise funds from financial institutions at a lower cost. Why? Because at a lower cost, because it is in position to raise assets that can be used as collateral. Then number three, we have marketing economies. Marketing economies. So marketing economies is where when a farm expands, it will be able to like take advantage in buying in bulk. When a farm buys in bulk, it will enjoy quantity discounts. And when it enjoys quantity discounts, it means that it will be buying at a lower cost than what others will be buying at. And therefore, it will be always saving in terms of purchase. And then it can also enjoy economies to do with packaging. When it is packaging in large quantities, it is more cheaper than when packaging in small quantities. And then when it comes to selling and even distribution, it will have that advantage. So marketing economies, these are normally in the form of like buying in bulk. Buying in bulk. This enables the farm to take advantage of quantity discounts. Hence buying at a lower price, which makes them to save in terms of the purchase price. We also have packaging. Packaging is where I can just say packaging in large quantities. Packaging in large quantities enables a farm to save rather than packing in small. Why? Because when we pack in large quantities, the cost is normally spread on those units that are packaged in that one package. But when you are packaging in small quantities, then that simply means that you will incur a higher cost than a farm that is packaging in large quantities. And then number 4, we have diversification. Diversification is where when a farm enlarges, it has an ability of even producing more products. Like it can introduce new products. Why? Because it has an ability to do that. So like, for example, where there is competition or when it is facing competition with other farms, it can decide to introduce new products which can enable it to fight that competition, and that enables it to continue remaining on the market. So diversification is simply where a farm is in position to introduce new products. A farm is in position to introduce new products that can lead to increased profits, as well as acting as a risk management strategy. And then number 5, we have risk-bearing economies. So what are risk-bearing economies? Like when a farm expands, it can be able to predict risks better than small farms. Why? Because like when it is conducting a market research, it will be able to know what are the advantages, what are the disadvantages of its product, who are the competitors, and because of that, it can simply be able to use SWOT analysis so that it is able to do what? To minimize its risks than a small farm. So risk-bearing economies, we say that a large farm is able to predict risks than a small farm. Why? It has an ability to conduct a market research. It can conduct a SWOT analysis than a small farm. So those are the internal economies of scale. Then we have disadvantages or these internal diseconomies. Can look at that shortly. Internal diseconomies of scale. So in our next lesson, we'll be looking at internal diseconomies of scale. So learners, have a good day. This ends or marks the end of our session.
December 2024 past paper on finance for decision making, question 2C reads as follows. The following information relates to Uzima Limited for the 4 months given below. So you have the sales for September, October, November, and December. All sales will be made on credit. Half of the debtors are expected to pay within the month of sale and are also expected to claim 8% cash discount. The remaining debtors are expected to pay by the beginning of the following month. Then below that statement, we have raw material purchases for September, October, November, and December. The firm plans to pay its creditors in full in the month following that of purchase. Then below that statement, we have the wages and salaries for September, October, November, and December. Part 2 or page 2, we have additional information on page 2. Additional information number 1 reads, all employees are paid in the month in which the wages or salaries is earned. Number 2, rent of 40,000 for each quarter is paid in the month of March, June, September, and December. 3, other cash overheads of 8,000 shillings per month are payable. 4, a new plant due for delivery in September will be paid in November at a cost of 100,000 shillings. 5, on 1st October, the firm plans to have 40,000 shillings in the bank. That is on 1st of October. On 1st of October. Required a cash budget for the month of October, November, and December. October, November, and December. So that is the question. We are to prepare a cash budget for the month of October, November, and December. So that is it. Part C. We are to prepare a budget, a cash budget. The company is known as Uzima Limited. Cash budget for the month. You have to have a title for the month. For the months, there are months. For the month of October, November, and December. That is the title. Now remember we said that a cash budget comprises of 2 main components: receipts and disbursements. Cash inflows and cash outflows. Cash inflows and cash outflows. So from the information given, we need to identify the receipts and payments for the month of October, November, and December. So we have October, November, and December. So here we have December. We'll have 3 columns for the amounts: November and October. These are shillings. Are they in thousands? No, they're just shillings. So candidates have said that a cash budget will contain mainly the disbursements, which are cash outflows or receipts, and the receipts and cash disbursements. But again, there could also be balances. In this question we read that there will be a balance. The company intends, we read that the company intends to have a cash balance of 40,000 on October 1st. So we will have, first of all, a row for cash balance. This is cash balance brought down. At the beginning, we've seen for the month of October, the company expects to have 40,000 shillings. Then we have the receipts. We need to identify the sources of these receipts. Now from the question, we have cash sales, that is the first source. Then you have collections from debtors. Look at the question. Those are the main receipts. Cash sales, you have cash sales. Then the second receipt is cash from debtors. Cash collections from debtors. Cash from this question, those are the only two receipts. Then you have disbursements or payments. Payments. What payments? The first payment here will be the credit purchases. Credit purchases. Payments will be made to the creditors. Credit purchases. The second payment will be from the question we see wages and salaries. Then we have rent. Rent is a payment. We have cash overheads. Cash overheads. Overheads are indirect expenses. Then do we have any other? Yes, we read that the company will pay for delivery of a new plant. That is a payment. This is new. Plant is expected to be paid in November. That we can just have it in November. Here we have 100,000 will be paid in November. New plant. Then I don't think there is anything else. There is no payment. So we'll have here total payment. Total payment. We have total payment. That is a row for total payment. Then receipts. There is also total cash receipts. We have here a total receipts. So we have balance at the beginning. We add cash sales. We add cash from debtors. We are going to have the total receipts for each month. Then out of these total receipts, we are going to deduct the payments, which include the credit purchases, wages and salaries, rent, cash overheads, new plant. So we'll have the total payments. So we deduct the total payments for each month from the total receipts. When we deduct total payments from total receipts, we are going to have cash balance at the end of the month. This is cash balance at the beginning. So cash balance at the end is known as balance carried down. This is balance brought down. At the end we call it balance carried down. So these are the columns that we are going to have for October, November and December, and these are the rows which we have obtained from the question. So the balance at the beginning of the month of October, we have it from the question. Then we need to have a working for cash sales. That will be our working number one. So we will have workings over here. So working one is cash sales. And what information do we have on cash sales? We read from the question that half of the debtors are expected to pay within the month of sale and are also expected to claim 8%. So you'll have a working here for cash sales. We start with the October. The cash sale for October will be half of the debtors. Half of the debtors. So half of the debtors for October, we have a half of the amount for debtors for October is 240. We multiply by 240,000. This gives us the half the amount. But we read from the question that and are also expected to claim 8% cash discount. So the company is expected to claim 8% discount. Okay, 8% discount. Debtors are to pay, but there is 8% discount, which means the 200 and half of 240 will not be received 100%, but will be 100% minus 8%, which is 92%. So we are going to multiply this figure by 92%. The same case for November. Half will be paid. Half of the amount for November from the question is 280,000 times 92%. December, half of the amount there is 360 times 360,000 multiplied by 92%. So the rest is the work of the calculator. We go to the calculator. Let me pick my calculator. Yes, I have it here. So we have a half of 240, that will be 120. So 120,000 times 92%, 0.92. 110, 400. Then a half of 280, this is 140,000. 140,000 times 0.92. 128, 800. December, 360, half of 360, this is 180. 180,000 times 0.92, 165, 600. So this is the cash sales for October. 110, 400. November, 128, 800. December, 165, 600. That is working one. Cash sales. Then what do we read? The cash collections from debtors, we read that the remaining debtors are expected to pay by the beginning of the following month. Or to pay the beginning of the following month. That means that the sales credit for September will be due in October, half of it. So this is cash collection from debtors. So number 2, the second working is cash collection debtors. Cash collection from debtors, read from the question that the remaining debtors are expected to pay by the beginning of the following month. That means that the September credit sales will be due in October. September in October. So September sales will be is 240 September sales, and half of 240,000 will be due in October. So half of 240 is equal to 120,000. So that is October. The September sales will be due in October. October sales will be due in November. October sales will be due in November. The October sales again, October sales is 240. So half of 240 will be due in November, which is equal to 120,000. And lastly, November sales will be due in December. November sales is 280. November sales is 280. 280, half of 280 will be due in December. Half of 280 is equal to 140,000. So these are cash collections from debtors. For the month of October, how much will be received? The amount that will be received in October is half of what was to be received in September, which is equal to 120 as calculated. Cash from debtors for the month of November is half of the sales that were to be received in October, which is equal to again 120. December 140. So these are the receipts. So we are going to sum the receipts. We begin with the October receipts. October receipts. We have the balance at the beginning of 40,000. Add 110, 400, add 120,000. It's equal to 270, 400. We go to the expenses. We move to expenses. One source of expense there is credit purchases. Credit purchases from the question, we see that we read that the firm pays its creditors in full in the following month. In the following month of purchase, the following month. The firm pays its creditors the following month, which means September purchases are paid in October, October purchases are paid in November, November purchases are paid in December. So we have the purchases, and the September purchases are paid in October. What is the amount for September purchases? September purchases is 80,000 is paid in October. So the credit purchases that will be paid in October are September purchases, which 80,000. Then we have the October purchases that will be paid in November, amounting to 160,000. November purchases will be paid in December. November purchases will be paid in December. November purchases amount to 160,000. Then of course we have wages and salaries from the question. Wages for October is 60,000. 60,000 October wages. Then November wages 68,000. December wages, we are reading from the question, directly from the question. These ones we are picking directly from the question. We do not require workings. The wages and salaries for December is 52,000. Then of course we have rent, which we see will be paid. The rent amounts to 40,000. The rent amounts to 40,000, and we read that from the question, rent. That is which note? Rent. Let's move to page 2. Note 2 reads, rent of 40,000 for each quarter is paid in the month of March, June, September, and December. So for the last quarter, this is the last quarter, we have a rent of 40,000 which is paid in December. So the rent here is paid in December. It's very clear from the question, direct. Then we have cash overheads. Cash overheads. We have cash overheads. Yes. Cash overheads amount to 8,000. Cash overheads amount to 8,000 for each of the months. Cash overhead, we have 8,000, 8,000, 8,000. Then of course you have the new plant that is to be delivered in November of 100,000. So we can now do the totals. We have plugged in all the details. So first we begin with the month of October. We are going to do the cash balance, which will bring down to the month of November. We have the total of receipts in October. We need to get the total of purchases, the total of payments in October. We deduct the total payments from the total receipts to get the cash balance at the end of the month of October. So let's do the total payments. 80,000 plus 60,000 plus 8,000 is equal to 148,000. This is total payments for the month of October. We deduct this payment from the receipts to get the balance. So we deduct 148,000 from 270, 400. So the balance here is 122, 400. So this balance carried down at the end of October becomes the balance brought down the month of November, which is 122, 400. That is balance brought down. This balance brought down is going to form part of the receipts in the month of November. So we take the 122, 400, add 128, 800, 128, 800, add 120,000, 120,000. The total is 371, 200. That is total receipts for the month of November. We deduct the total payments from this total receipts. What's the total payment? The total payment is 160 plus 68 plus 8 plus 100,000. So total payments for the month of November, 160,000 plus 68,000 plus 8,000 plus 100,000. So I get here 336,000. 336,000 is the total receipts. Deduct from 371, 200, 371, 200. The balance carried down is equal to 35, 200. 35, 200 is the balance carried down month of November. Balance carried down month of November becomes balance brought down month of December, which is 35, 200. We are going to add here to get the receipts. 35, 200 plus 165, 600 plus 140,000. Total receipts month of December, 340,800. We do again the total receipts, the payments for total payments for the month of December. So 160,000 plus 52,000 plus 40,000 plus 8,000. So I have 160,000 plus 52,000 plus 40,000 plus 8,000. Total 260. Is it 260? Yes, 260,000. We deduct from the 340 to get the balance at the end. 340, 800. So balance here at the end is 80, 800. So look at the question again. Do you have anything that we have omitted? No. So that is the preparation of cash budget. We've answered the question that was tested in December 2024, question 2. When preparing the cash balance, the cash budget candidates, first of all, make sure you have the heading. That is the name of the company that is preparing the cash budget. So there are three main columns. There are two main columns. The two main sections. We have section for the receipts. We have section for payments. Then we have balance at the beginning. This balance at the beginning is given in the question. We begin with the balance at the start. We add the receipts for the month, deduct the payments for the month. Then we have the balance carried down at the end. The balance carried down at the end of the month, one month becomes the balance brought down the next month. We do the same process. We have a balance carried down at the end of this month, which is also brought down the next month. Then again, we deduct the cash payments from the total receipts. We get the balance carried down at the end of the last month. That's the end of our today's lesson. Thank you. We will answer more questions from past papers. If you go to the block revision segment on our website, we've done more questions. So make sure you go to the past papers, attempt the other questions, and you can also refer to the answers in our books. We have done this also in our revision books. The same answers are in video format on our platform, www.manifestedpublishers.com. Bye-bye. Greetings, candidates, and welcome back to the Advanced Financial Management class. Today we continue with the topic mergers and acquisitions. So far, we've studied the nature of mergers and acquisitions. We discussed the arguments for and against the use of mergers. We went ahead to highlight some of the evaluation models, the defense tactics against hostile takeovers. Today we move on to the next subtopic, which is financing of mergers and acquisitions. Now, after the evaluation of a target, the company has to figure out which method to use to finance the acquisition. And there are various ways. The company can choose to do what we call outright purchase using cash. There could be share for share exchange, share debenture exchange, and share preference exchange. In this lesson, we're going to discuss the various methods that can be used in financing mergers and acquisitions. And the first method is outright purchase using cash. Outright purchase using cash. The second method is share for share exchange. Number 3, we have the share debenture exchange. Share debenture exchange. 4 is the share preference exchange. Outright purchase using cash, number 1. Number 2, share to share exchange. Number 3, share debenture exchange. Number 4, share preference exchange. In this lesson, we're going to highlight the advantages and disadvantages of these methods. We're going to also discuss how the methods can be used. First of all, let's begin with the share purchase using outright cash. Share purchase using outright cash. After valuation of a target, the acquirer may decide to pay or to purchase the target using cash. So when discussing the financing of mergers and acquisitions, an outright purchase using cash refers to the straightforward transaction where the acquiring company pays for the target company entirely with cash. Entirely with cash. If the agreement is, say, 100 million, the acquirer pays the 100 million transaction in cash. Straightforward. Do you understand? So the target company shareholders receive immediate cash. They receive immediate cash payment for the shares. They receive immediate cash for their shares. So shareholders of the target company receive immediate cash for their shares. They receive immediate cash for their shares. So that is one feature of outright purchase using cash. It is a very simplified transaction compared to other financing methods like stock swaps or cash acquisitions, and cash acquisitions tend to be simpler compared to share, compared to share debenture exchange, compared to share preference exchange. This one is simpler. It is a simpler transaction. It's like going to a yard and just paying for a car, or going to a market and you pay for a commodity. It is simple. You pay the seller and the transaction ends there. There are very few complexities related to valuations and potential fluctuations in stock prices. Another aspect here is control and ownership. Control and ownership. The acquiring company gains full control, full and immediate control of the target company. And there is no dilution of ownership. There is no dilution of ownership for the acquiring company's existing shareholders. Control and ownership is immediate. Financial resources. This method requires financial resources. For the target company to effect this transaction, for the acquirer to effect this transaction, then the acquirer has to have financial resources. Financial resources. The method requires the acquiring company to have substantial cash reserves, or the company should have the ability to raise significant capital. You understand? So this method comes with the advantages, what we call pros, and disadvantages, what we are calling cons. Now the first advantage of financing of mergers and acquisitions using outright purchase using cash, is certainty for the seller. Certainty. Certainty is an advantage for the seller. The target company shareholders receive immediate and guaranteed payment. Immediate and guaranteed payment, which then eliminates uncertainties associated with stock fluctuations. There is that element of certainty. Simplicity, speed and simplicity is another advantage. Speed and simplicity. Here we say that is a simple transaction. Cash transactions tend to be quicker and less complex than those involving stock exchanges like the share-to-share exchange, the debenture, share-debenture exchange, and so on. Simple and quick. Speed and simplicity. Clear valuation. Clear valuations. Now, how is clear valuation an advantage associated with the outright purchase using cash. Now the price is clearly defined. Before the payment is done, the price is clearly defined. Clearly defined, which reduces then valuation disputes. Clear valuations reduces valuation disputes. Maintains control. There's also an advantage associated with control. Control. The acquiring company retains full ownership and avoids diluting its existing shareholding or its existing shareholders' equity. Another advantage is positive market perception. Positive market perception. Positive market perception. How is positive market perception an advantage? Positive market perception. How is it an advantage? Now, candidates' cash deals can often signal financial strength to the market. When the market hears that company A has acquired company B with an outright purchase using cash, then it sends a signal, an indicator that company A is doing well, and investors would want to be associated with companies that have strong financial muscle. So these are 5 advantages, but you also have disadvantages. There are some disadvantages that are associated with the financing of mergers using outright cash. One is financial strain. It can lead to financial strain, particularly where the target is overvalued. Large cash outlays can deplete the acquiring company's financial reserves, which then potentially hinders future investments or operations. Opportunity cost. Opportunity costs. Using cash for acquiring a company means that those funds are unavailable for other potential uses, such as research and development, such as expansion, and so on. Funding requirements, number 3. Funding requirements. If the acquiring company lacks significant cash, it may need to borrow. It may need to do what? To borrow. It may need to increase debt. Then that leads to what we call debt load. And debt load, we know, is associated with the interest expenses, which are fixed. That is a disadvantage. If the company lacks money from its internal sources, then the acquiring company may be forced to borrow, and that increases its debt load, and it increases the interest charges that are associated with debt. Funding requirements. There could also be tax implications. Tax implications. For the seller candidates, receiving cash creates an immediate taxable event. Okay? There is an immediate taxable event, and that could lead to capital gains taxes, which will be due to the seller. So that is all we can say about outright purchase using cash when financing mergers and acquisitions. So this is the first method. Now the second method is share-to-share exchange. Share-to-share exchange. B share to share exchange. Share to share exchange. Exchange. Share for share exchange is another method that a company may use to finance mergers and acquisitions. Now, when discussing the financing of mergers and acquisitions, a share for share exchange is a crucial method to understand before settling on which method to use. Companies have to consider the share for share exchange method. And in essence, share for share exchange is a transaction where the acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. Share for share exchange. It's self-explanatory, is it not? The acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. So if company A is acquiring company B, so this is the acquirer and this is the target, the predator. This company has shareholders, this company has shareholders. This company is buying company B. This company B is owned by existing shareholders. So instead of paying the existing shareholders cash, as we saw in the first case, this company can offer its own shares to company B. Because once company B is acquired, this company ceases to exist. So instead of these shareholders being granted or given cash, they become shareholders of company A by virtue of the shareholding that they receive in exchange to their existing shares. So they have to relinquish their own shares in company B, and for them to relinquish these shares in company B, they are given company A shares. The acquiring company offers its own shares to the shareholders of the target company, and that is in exchange for their existing shares. So they are not given cash, they are given shares of company A, the acquirer. And that means that instead of receiving cash, the target company's shareholders become shareholders of the acquiring company, to put it differently. And a critical element here is the exchange ratio. Okay, there has to be a ratio. A critical element in share for share exchange is the exchange ratio, which determines the target company. You understand? The exchange ratio, which we will be learning how to calculate later on, but you have to get that understanding. You need to understand what is a share for share exchange. Now, one of the key features of share to share exchange is that it is equity based. This method is equity based. We are talking about share to share exchange. It is equity based. It's based on equity. The method primarily involves the exchange of equity rather than the exchange of cash or debt. Another feature associated with what is dilution. Another feature associated with the exchange, the share-to-share exchange, is dilution. Now, the acquiring company issues new shares, which then dilutes the ownership percentage of its existing shareholders. If, for example, there were only 10 shareholders, when new shareholders are introduced, say 20 shareholders are introduced, then there is dilution of shares. There is dilution. The existing company, after issuing new shares, dilutes the ownership percentage of its existing shareholders. So these ones were holding equally, say equal, maybe each is a tenth of the shareholding. When you have 20, they will no longer be controlling, each shareholder will no longer be controlling 10%. The percentage will be diluted by virtue of having many shareholders in the company. Dilution. Another feature associated with the share-to-share exchange is the aspect of valuation. Valuation. Accurate valuation of both companies is essential in order to determine a fair exchange ratio. The companies must be properly valued in order to have a fair exchange ratio. There could also be tax implications. In some jurisdictions, this type of exchange can be structured to be tax deferred, which can be a significant advantage. Now, why would a company then prefer share-to-share exchange and not outright cash or share-to-debenture exchange? Why do we have some companies preferring share-to-share exchange? That is a question that we may want to answer. Companies use share-to-share exchange in mergers and acquisitions for various strategic reasons. And the reasons are structured around financial flexibility. They are structured around alignment of interests and also tax advantages. One reason is to conserve cash. Companies will prefer share-to-share exchange as opposed to outright purchases in cash in order to conserve cash. That is the primary reason. The primary reason a company will opt for share-to-share exchange is to conserve cash. Instead of paying cash for the target company, the acquiring company offers its own stock. And that is especially important for companies that want to preserve their financial resources. So that instead of paying the target company, that money can be invested. That's one reason. Another reason is associated with large acquisitions. Large acquisitions, another reason. Now, large acquisitions, a cash purchase might be prohibitively expensive, which makes share-for-share exchange a more viable option if you have a large acquisition. if the target company, if the acquirer is to pay large sums of money to the target, the only viable solution will be share-to-share exchange. Yet another reason is aligning of interests. Aligning of interests. Aligning of interests. Now, when the target company shareholders, for example, receive shares in the acquiring company, they become shareholders in the combined entity. And that aligns their interests with the acquiring company's interests, which then encourages them to support the integration process. You understand? Yes. Because they are now part of the ownership of the acquiring company. To align the interests of both the target company and the acquiring company, the share-to-share exchange method is preferred. Tax advantages. Now, candidates, in some jurisdictions, a share-for-share exchange can be structured as a tax-deferred transaction. It can be structured as a tax-deferred transaction, which means that the target company's shareholders do not have to pay capital gains taxes until they eventually sell the shares of the acquiring company. Deferred. That's why I refer to it as deferred. It is a tax-deferred transaction. Tax-deferred transaction. Because it is a share-to-share exchange, the shareholders of the target, as opposed to the cash method, they are not required, may not be required to pay capital tax gains after selling off the company. They may be required to to pay tax gains after selling the shares that they receive from the acquiring company. So that is another reason. There are no capital gains taxes that are paid when this transaction is being carried out. And that is a tax advantage. That tax advantage is attractive to the shareholders. It makes the deal more attractive to the target company's shareholders because it allows them to defer paying taxes on their gains. They gain by joining the acquiring company without making any taxes, without paying taxes. So that's an advantage. That is a reason. Reason one is conservation of cash. Number two, we've said it aligns the interests of the shareholders. Number three, we've seen it has tax advantages. Number four, the fourth reason why share-to-share exchange is attractive is flexibility in negotiations. There is flexibility in negotiations. Offering shares can be a flexible transaction tool, allowing companies to structure deals that meet the needs of both parties. Because using shares can help when there are disagreements on valuations. If there are any disagreements on valuations of both the companies, the disagreements can be resolved when financing using share-to-share exchange method. You understand? That it allows for flexibility in negotiations because the target company shareholders are not being paid off and they go away. No, they still become part of the new entity. they become part of the shareholders, the owners of the acquiring company. So it becomes very easy to negotiate or to iron out any disagreement that may arise during valuation. Understand? There is also another reason. It maintains financial stability. Financial stability is maintained. You understand? Share for share exchange prevent the acquiring company from having to take on large amounts of debt. So these are the advantages. These are the reasons why share to share exchange is preferred or may be preferred. But does that not mean that this method does not have disadvantages? There are also some disadvantages that are associated with or challenges that are associated with the method. So what are the disadvantages? Now the first challenge of share to share exchange method is dilution of ownership. Dilution. It's obvious. Dilution of ownership. Issuing new shares dilutes the ownership stake of the acquiring company's existing shareholders. That is obvious. There could also be valuation challenges. 2, valuation challenges. Valuation challenges. Determining a fair exchange ratio can be complex and contentious because it requires accurate valuations of both companies. And there could also be fluctuations in stock prices which can further complicate the process. Market volatility is another disadvantage. Market volatility. The value of the shares received by the target company's shareholders can fluctuate, which creates uncertainty and potential losses. Complexity. Is a challenge. How is complexity a challenge? Share for share exchange can be a complex transaction which requires careful legal and financial planning. There is dependence again on stock performance. E, dependence on stock performance. Dependence on stock performance. The value of the deal is tied to the performance of the acquiring company's stock. And if the stock performs poorly, then the deal becomes less valuable to the shareholders of the target company. So candidates, that's all we can say about the share to share exchange. We've highlighted the features, the advantages, and the disadvantages. Let's move on to the fourth or the third method. The third method, that is C. Share debenture exchange. Share debenture exchange is yet another method that can be used in financing mergers and acquisitions. Now, a share debenture exchange refers to a financial transaction often occurring during mergers and acquisitions where a company offers a combination of its own shares and debentures to the existing shareholders of another company. And at this stage in your professional journey, I know you have you fully grasp the meaning of a share. Shares we know represent ownership in a company. When you hold shares, you own a portion of that company. So shareholders may receive dividends, which is a portion of the company's profits, and may have voting rights. That is the meaning of share. A debenture, on the other hand, these are debt instruments. They are essentially loans that are issued by a company. And debenture holders are creditors and not owners, like the shareholders. They are not owners, they are creditors to the company. And they receive fixed interest payments. Debentures, something to note again here, are essentially unsecured. They are typically unsecured, meaning that they are not backed by specific assets. And therefore, a share debenture exchange involves providing the target company shareholders with a mix of ownership and debt in acquiring the company. In the acquiring company, that is. So the existing shareholders of the target, after the deal, they are given a mix of ownership and debt in the existing acquiring company. You understand? The share debenture exchange, I repeat, involves providing target company shareholders with a mix of ownership, which is represented by shares, and debt, which is represented by debentures in the acquiring company. And these strategy candidates can be particularly useful in mergers and transactions because it offers a blend of potential for capital appreciation through shares and stable income stream through debentures. You understand? By having a mix of shares and debentures in the acquiring company, the shareholders of the target company can enjoy the benefits that come with capital appreciation, but they also enjoy some level of fixed interest payments because of the debentures. So the question we need to ask, why companies use this method? We know companies use share debenture exchange for various strategic reasons. And one main reason is to offer a more appealing and flexible deal structure. So one reason or advantage is to attract a wide range of investors. Attract wide range of investors. To attract a large or wide range of investors. This method appeals to investors with varying risk appetites, because we've seen that debentures offer a stable income stream through interest payments, while shares provide the potential for capital appreciation. So you may have investors who are looking for both capital appreciation and the potential for the fixed interest payments. Flexible financing. It It is a flexible financing method. There is flexibility. The share debenture exchange allows for a greater flexibility in structuring the mergers and acquisition transaction, because companies can tailor the mix of shares and debentures to meet the specific needs of the target company's shareholders. 3, there is a reason in relation to the lowering of interest costs, lowering interest costs. Often candidates, the debentures offered are convertible. The debentures that are offered to the shareholders of the target company are convertible debentures, meaning that after some time, the debentures are converted into shares. They can be exchanged for shares at a later date. That's the meaning of convertible debenture. The debentures that are mostly used in these transactions are convertible debentures. And this conversion feature can make debentures more attractive to investors, which allows the acquiring company lower interest rates. Deferred equity dilution. Deferred equity dilution. Deferred equity dilution. What does that mean? Now, the equity dilution from issuing new shares occurs only upon conversion of the debentures. So if debentures are converted after 10 years into shares, then the dilution is deferred. Dilution can only happen after 10 years. That's an advantage. Deferred equity dilution. And that allows the acquiring company to manage the dilution over time. Next, bridging valuation gap. Another reason why this method is attractive is the aspect of bridging valuation gap. Bridging valuation gaps. In situations where, for example, there is a disagreement there could be a disagreement on the valuation of the target company. But you see, this method is offering a mix of shares and debentures which can serve as a compromise. Number 6 is provides income and growth potential. Provides income and growth potential. This method provides income and growth potential. Income and growth potential. And it's more appealing to investors. So this aspect provides income via the debentures and growth potential via the shares or the conversion of the debentures into shares. So a share to debenture exchange comes with the advantages. 1, attracts wide range of investors. Number 2 is flexible financing. Number 4 is lowers interest costs. There is the deferred equity dilution. It bridges valuation gaps. It also provides income and growth potential. There is potential for income through the debenture interest payments and potential for growth through the shares that are offered to the shareholders of the target company. All right. Now let's move on to the last method, which is the share preference. The share preference. The share preference share exchange. share preference share exchange. The share, this is the ordinary share, this is the preference share. The share preference share exchange. The share preference share exchange. Now, share preference share exchange in the context of mergers and acquisitions. In the context of mergers and acquisition, the share preference share exchange, what does that mean? What does it mean? Or what does it involve? This one currently involves offering preference shares of the acquiring company to the shareholders of the target company in exchange of their existing shares. So the acquiring company offers its preference shares to the target company shareholders in exchange for their common shares in the target company. And this exchange provides the target company shareholders with a more stable and predictable income stream, because we know preference shares the preference shareholders are paid fixed dividends. All right? And if the preference shares are convertible, there is also the ability to convert the preference shares at a later date into common shares of the acquiring company. And there are very many reasons why companies also prefer preference share exchange. Companies use the share preference share exchange in mergers and acquisitions for various strategic reasons. And the main reason is to appeal to specific investor preferences, and to achieve certain financial objectives. One reason is to attract conservative investors. One reason is to attract conservative investors. Now, preference shares offer a fixed dividend, providing a predictable income stream, and this is attractive to investors who prioritize stability over high growth potential, such as retirees or risk-averse individuals. It may also reduce risk. Preference shares have a higher claim. The preference shareholders have a higher claim on dividends and assets in liquidation than common shareholders. So reduces risk. To reduce risk to the investors of the target company. It may also facilitate M&A deal or transaction. Understand? Offering preference shares can make the M&A transaction more appealing to target company shareholders who are maybe hesitant about the volatility of the common stock, or who desire a more stable income. There's the aspect again of bridging valuation gaps. Bridging valuation gaps, which I explained earlier. This method can help bridge valuation gaps. Right? Bridging valuation gaps. Another point is related to capital restructuring. Capital restructuring. This method can be very essential in capital restructuring. Adjusting capital structure. A company may use share preference share exchange to adjust its capital structure, potentially reducing the number of outstanding common shares or even altering its dividend obligations. There could also be tax considerations, as explained earlier. Tax considerations. Depending on the jurisdiction, there may be tax advantages associated with the preference shares that make them attractive to certain M&A scenarios. So there are many reasons, candidates, why preference share exchange may be preferred in mergers and acquisitions. So in this lesson, we've discussed the 4 methods. One is outright purchase using cash. These are methods in financing mergers and acquisitions. The second one is share to share exchange. The third one is share debenture exchange. And lastly, we've discussed share preference share exchange. Thank you for attending the lesson. We continue to learn more about mergers and acquisition in our next session. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when we talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such a subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, shareholding in the subsidiary company, subsidiary company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in a subsidiary company. Now generally the disposal of interest can be broadly classified into 2 main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore here we can talk of types of disposal of interest, So when we say there are 2 types of this, we say disposal of interest can either be, number 1, we have the full disposal, and then we have the partial disposal. Disposal. But in accordance with the International Financial Reporting Standard number 3, a disposal of interest basically occurs when the parent company loses control. So mean that once the parent company sells some of the shares which are held in a subsidiary company, and the parent company now loses control. So mean that the shares which will be held by the parent company in the subsidiary falls below 51%. So actually from 50% to 0. That is the time the disposal is deemed to have occurred in accordance with IFRS 3, in which case then the parent company is required to determine something called the gain or loss on disposal. So therefore the gain or loss on disposal basically is determined when the parent company loses control. So therefore you can say according to IFRS 3, according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest occurs when the parent company loses control. When the parent company loses control. The parent company loses what? Loses control. So basically what that means is that the shares now which are retained by the parent company, the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. Less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important, therefore, to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited, which held 80% of the ordinary shares issued by B, the parent company we can be told like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company in the investee company lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore you can say when disposal of interest occurs, that is when the parent company loses control, control, a gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what referred as the fair value of purchase consideration received. To this we add the fair value of investment which has been retained. when talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% shareholding in B, which is a subsidiary, if, for example, the parent company sells, like half of these shares, sells 40% of the shares held here, it means that the parent company has retained a shareholding which is equal to 40%. So at the date the disposal took place, the remaining investment will have to be revalued at its fair value, and always that figure will be provided to you. That's what we refer to as the fair value of the investment retained. So after adding those two figures, we come here and we less, number one, the fair value of net assets, fair value of net assets held at date of disposal, at date of disposal. So the fair value of the net asset held at the date of disposal, and then to this we also add the parent company and impaired goodwill. The parent company and impaired goodwill, and after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain, but if a negative figure, this is a loss on disposal, a loss on disposal. Yes, so this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case we compute the gain or loss on what? The gain or loss on disposal. So then next we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares in a subsidiary. So a wholesale of shares in a subsidiary company, and this one is basically governed by. This one is governed by IFRS 5. So basically, in terms of how the parent company should treat that particular subsidiary which has been free disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. Assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized on those two items, the gain or loss on disposal of interest, the gain, not the gain rather, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity or basically company should determine, or in other terms determine number one, the gain or loss on disposal, the gain or loss on disposal of interest, and number two, the profit or loss from discontinued operation. From, we can abbreviate this as DO, from discontinued operation. And you are saying that these two items, that is the gain or loss on disposal and the profit or loss from discontinued operation, they should be recognized. This should be recognized as separate line items in consolidated statement of profit or loss. Should be recognized as separate line items in the consolidated statement of profit or loss. Let's maybe from our group structure here, we introduce another company here, that is C Limited. We also assume that the parent company had a shareholding of 75%. So, and also we are told that the parent company, that is A, had 80% shareholding in B Limited, but you are told during the current financial year, the parent company sold all the shares held in B. So we have said B is a discontinued operation. So therefore, when A Limited is preparing the consolidated income statement, the consolidated income statement or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what? The profit or the loss from continuing operations. Continuing operations include A and C. And for the parent company to do that, basically, in this case, we take the revenue of this, that is A, plus the revenue of C. And then we also take the expenses, including the cost of sales of A plus that of C, We less that now from the revenue. We get, whatever you get here will be the profit or loss from continuing operations. Continuing operations. And then we are saying that these two items here should be added to the profit or loss from the continuing operations. So then we have the discontinued operations. Discontinued operation, basically you have said is this subsidiary which has been disposed. So two items will be included here. The gain or loss on disposal of interest. And you have to recall that this one is computed using that particular approach there, or that particular format there. And then we also have the profit or loss from discontinued operation. So how do we determine this a profit or loss from discontinued operation? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B, which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add. If it's a loss, we do what? We less here. We less. And then we add that now to the profit or loss from the continuing operations. And then we get the profit for the year. The profit for the year. So that's basically how we deal with what you refer as a full disposal. A full disposal. And basically, remember, these applies in preparation of a consolidated statement of profit or loss. Consolidated statement of profit or loss. So basically, when now preparing the consolidated statement of financial position, at the end of the year, the parent company will have fully disposed its shares in this subsidiary. So the parent company will not be having any control. Equally, there will be no NCI. So therefore, we can say that when preparing this consolidated statement of financial position, we can say there will be no NCI, or basically we can say assets and liabilities of subsidiary fully disposed are not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of there. That's basically how we deal with what you refer as a full disposal. Then from there we have the other type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one, or number A, we have what we refer as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company here retained 60%. So therefore, you can see B Limited still remain a subsidiary. So when it comes to preparing a consolidated income statement, what you do, you take the revenue and expenses of that subsidiary, you add to that of the parent. Actually, that disposal do not have any effect as far as the preparation of the consolidated statement of profit or loss is concerned. On the other hand, when preparing the consolidated statement of financial position, because this company is still a subsidiary at the end of the year, you take its assets and liabilities, you add to those of the parent. Actually, this particular type of partial disposal do not have any effect as far as the preparation of the group account is concerned. It's also important to note that here, because the parent company is not losing control, no gain or loss on disposal of interest is computed. This one is not computed because you have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. on disposal of interest. Disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B, is a disposal which makes a company which was initially a subsidiary to be an associate or a joint arrangement. A joint arrangement. So first of all, you have to recall from what you have discussed in our previous sessions that investment in associate, investment in joint arrangement should be accounted for in the same way using the equity method. That is something, first of all, you have to recall, and that's why you can see here we are talking of associate or the joint arrangement at one point. So this whereby we assume that the current financial year was ending on 31st of December 2023. That is the date of consolidation when the group accounts are supposed to be prepared, meaning that the year started on 1st of January 2023. We may be told that the parent company initially had acquired like 80% of the shares, 80% of the shares, like maybe A Limited had initially acquired 80% shareholding in B Limited some time back, but during the current financial year, maybe on 1st of July 2023, the parent company sold or disposed 40% or half of these shares. So mean that the parent company sold 40, and that means that the parent company then retained 40%. Retained 40%. So if it retained 40%, then it means that this company, which was initially a subsidiary, then becomes what? An associate. Becomes an associate. And therefore, in the first 6 months, the parent company, you can see, had 80% shareholding, meaning that this company was therefore a subsidiary. And then after selling half, the parent company retained 40%, meaning that in the last 6 months, that company was what? Was an associate. Was an associate. So how do we go about in this case, or how do we prepare the group account in such type of a partial disposal? Number one, when preparing the consolidated statement of a profit or loss, in preparing the consolidated statement of profit or loss, number one, we have to compute the gain or loss on disposal. We have to compute the gain or loss on disposal of interest, of which this particular gain, if it's a gain, it is recognized as an in the income statement as an income. If it is a loss, it is recognized as an expense. Number two, we then consolidate the results. The results of the subsidiary company up to date of disposal. Up to date of disposal. Up to date of disposal. Like in this case, in preparing the consolidated income statement, we're going to take into account the revenue and expenses of B for the first 6 months when it was a subsidiary. And then in the last 6 months, because it was an associate, you have to recall that we don't include the revenue and expenses of associate in the consolidated income statement. So that's why we are saying consolidate it results up to the date of disposal, and thereafter include group share of its profit after tax, and that is in accordance with equity method. That is in accordance with IS 28, because as far as the associate is concerned, we include, or what we include in the consolidated income statement is the group share or the parent company share of its profit after tax. So mean that you'll take the profit after tax of this company here, which is always given in its income statement. Multiply that with 6 all over 12 so that you get now the profit after tax for the last 6 months when it was an associate, and then multiply that with the parent company shareholding in B, which is 40%. 40%. So that's basically how we prepare that. And then how do we prepare the consolidated statement of financial position? Consolidated statement of financial position. So in preparing the consolidated statement of financial position, our interest is basically the status of this company at the end of the year. So what will be the status of the investee company at the end of the year? At the end of the year, the investee company, that is B, will be an associate, and therefore in accordance with the equity method, what we include in the consolidated statement of financial position as far as the associate is concerned is something called the investment in associate. We don't include or we don't combine the asset and liabilities of the parent, those of the associate, in preparing the consolidated statement of financial position. So therefore, in preparing this, we say compute the investment in associate, investment in associate or joint arrangement, and included in consolidated statement of financial position as a non-current asset. So in that case, we compute something called the investment in associate or investment in joint arrangement, and we include that in the consolidated statement of financial position as a non-current asset. So how do we compute this particular investment in associate or joint arrangement? So investment in associate or joint arrangement. So this one is computed using this approach here, or this format. So number one, we take the fair value of investment which has been retained. Fair value of investment retained. So the investment which has been retained here is 40%, and basically we have said that in case of a partial disposal, the investment which has been retained always will have to be revalued to its fair value on the date of disposal. That figure will always be provided to you. So you'll be told that the investment which has been retained on the date of disposal had this fair value. That's what you use here, and then to this we add the group share of post-acquisition net assets. Post-acquisition net assets, and whatever you get here is now what you refer to as the investment in associate, investment in joint arrangement, and you're saying that that should be taken to the consolidated statement of financial position as one of the item of the non-current asset. Yes. So basically those are different scenarios of partial disposal, and basically how we deal with them specifically in preparing the consolidated financial statement. So basically that's what you need to know. I want us to stop at that particular point. Once we come back in our next session, I want us to look on an illustration question regarding how to prepare the group accounts, and also how to compute the gain or loss on disposal in case of disposal of interest. So see you in the next session.
Hi candidates, and welcome to our today's learning session. The subject is Advanced Auditing and Assurance. We proceed from where we stopped in our last session. Today we are going to study the International Standards on Auditing number 200 and number 210 as they relate to audit of banks. ISA 200 and ISA 210. The ISA 200 is about objective and general principles governing an audit of financial statements, whereas 210 is about the terms of audit engagements. So let's first look at the ISA 200, objective and general principles governing an audit of financial statements. This standard states that the objective of an audit of financial statements is to enable the auditor to express an opinion whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. The objective of the audit of a bank's financial statements, therefore, should be conducted in accordance with the international standards on auditing. And it is to enable the auditor to express an opinion on the bank's financial statements, which are prepared in accordance with the applicable financial reporting framework. Therefore, candidates, the auditor's report indicates the financial reporting framework that has been used to prepare the bank's financial statements, including identifying the country of origin of the financial reporting framework when the framework is used, or when the framework is not used, or when the framework used is not, international accounting standards. So when reporting on financial statements of a bank prepared specifically for use in a country other than that under whose rules it is established, the auditor considers whether the financial statements contain appropriate disclosures about the financial reporting framework used. That is the provisions of the International Standards on Auditing number 200. All right. Objective and general principles governing an audit of financial statements. I've said that the objective of an audit of financial statements, here we are talking of general statements of all the types of businesses, including banks. The objective is for an auditor to enable an auditor to express an opinion whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. How about ISA 210, which is in relation to terms of audit engagement? ISA 210, terms of audit engagement. Terms of audit engagements. Terms of audit engagements. Candidates, the engagement letter documents and confirms the auditor's acceptance of the appointment. All right, that's number one. The point is that the engagement letter does what? Documents and confirms the auditor's acceptance of the appointment. The letter also documents the objective and the scope of the audit, number two, Number 3, the letter documents the extent of the auditor's responsibility to the client and the form of any reports. Therefore, candidates, in considering the objective and the scope of the audit and the extent of the responsibilities, the auditor considers his own skills and competence and those of his assistants to conduct the engagement. And in doing so, the auditor considers certain factors, such as 1, the use and source of specialized accounting principles with particular reference to number 1, any requirements contained in the law or regulations applicable to banks. Number 2, pronouncements of the banking supervisory and other regulatory authorities. 3, pronouncements of relevant professional accounting bodies. For example, the International Accounting Standards Board. 4, the pronouncements of the Basel Committee on Banking Supervision. And finally, number 5, industry practice. So when issuing an engagement letter, apart from the provisions of ISA 210 on terms of audit engagements, there are other factors that the auditor needs to put into consideration. So I've mentioned one of the factors, and this is the use and the source of specialized accounting principles with the particular reference to the 5 aspects that I've mentioned. Then number 2 is the contents. The auditor should consider the contents and the form of the auditor's report on the financial statements and any special purpose reports required from the auditor in addition to the report on the financial statements. And this includes whether such reports refer to the application of regulatory or other special purpose accounting principles or describe procedures undertaken especially to meet regulatory requirements. Then number 3, the nature and any special communication requirements or protocols that may exist between the auditor and the banking supervisory or other regulatory authorities like the central bank. Then number 4, we have the access that bank supervisors will be granted to the auditor's working papers when such access is required by the law, and the bank's advance consent to the access. So those are some of the factors that the bank auditor should consider when issuing an audit engagement letter. And that effectively brings to conclusion of our today's lesson, where we've considered 2 aspects, that is the ISA 200 and ISA 210, the terms of audit engagements. In our next session, we'll commence our study on the audit plan of a bank, audit planning when carrying out the audit of a bank. Thank you and God bless you. Hello candidates and welcome to the Advanced Auditing and Assurance Learning session. The subtopic is Audit of Banks. To remind you, the general objective of the Advanced Auditing and Assurance paper is to enable the candidates to gain knowledge and skills to undertake advanced audit and assurance engagements in compliance with regulatory frameworks and international auditing standards. The subtopic Audit of Banks candidates. By the end of this study on the audit of banks, it is expected that you will gain knowledge and skills to enable you to undertake audit and assurance engagements which are in line or in compliance with the regulatory frameworks and international auditing standards. In the study of audit of banks candidates, we will study audit objectives, the terms of engagement, planning the audit of a bank, the internal controls. On internal controls, we will consider the policy paper that was issued by the Basel Committee on Banking Supervision, dubbed Framework for Internal Control Systems in Banking Organizations. Then we will also study the substantive procedures that are required in the audit of banks, then the audit report on the financial statements of banks. So candidates, welcome to the session, Audit of Banks. I just stated that in auditing of financial statements, the auditor should pay attention to the regulatory frameworks and international auditing standards. That is regulatory frameworks and international standards on auditing. The Banking Act of 2015, Section 24, requires that every institution to appoint annually an auditor who is qualified and approved by the central bank, whose duty is to audit and make a report upon the annual balance sheet and the profit and loss account, which are to be submitted to the central bank. That is Section 24 of the Banking Act. Section 24. Section 24 of the Banking Act of 2015. Now, Section 25 of the same Act talks about change of auditors, and such changes of auditors of a bank should be notified to the central bank. And Section 26 of the Banking Act is about auditors' duty of confidence. Auditors' duty of confidence. Now, the audit of banks is governed by the International Auditing practice statement number 1006. This statement is about the audit of financial statements of banks. Financial statements of banks. And the purpose of this statement is to provide practical assistance to auditors and to promote good practice in applying international standards on auditing of the financial statements of banks. Learners, it should also be noted that this statement is not intended to be an exhaustive listing of the procedures and practices to be used in such an audit. And therefore, in conducting an audit in accordance with ISAs, the auditors comply with all the requirements of all the international standards on auditing. But we all know that banks commonly undertake a wide range of activities. However, most banks continue to have in common some basic activities of deposit taking, borrowing, lending, settlement, trading, and treasury operations, and so on. So this statement, the primary purpose for this statement is the provision of guidance on the audit implications of such activities. I've mentioned the activities like borrowing, lending, settlement, trading, treasury operations, and so on. So before we get into the audit of banks, I think it's important for us to highlight some of the basic characteristics that generally distinguish banks from other commercial enterprises. Basic characteristics of banks. Basic characteristics of banks. Number one is that banks have custody of large amounts of monetary items. Custody of large amounts of monetary items. Large amounts of monetary items, including cash, including negotiable instruments, whose physical security has to be safeguarded during transfer and while being stored. They also have custody and control of negotiable instruments and other assets that are readily transferable in electronic form. So candidates, the liquidity characteristics of these items make banks vulnerable to misappropriation and fraud. Banks therefore need to establish formal operational or operating procedures that are well defined that have well defined limits for individual discretion and rigorous systems of internal controls. So that is one basic characteristic of banking institutions that distinguish banks from other commercial enterprises, large amounts of monetary items. Then number two is that banks often engage in transactions that are initiated in one jurisdiction and managed yet in another jurisdiction. Transaction is initiated, for example, in one continent, and then the management of that transaction is done in another continent. Number three, banks operate with a very high leverage. Very high leverage. That means that the ratio of capital to total assets is low. And this increases banks' vulnerability to adverse economic trends and increases the risk of failure. High what? Leverage. They operate with very high leverage, meaning that the ratio of capital to total assets is low. Then another characteristic is that banks have assets that rapidly change. Assets that rapidly change in value and whose value is often difficult to determine. Consequentially, a relatively small decrease in asset values may have a significant effect on their capital and potentially on their regulatory solvency. Another property is that banks generally derive a significant amount of their funding from short-term deposits, and these deposits may be insured or uninsured. Therefore, a loss of confidence by depositors in a bank's solvency may quickly result in liquidity crisis. May do what? May result in liquidity crisis. Liquidity crisis. Another feature is that banks have fiduciary duties, and these fiduciary duties are in respect of the assets they hold that belong to other persons. And these fiduciary duties may give rise to liabilities for breach of trust. So they therefore need to establish operating procedures, internal controls designed to ensure that they deal with such assets only in accordance with the terms on which the assets were transferred to the bank. Next point is that banks engage in a large volume and variety of transactions whose value may be significant, and this ordinarily requires complex accounting and internal control systems and widespread use of information technology. Another characteristic is that banks ordinarily operate through networks of branches and departments that are geographically located or geographically dispersed. This necessarily involves a greater decentralization of authority and dispersal of accounting and control functions, with consequential difficulties in maintaining uniform operating practices and accounting systems, particularly when the branch network transcends national boundaries. Next characteristic is in relation to transactions which often may be directly initiated and completed by the customer without any intervention of the bank's employees. For example, transactions that are carried out over the internet or through the automatic teller machines and so on. So these are some of the basic characteristics of banks that distinguish banks from other commercial enterprises. Now, learners, that will mark the end of our today's learning session, where we've introduced the subtopic audit of banks. And in this session, we've learned that an auditor should have knowledge and skills to undertake the audit and assurance engagements that are in line with regulatory frameworks and international standards on auditing. In this lesson, we also learned that the audit of banks is regulated or guided, or we can say auditors seek guidance, get guidance from the International Auditing Practice Statement number 1006. This statement is about the audit of financial statements of banks. In the lesson, we've gone ahead to identify some of the basic characteristics of banks. These characteristics are common to banks, and the characteristics distinguish the banks from other commercial enterprises. In our next session, we will study audit objectives of banks and terms of engagement. Thank you, and God bless you. Welcome once again to the lesson. We are going to proceed with the topic on mergers and acquisitions. Today our focus is on post-merger and acquisition, that is financial evaluation. Post-merger means after the companies have merged. In our last session, we were calculating the value of a company, the value of a target, the company that is to be acquired. Before the acquirer, before the acquiring company purchases a company, it may be necessary to determine the value of the target. The target company is the one that is being acquired. So that's what we did in our last session. So here we want to do what we call financial evaluation. What is the value of the, for example, the earnings per share after the merger or acquisition? That's why we are calling it post-merger acquisition. Financial evaluation post-merger stock acquisition. So financial evaluation, or let me say post-merger acquisition financial evaluation. Post-merger stock acquisition financial evaluation is a critical process to assess the success of a merger or acquisition. Evaluation is necessary, candidates, so that the company that is acquiring another, or where companies are merging, to determine whether that strategy, determine whether that decision was a success or not. This evaluation is a process that helps to assess the success of a merger or an acquisition, and it involves analyzing various financial metrics to determine whether the deal was good or not, to determine whether the deal has created value for the combined company. This evaluation is important to determine whether the deal was good for the shareholders. And there are two key financial metrics which the syllabus has highlighted. Just two, candidates, two key financial metrics that we use to evaluate companies after acquisition or merger. The first one is earnings per share. Earnings per share, EPS, post-merger. EPS. Now, the EPS measures the profitability of a company per share. The profitability of a company per share. And a post-merger increase in EPS, a post-merger increase in EPS, a post-merger increase in EPS generally indicates a successful deal. If there is an increase in EPS, increase means you are comparing the EPS before the merger and EPS after the merger. If the EPS of the merger is higher than the EPS before the merger, then we say that that was a successful deal, because at the end of the day, that's what people are looking for. Shareholders are looking for increase in earnings per share. So that's one financial metrics that we use in financial evaluation of mergers and acquisitions. The second obvious financial metric is a market price per share. Market price per share, the MPS. MPS, market price per share. The market price per share, the price of the share is fetching in the market after the merger. The market's valuation of the combined company's shares is what we are referring to as the market price per share, combined. So an increase in MPS suggests that the market views the merger or acquisition positively. Because how is this price determined? How do we determine the MPS? The MPS is a market price. How are prices determined in the market? The prices are determined in the market based on the forces of demand and supply. So if there is an increase in the price, that means that there are many individuals or institutions that would want to buy the share. The demand is high. If the demand is high, then ultimately that leads to a higher MPS, and that is a signal that the merger or acquisition was a success. You understand? So the syllabus is limiting us just to these two. These are not the only financial metrics. There are more financial metrics. Maybe some of you will have interest in maybe investments and financial analysis course, we will have an opportunity of studying other financial metrics. But you know, in CPA we are just doing basics. These are basics. All right, these are just basics. The word advanced does not mean complicated, just continuation. There are times when students they kind of misinterpret this word. This word advanced is derived from the word advance, to continue. You are continuing. It's not, does not mean complicated. That's why you see we are just studying earnings per share. The formula is what we learned in intermediate level. The market price per share, these are things we covered. And as we are getting to the illustrative examples, you'll discover that there's nothing complex. It's just what we've been doing. There's nothing new under the sun. So let's look at the illustration. Let's illustrate. The illustration, that illustration is just as simple as it may look. That is a past paper question. That's the question. APCO Limited is considering to acquire Alpha Limited. The following are the financial data for the two companies. You have the data for net sales, profit after tax, number of outstanding ordinary shares, the EPS, the DPS, and market capitalization. So firstly, we are to determine the pre-merger market value per share for both companies. Illustration. Pre-merger MPS. Pre-merger MPS. Pre-merger MPS. We have APCO. APCO is the target. What is the MPS for APCO? What is the formula for MPS? Formula for MPS. Market value per share. We just take the total market capitalization divided by the number of outstanding ordinary shares. It's total market capitalization divide number of outstanding shares. It's direct there from the question. APCO 420,000 market capitalization, number of shares outstanding 7,500. For the other company's name is Alpha. The market capitalization is 45,000 shillings. Number of shares 1,500. Give me the values. 56 MPS 56 shillings. Alpha 30 shillings. Janice says 30 shillings. Roman 2, we are to calculate post-merger EPS, MPS, and PE. Post-merger EPS. Post-merger EPS. Post-merger EPS. What is the formula? The formula will be the combined earnings. What is the word used in the question? Combined after-tax profit. After-tax profit. We divide with the combined number of shares. Post merger we combine. So combined after tax profit 18,130 plus 3750. 3750. That is the combined after tax profit. We divide with the combined number of shares. Combined number of shares just 7,500. This 7,500. We need a working. We need to have a working for this number of shares. You recall, candidates, that APCO Limited is considering to acquire Alpha Limited. Post-merger, we do not have shares for Alpha. Post-merger, the shares of the target do not exist. The shares of the target do not exist after merging. We need to know the shareholders of this target Alpha will be provided how many shares of the acquirer. And it's not possible to know these 1,500 shares. These are outstanding ordinary shares of the target. 1,500 shares. What is the conversion ratio? The conversion ratio is not provided in the question. Where conversion ratio is not provided, then we are going to use the maximum exchange ratio. We are going to use the maximum exchange ratio. Maximum exchange ratio. Maximum exchange ratio. And we are going to use the price payable. Okay, we are going to use this price payable. But first of all, what is the maximum exchange ratio? Now, maximum exchange ratio, candidates, is the maximum. It is the highest. Let me use the word highest instead of using maximum again. Maximum exchange ratio is the highest number of shares of the acquiring company, the highest number of shares of the acquiring company that it is willing to offer for each share of the target. 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 The highest number of shares that the acquiring firm is willing to pay to the target shareholders. Do you understand? Is that clear? Maximum exchange ratio is the highest number of shares of the acquiring company that it is willing to offer for each share of the target company. All right? And it's equal to the price payable over MPS of the acquiring firm. So the price payable for this 1,500 shares is 30 shillings. That is the price payable. the market price is 30 shillings. It's 30 shillings, the price payable. That share is fetching 30 shillings in the market. Then we divide by the MPS, the market price of the acquiring firm. We get the maximum exchange ratio. And we have it here, 56 shillings. So please take a screenshot. Take a screenshot, use your eyes, take a screenshot. Maximum exchange ratio is equal to the MPS of the target divided by the MPS of the predator. The predator is the acquiring firm. Give me the ratio, 0.54. 0.54. 0.54. That is the maximum exchange ratio. Maximum exchange ratio is 0.54. What does that mean? As the highest number of shares of the acquiring firm that is willing to offer for each share of the target. So for each share of the target, one share of the target, the predator is willing to offer 0.54 shares. Therefore, these 1,500 shares of the target, for each share of the target, let me write it. Each share of the target, each share of the target, the predator is willing to pay 0 or to give. It's not paying but giving, but it's also paying because it's acquiring and buying. That exchange, the exchange ratio is 0.54. Therefore, 1,500 shares of the target will be equal to 1,500 over 1, this one, times 0.54. How much is it? 810. Yes, this is 810 shares. These are additional shares after the merger. But we have the original shareholders. These are shares offered to the target company. But we have the original shareholders holding how many shares? This is it 7,500? This one. Then we add these new shares, the shareholders who are coming in, 810. So that's how you calculate the combined number of shares. The original shareholders of the target of the acquiring company plus these new shareholders who've just come in from Alpha. So that then will give us the post-merger EPS. How much is it? 2.63. That is the after merger EPS. 2.63 shillings. Earnings per share after merger. So you have to calculate the pre-merger market price. Number 2, the post-merger. Then number 3, we are to do the MPS, post-merger MPS. Post-merger MPS. The formula does not change. It's total market capitalization over number of shares. Total market capitalization of a combined number of shares. Total market capitalization. So what is the total market capitalization? This was for one company. So it is 420 plus the 45 shillings. Combined shares post merger 7,500 plus 810. Post merger MPS. How much is it? 55.96. 59.56. That is the post merger MPS. You can see for APCO, pre-merger MPS is 56, post-merger 59. That tells you that the merger would be a success because the MPS has gone up. We say that an increase in MPS suggests that the market views the merger or acquisition positively. So if investors heard that these two companies are merging, so they are, if it increases, then that tells you that they view it positive. But if it reduces, then it means that the investors have a different sentiment, a negative sentiment. Post-merger MPS. Then number 4. Before number 4, what is the? We are also to do the PE ratio. PE ratio. We know the formula is just MPS, and it is post PE ratio over EPS, and we have the MPS, post merger MPS 59.56. The EPS, we have it, post merger EPS 2.63. So what is the ratio? Ratio 21.27 times price earning. It is earning 21.27 times. The other part of the question reads, compare APCO Limited's EPS assuming Alpha Limited's shareholders are offered 100,000 shillings 5% convertible debenture for each share held in Alpha Limited. How do you go about it? The formula does not change. Earnings per share is equal to the combined profit we divide by the number of shares. So EPS, the formula does not change. So every time you are asked to compute EPS or anything else, you put down the formula. You put down the formula. What is the formula for the EPS? It is just the profit after merger, the earnings after merger. We divide by the number of shares after merger. But here the exchange, this is a share debenture exchange. The target shareholders are not given shares, but they are paid in form of debentures, and we are given the amount here, 5,000. Is it 5,000? 100,000 shillings, 5% convertible debentures. Convertible debentures means candidates at some point these debentures will be converted into shares. So then there are two variables we need here. Inputs, profit after tax. Then we'll have the answer there. So we need a working. So candidates, I urge you to adapt my approach. Anytime you have a question, just put down the formula. You may just get a mark for that formula. Then you may get this number of shares wrong, you get this one right. You may get a half a mark for that. So please pay attention. Pay attention. It's not always that questions will be direct. You never know you're sitting. It may not come direct. You may have to work out some of the inputs. The number of shares. The number of shares will be 7,500. I want you to take note of that. Number of shares after the merger will not increase because the target shareholders are not given new shares like it was the case here. You see the exchange ratio is that. Now they are not given shares. So the shareholders or the number of shares after the merger are just the shareholders of the acquirer, 7,500. Is that clear? The denominator does not change. How about the profit after tax? The profit after tax has to change. The post profit after tax has to change because of the interest factor. Do you see 100%, 5% debentures? That 5% is the coupon rate. The interest on debenture is 5%. Do you see that? So what will be the combined profit after merger? You have to adjust the combined profit after merger to take into account the interest. What is the combined profit post merger? What is the combined profit after merger? Do we have it from the question? 18,130 plus 3750. How much is it? 880. Then after the merger, there is that interest on debentures of 5% of the 100,000. That one has to be deducted, and we have to take into account the tax. Interest after tax will be 5% times 100,000 times 1 minus t, which is 0.7 after tax, times 1 minus t. How much is it? That's what we need here. 3,500. Deduct it from the combined profit post merger. That is it, 18,380. Divide by the number of shares, what is the amount? What is the EPS? Assuming that the shareholders were paid debentures, were given debentures, convertible debentures. What is the new EPS? 2.43. 2.43. EPS 2.43 shillings. Comparison. So how do you compare? Share to share exchange, the post merger EPS is 2.63. Post merger share to share exchange, this was the EPS. Post merger EPS, we calculated it here. Post merger EPS, share to share exchange EPS post merger 2.63. Share debenture exchange post merger EPS 2.45. So you see the comparison. Share to debenture exchange affects the earnings per share. The earnings per share are reduced, and we know the reason. The reason is because of the interest factor. Interest on debentures. So post-merger EPS, share to share exchange, EPS is higher than post-merger share debenture exchange, EPS is lower. Any question? Now, for those of you who are preparing for exams, the topic on mergers and acquisitions is one topic that can help you score marks easily. So please reinforce what we've learned today by doing the numerous questions that are available to you. We may not have time to do any other question on mergers, pre-merger EPS, post-merger EPS. The questions can vary by in many ways. Hello candidates, and welcome to the Advanced Financial Management Learning session. The topic is mergers and acquisitions. In our today's lesson, we're going to discuss the regulatory framework for mergers and acquisitions. Regulatory framework for mergers and acquisitions. And in this lesson, we're going to highlight some of the regulatory bodies and legislation govern mergers and acquisitions in Kenya. And the regulatory framework for mergers and acquisitions in Kenya is designed to ensure fair competition and also to protect the interests of various stakeholders, where companies choose to merge or when a company decides to acquire another one. That decision is likely to affect many stakeholders like the employees, the management, the shareholders, the investors, the members of the public, and so on. And therefore, it's important that these transactions are regulated. That's why we have regulatory bodies in Kenya that help in ensuring that the interests of the various stakeholders are protected. So the first regulatory body is the Competition Authority of Kenya. One, Competition Authority of Kenya. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisition activities in Kenya. And the mandate of the CAK is derived from the Competition Act. It is derived from the Competition Act. This is an act of parliament that stipulates that there ought to be a Competition Authority of Kenya, which has been put in place since the year 2010. It is the principal legislation governing mergers and acquisitions, right? The Competition Authority of Kenya. It is the principal governing body. And the role of the Competition Authority of Kenya is to prevent anti-competitive practices that may arise from mergers and acquisitions. Do you understand? That is the primary role of the CAK. Is to do what? Is to prevent anti-competitive practices that may arise during these transactions, the mergers and acquisition. The second body is the Market Authority. Capital Market Authority, CMA. CMA, the Capital Market Authority, regulates mergers and acquisitions involving companies that are listed on the Securities Exchange, companies that are listed on the Nairobi Securities Exchange. So if the companies that are listed on the Nairobi Securities Exchange choose to merge or to acquire or to take over other companies, the Capital Market Authority has to be involved. The CMA has developed regulations, what we call takeovers and mergers. That is Capital Market takeovers and mergers regulations. These are regulations that guide the acquisitions and mergers involving companies that are listed on the Nairobi Securities Exchange. You understand? These regulations provide the framework for such activities. And the CMA ensures that there is transparency. The CMA also protects investor interests and so on, particularly the interests of the companies that are listed on the Nairobi Securities Exchange. You understand? So the Capital Market Authority, through the takeovers and mergers regulations, ensures that there is transparency, ensures that the interests of the public, the interests of the various stakeholders are protected. So this is the second body, the Capital Market Authority. The third body is the Central Bank of Kenya. The Central Bank of Kenya, regulates mergers and acquisitions in the banking and the financial services sector. Banking and financial services sector. Mergers and acquisitions that occur in the banking and financial services sector are regulated by the Central Bank of Kenya. And the Banking Act also requires that financial institutions should obtain the central bank approval for mergers and acquisitions. So we have again here the Banking Act as another piece of legislation that guide mergers and acquisitions in the banking and financial services sector. So the companies that operate in the banking and financial services sector that would wish to merge or to engage in acquisition activities, they must seek approval from the Central Bank of Kenya. The Central Bank of Kenya. Number 4, we are currently discussing the various bodies that regulate mergers and acquisitions. And the third one here is the Communications Authority of Kenya. Communications Authority of Kenya. Communications Authority of Kenya regulates mergers and acquisitions of companies within the communication sector. Within the communication sector. The fifth body is the Insurance Regulatory Authority. Insurance Regulatory Authority. Insurance Regulatory Authority, the IRA, regulates mergers and acquisitions of companies within the insurance sector. I can go on and mention such bodies and mention other acts of parliament like the Companies Act, the Companies Act, the Companies Act of 2015 provides the general regulations. They provide what we call general regulations for companies within Kenya, and it impacts how mergers and acquisitions are carried out. How mergers and acquisitions are carried out. You understand, candidates? Regulatory framework for mergers and acquisitions in Kenya. These are 5 bodies and the Companies Act. And in this lesson we've learned that the regulatory framework for mergers and acquisitions is designed to ensure fair competition. It's also designed to protect the interests of various stakeholders, like the Competition Authority of Kenya. We've said this is the principal. It is the principal body. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisitions. And we mentioned that its mandate is derived from the Competition Act, which is the principal legislation governing competition and mergers and acquisitions. We've stated here again that the Competition Authority of Kenya, the role of this authority is to prevent anti-competitive practices that may arise from mergers and acquisitions. So this is the principal body, principal legislation. This is the principal body, and the principal legislation is the Competition Act. The second body is the Capital Markets Authority. The Capital Markets Authority, we've said, regulates mergers and acquisitions of companies that are listed on the Nairobi Securities Exchange. And the Capital Markets Authority has developed regulations that are referred to as the Capital Market Takeovers and Mergers. Takeovers and mergers. Takeovers and mergers, which provide the framework for mergers and acquisition transactions. Number 3 is the Central Bank of Kenya, we've said, regulates mergers and acquisitions in the banking and financial services sector. And we've stated that the Banking Act, which is an act of parliament in Kenya, the Banking Act requires financial institutions to seek approval from the central bank. Okay? Requires that companies within the banking and financial sector seek approval from the Central Bank of Kenya before merging. The number 4, we have the Communications Authority of Kenya, which regulates mergers and acquisitions in the communication sector. We've gone ahead to identify also the Insurance Regulatory Authority of Kenya, which you've said regulates mergers and acquisitions of companies within the insurance sector. So that marks the end of the lesson, where we've discussed briefly the regulatory framework for mergers and acquisitions in Kenya. Here is today's assignment. Number 1, what are the key objectives of anti-competitive regulations in the context of mergers and acquisitions? And how do these regulations aim to protect market competition? Number 2, how do cross-border mergers and acquisitions create complexities in regulatory compliance? And what international frameworks exist to address these challenges? I repeat, how do cross-border mergers and acquisitions create complexities in regulatory compliance? Number 3, how does the regulatory framework regarding disclosure requirements impact the transparency and fairness of the mergers and acquisitions process? Thank you for attending the lesson. We'll meet in the next lesson, where we continue to share knowledge in advanced financial management. Bye-bye.
Hello class, welcome to lesson number 4 of topic number 5, share capital. So in this 4th lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items, where we are talking about by purchase of own shares, by a company, where we are asking ourselves the question, can a company purchase its own shares? Or could a company, by extension, finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, this is the rule in Trevor versus Whitworth, where the direction of the court is that a company must not purchase its own shares. A company must not purchase its own shares. Now, this is consistent with the rules that relate to the company's maintenance of its own capital. That the company's capital is the creditor's fund of last resort, and as such should be maintained. And all those matters, all those transactions of the company that go towards threatening the company's share capital, transactions such as reduction of share capital, transactions such as the company's purchasing its own share capital, all these are extremely regulated transactions by law in a bid to ensure the company's share capital remains fixed end known remains unreduced, that there are measures that have been taken to ensure that the company does not waste its own capital. Now, despite this direction that a company must not purchase its own shares, the Companies Act gives us some special exemptions under which a company may be purchasing its own shares. So these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is during a redemption of redeemable preference shares. During the redemption of redeemable preference shares. This is if allowed by the articles, and all rules relating to redemption of redeemable preference shares have been followed. Rules that we have discussed earlier, such as the shares being fully paid, the shares being redeemed either out of the proceeds of a new issue, or if no fresh issue has been issued by the company redeeming them out of reserves and creating the share redemption reserve fund. We could also have a company purchasing its own shares in case of a valid surrender of shares by a member. This is a rare case, but very much possible, particularly where a shareholder holds partly paid shares, that the shares held by this member are partly paid. The fact that they are partly paid, they present a further obligation on that member to make payments for the balance, for the unpaid part of those shares. In the case this member is unable to make these further payments, in the event that this member is not able to discharge this liability, this obligation to pay for the balance outstanding on their shares, then they can surrender such shares to the company. This surrender, in a way, is to absolve them from that liability to pay for the outstanding amounts on their shares. The other possible circumstance under law where a company would be purchasing its own shares would be following a court order for protection or for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, the court could be directing the company to purchase the interest of these minorities, which the resulting transaction would be a company purchasing its own shares. So class, in these exceptional cases, they are presenting us to a scenario where we are going against the directions given by the rule in Trevor versus Whitworth, where the direction is a company must not purchase its own shares. However, we are saying in these exceptional circumstances, we can have a company purchasing its own shares. Now, by extension, we are also saying that a company must not finance or provide a guarantee, for the purchase, of its shares, must not finance or provide a guarantee for the purchase of its own shares on the same premise that we were not to purchase our own shares for purposes of capital maintenance requirements. However, we are also finding ourselves running into exceptions to this rule, that we have exceptional circumstances where a company may finance the acquisition of its own shares. Now, these exceptions include where providing finance or guarantee is part of the ordinary business of the company. So this could be a company in the financial sector where part of their business is the provision of financial assistance, that they're in the business of giving loans. So a loan has been obtained by a customer in the normal circumstances under which normal loans would be borrowed, where such customer also proceeds on to purchase the shares of this company with the proceeds advanced by the company. Then we have a situation, an exceptional circumstance, where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, money or funds to trustees, to a trustee or trustees to acquire shares for the benefit of its employees, Now, this exception presents us with a situation where this company has set up a trust fund or has set up a trust for the benefit of the members. And this trust, part of the things it does is investments for the purposes of the members. Remember, these investments could be through the purchase of shares, securities in companies. So we are saying funds have been advanced to the trustees by this company, where the trustees invest for the purposes of the members' welfare. These trustees could proceed on to use these funds in buying the shares of this company, advancing the funds. Now that presents us with an exceptional circumstance where the company is seen advancing funds, which funds are subsequently applied in the purchase of its own shares. Then finally, we have an exception where the company has a scheme. The company has a scheme to advance funds to employees. This is with an exception of directors. Except directors to purchase shares in the company, for beneficial ownership. So company law recognizes that companies could have a scheme, an arrangement within the company that they advance funds, they advance money to the employees of the company, with an exception of directors. Directors are excluded from this fund. They are excluded from this scheme, this arrangement of advancing money to employees to purchase shares of the company for beneficial ownership. This scheme is to make the employees of the company feel part of the company, where they have been advanced money for the purposes of owning a stock in the company that they work for. So this is the idea of purchasing of own shares by the company, that it is generally prohibited in the interest of protecting the company's capital. However, we have seen ourselves running into exceptional circumstances where companies can directly purchase their own shares. We have also seen circumstances where companies are allowed by law to finance the purchase of their own shares. Let me now look at dividends. Dividends. we are describing a dividend to be a member's return. This is a member's return for their investment. A member's return for their investment in the company. A member's return for their investment in the company. It is also seen as a share of the company's profit, a share of the company's profit that is paid to the members. The share of the company's profit that is paid out to the members. Now, the Companies Act presents us with certain rules relating to the payment of dividends to members, relating to the sharing of profits or paying of this return to the members. Rules of paying dividend. Rules of paying dividend. Now, as part of this continuing story of maintaining the company's capital, one of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can only be paid. Dividend can only be paid out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is not under obligation to pay dividend to the members. But we are saying, should we be paying dividends? Dividends must always be paid out of profit. It is unlawful. It shall be wrong. It shall be against the law to pay dividends where the company is not making profits. It shall be seen as paying dividends out of capital. Now, what will be considered profits? The company has what we call the realized profit of the company. Now, from the company's realized profit, it may create some part of this realized profit as the profits available for distribution as dividend. Now, in arriving at the company's realized profit, it could be considering any gains. We talk about realized gains. Any realized gains from revaluations. Any realized gains from revaluations of assets can also be considered as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. So from the company's realized profit, the directors will designate part of the company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend is recommended. Dividend is recommended by the board. Dividend is recommended by the board of directors. Dividend is recommended by the board of directors. These are the persons charged with the day-to-day management of the company. So they are best placed to know how much this company can afford to pay as dividends. So it shall be their responsibility to recommend how much dividend is to be paid. Still relating to the payment, we are saying that dividend is approved. Dividend is approved by members. Dividend is approved by members at a general meeting. Dividend is approved by members at a general meeting. Now, this meeting could be the company's AGM, at which dividend is usually approved by the members. So the directors have recommended a dividend, then we have a meeting of members where that dividend is approved. Relating to the approval, we are noting another rule that the members cannot recommend, let me withdraw the word recommend and replace it with the word approve. The members cannot approve a dividend above the rate, cannot approve a dividend above the rate recommended, above the rate recommended by the board, above the rate recommended by the board. So the board's recommendation on what dividend is payable shall be final. That in the GM's, the general meeting's approval, they cannot approve an amount beyond that which is recommended by the board. We are also noting that the company cannot pay dividend. The company cannot pay dividend if such payment will result to inability to meet its financial obligations. A company will not pay dividends to be unable to pay its salary to employees. A company will not pay dividends to be unable to pay rentals. A company will not be paying dividends to be unable to pay such expenses as are necessary for the running of this company. Now, once a dividend has been declared, something also happens that declared dividends, let's add the approval, declared and approved dividends, shall not bear interest against the company if there is a delay, if there is a delay in payment. That the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general meeting. Now, the usual practice is that once the dividend has been declared and approved, within 42 days of such approval, the dividend should be payable. If there is any delay in payment of such dividend, the suffering members shall not claim interest against the company for delay in paying them the dividends due. The other rule still relating to payment of dividends is that the company may deduct any amounts. The company may deduct any amounts owed to it by a member from the dividend payable. That the company can deduct any amounts that they are claiming from a member from the total amount they are to pay them as dividend. For instance, imagine a case where we have borrowed some money from our company and we have been unable to pay them. We have not repaid such borrowed amounts of money. So this company has some claim against us. So this rule is empowering them to deduct such amounts that they are claiming from any dividend that is payable to us after the declaration of the dividend. Now, from these rules, we can start imagining a procedure that companies follow in the payment of dividend. What procedures do we follow when we are paying dividend as a company? We will begin from a board meeting being held to recommend a dividend. After a board meeting has been held to recommend a dividend, the company will prepare and update the company's register of members, because it is on the basis of the register that this dividend is payable. Then we shall proceed on to convene a meeting of members where this dividend payment is to be approved. So once the dividend has been approved, then we have a preparation and closure of the register of members so that we have no more additions to the register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked against the company's register of members. Then checks can be prepared and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited, including the financing of the purchase of the company's own shares. But we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies when paying dividends. I now want to send you to the revision partner questions, just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you.
Let's now talk about number E, or the 5th method of dealing with CVP, where you are uncertain, which is probability tree diagram. Probability tree diagram. So you will allow me to do away with this, your probability tree diagram. Your probability tree diagram, is where you simply draw a tree diagram, almost similar to when you're dealing with probability trees. From your mathematics, you must have done probabilities. So we'll be drawing a similar tree. And for us to be able to draw that or to illustrate that, there are certain items you must be given. One of the items that you must be given is your probability. You must be given your probability. And you must be given your variables. You must be given your probabilities and your what? Variables. Your variables here may be labor cost, maybe material cost, maybe direct expenses, variable overheads, maybe the variable cost, maybe the fixed cost, maybe the units to be produced and sold. But they must give you some variable that you're going to represent in your tree diagram so that it can help you to get a decision. For example, if they're asking you to draw a tree diagram to determine your contribution, you know your contribution is the difference between your selling price and your variable cost. So one of the items that they must provide is your selling price. The other item they must provide is your variable cost. They must also provide your what? Quantity sold. If they ask you to represent or to determine profit using probability distribution again, they will give you selling price that they must provide and the probabilities. They must also give you what? Variable cost with the probabilities, the units sold, the fixed cost. So we're saying when you're dealing with a probability tree diagram, there is some certain information you must be done what?
given that is uncertain, and that is why you're going to be drawing a what? A tree diagram. And I want us to look at an illustration on the same, on a tree diagram. And the question I want us to talk about specifically is on April 2024. Let's go to April 2024. April 2024. The question we want to tackle is question 2A. And the company name is what? Joe Mwinzi. That is the name of that company. Joe Mwinzi, the management accountant of Vera Enterprises that makes and sells products alloy, has made the following estimates. You have your sales, you have three conditions, which is the worst, the most likely, and the best. You have your probability of the sales. You also have your variable cost under the conditions that are worst, most likely, and best. You have your costs or variable cost per unit under those conditions, and you also have the probability of variable cost under those conditions. Additional information. The selling price of alloy product is 1,000 per unit. Fixed cost attributable to alloy product is 24 million. Vera Enterprises intends to achieve a target profit of 6 million. Using a probability tree, compute the expected profit of Vera Enterprises. Number 2, compute the probability that Vera Enterprises will fail to break even. Number 3, determine the probability that Vera Enterprises will not achieve the target profit. The target profit. So they're telling us to determine your expected profit using your tree what? Diagram. Remember, from the previous working, we know how do you get expected values? You simply take your variable, you multiply by your what? Probability. So even in this particular circumstance, to get our expected profit, we will take our profit, you multiply by your what? Probability. But you know, how do you determine your profit, class? Your profit, we've talked about it so many times. It is determined by your selling price minus variable costs. You multiply by your units, and then you subtract your what? Fixed cost. You subtract your fixed cost. They are telling us that the selling price is 100. Your variable cost has been provided, and various costs have been provided with various what? Probabilities. So it basically means you are uncertain of the true cost of the variable cost. The units to be sold after production, you have been given under various conditions and their probabilities. And so this is how you're going to draw this tree diagram. This is how you're going to draw this tree diagram. Let's start by determining the units. There, there, and there. Your units, you have 45,000 units with a probability of 0.3, and those are the worst conditions. That is worst condition. The next condition is when it is most likely. Most likely. And most likely, your probability is 0.6. Then you have the best condition. The best condition, you have a probability of 0.1. Of 0.1. 0.1. How many units are these of most likely? 50,000. And best conditions was how much? 55,000. 55,000 units. 55,000 what? Units. We have represented the units to be produced and sold. So these are your who? Units. These are your units. The other uncertain item that we don't know about is your variable costs. Your variable what? Costs. And your variable cost, we will have it in 3 market conditions. 3 market conditions. Let's draw it nicely. 3 market conditions. The first market condition is 0.3, which is what? The worst. So let me write this here, the worst. The worst condition with a probability of 0.3, and your cost is 350. Most likely is the next market condition. With a price with a probability of 0.5, but a cost of how much? 400. You have the best condition with a probability of 0.1, with a price of how much? 550. You repeat this. Worst, your probability is 0.3. Most likely, your probability is 0.55. The best condition, your probability is 0.15. 0.15. Then we also need to analyze what? Worst, 0.3. Most likely, 0.55. The best is 0.15. Your prices are 350, 400, 550, 350, 400, 550. That is your variable who? Costs. These are the units, so these are your variable costs. Very important that you capture that. That is your variable cost there. Okay? Then we can then determine your contribution margin. Your contribution margin multiplied by the units will give us what we refer to as total contribution. Remember, how do you get your contribution margin? It is simply the difference between your selling price, and remember, your selling price was set as what? 1,000. Your selling price was set at 1,000. So to get your contribution margin, you simply take your selling price minus your variable cost. Minus your variable cost. And how will that be? You're going to take 1,000 minus 350. 1,000 minus 350. 1,000 minus 350. Let's say 1,000 minus 350. Then you multiply by the units. And how many units were you selling? 45,000. So please confirm that that is 45 million times 650. This is 29 to 50,000. So my values are in thousands. My values are in thousands. Then again, determine your contribution margin by taking your selling price 1,000 minus 400. I believe now you have understood that. times your units, and your units were 45,000. 1,000 minus 550. How many units again are you selling? 45,000. 1,000 minus 350. Yeah, your selling price is not changing. You multiply by who? Your units now, for the most likely scenario, are 50,000. 1,000 minus 400. Again, your units are 50,000. 1,000 minus 550. You multiply by 50,000. That will give you your contribution. 1,000 minus 350. Your units under the best scenario is selling 55,000. 1,000 minus 400 by who? By 55,000. 1,000 minus 550 by who? By 55. Then we now get our who? Totals. We then now get our who? Totals. We need to get our totals. We get our totals. 600 by 45,000. That must be 27 million. 1,000 minus 550 by 45,000. That must be 20 to 50,000 times 50,000. That must be 32,500. That must be 30 million. 1,000 minus 550 by 50,000. That is 22,500. 1,000 minus 350 times 55,000. 35,750 million. 1,000 minus 400 by 55 is 33 what? Million. 1,000 minus 550 times 55,000. 24,750,000. That will give you your who? Contribution. That will give you your total who? Contribution, which is your contribution margin times your units. Then you then subtract your who? Fixed costs. So let's have our who? Fixed costs. And I will have my fixed cost in thousands of what? Shillings. So you need to indicate that. Your fixed cost, what were they saying? Note number 2. The fixed cost attributable will be how much? 24 million. So this should give you 24,000. 24,000. 24,000. 24 again. 24. 24. 24. 24. And lastly who? 24. Now with that, we then need to get our who? Profit. Remember they wanted us to get our what? Expected profit, which we know. For us to get our expected profit, we need to get our profit. We multiply by our probability. So let's start by getting our profit. 29 to 50, which is your contribution, minus your fixed cost of 24 million. This will be 52.50. 27 million minus 24 million. That will give you 3 million. 2250 minus 24 million. That will give you a negative profit of 3750. 32,500 minus 24 million, that is 8,500, that is 6 million. 22,500, is that 1,500? Yes, it is. Minus 24 is 1,500. 35,750 minus 24 million, that must be 11,750. 33 million minus 24 million, that is 9,000. 9,000 or 9 million. 24,750 minus 24 million, that is how much? 750. We then will introduce our joint probability. Our joint probability, which we simply denote as JPO. Why are we doing that? We are doing that so that we now take our profit by our joint probability to get our expected profit. Our expected profit. Your joint probability will simply take the probability of units, you multiply by the probability of your variable cost. For example, 0.3 by 0.9, 0.3 by 0, it should be 0.3, eh? The other one is what? 0.3. You multiply by who? 0.55. I'm indicating this because it is necessary so that you together 0.3 by 0.15. Very nice. Must indicate this. 0.6 by 0.3. 0.6 you multiply by who? 0.55. That was 0.6 by 0.55. 0.6 by 0.15. Best 0.1 by 0.3. 0.1 by 0.5. 0.1 by 0.15. Sorry about that. We then get our joint probabilities now. Our joint probabilities. 0.3 by 0.3 is 0.09. Then 0.3 by 0.55 is 0.165. 0.3 times 0.15, 0.045. 0.6 by 0.3, 0.18. 0.6 by 0.55, 0.33. 0.6 by 0.15, 0.09. 0.1 by 0.33, 0.30. 0.03. 0.055, 0.015. Wonderful. Let's then get our expected profits. Our expected profit by taking your probability, you multiply by your who? Profit. Your probability, you multiply by your profit. So 5250, and this was in thousands of shillings. Remember that is in thousands of shillings. 5250 by 0.09. 5250 by 0.09, that is 472.5. 3000 by 0.165, 495. 3750 by 0.045. This will be 168.75. 8500 by 0.18. 1530. It is very, very necessary. As much as it looks exhausting and very involving, you need to do this. 1500 by 0.09. 130. 11750 by who? 0.03. 352.5. 9000. 55. 495. 750 by 0.015. 11.25. Once you've gotten the product of your probabilities and your what? Your profit to determine your expected profit, you then now get your totals. So you must get your what? Totals. And this, remember, is your expected who? Profit. Expected profit. So you now simply add 472.5 plus 495 plus 168 plus 0.75 plus 1530 plus 1980 plus 135 plus 352.5 plus 495 plus 11.25, which will give you 5640. Which will give you 56 what? 40. 5640. So therefore, we can say that, and this was a loss, this was a loss, 22 minus 24, that is a negative profit. The same case with this one, we have left out those negatives. Is there any other negative? That's a profit, a loss, a profit, and a profit. So let's compute this answer again because of the what? Of the negatives, of the negative profits. We left out that, but the good thing is that we have captured it. So let's add again. 472.5 plus 495 minus 168.75 plus 1530 plus 1980 minus, this is a negative, 135 plus 352.5, which was a positive, plus 495 plus 11.25, 5032.5. That will give you your expected what? Profit. That will give you your expected profit. That is the first part of that question. The first part of that question is saying, using a probability tree, compute the expected profit of what? Vera. The next part of that question, part 2, that was part 1. Part 2 of that question, compute the probability that Vera Enterprises will fail to break even. Compute probability that Vera will fail to break even. To break even. The probability that Vera will fail to break even is here. 0.045 plus 0.09. Why? At break-even point, your profit is equal to 0. Okay, so anything less than 0 basically means your company is not able to break even. And as you can see, with a probability of 0.45, your profit is negative. With a probability of 0.09, your profit is negative. So you have not been able to cover your costs. So this will be given by 0.045 plus 0.09. 0.09. It should be 0.045 plus 0.09, 0.135. You're not able to break even from here. The third part of that question, lastly, the last part of that question, determine the probability that Vera Limited will not achieve a target profit. Compute probability that Vera will not achieve. How much is your target profit? Your target profit, they were saying, was 6 million. 6 million. So where will you not be able to achieve your target profit of 6 million? That first is not achieving. You're also not achieving that you have achieved, that you have achieved, that you have not, that you have, that you have, that you have not. So we take the joint probabilities. The first one is 0.09 here. The second one is plus 0.165 here. The third one is already a loss, plus 0.045 plus that is a profit of more than 6. That is also okay. That is a loss with a probability of 0.09. That is a profit of more than 6 is okay. That is a profit of more than 6 is okay. That is less than 6 million. So 0.015. So then what do? We simply now get the total. So for the company not to be able to break, to achieve a target of what? Of 6 million profit, the probability is 0.405. 0.405. And that is all that is required in that particular question. That is all that is required in that particular question. All right. That is how you deal with probability tree diagram. So as far as your conditions of uncertainty is concerned, in the next lesson, we are going to talk about continuous or normal distribution method. Continuous or normal distribution method. And I would like for us to attempt a question. And from your previous illustration questions, you can attempt November 2017. So your assignment, this is an assignment. This is your homework. This is an assignment. So you can attempt a question of November 2017. November 2017. And the specific question is question 4A. BPO Limited. BPO Limited. BPO Limited. Right. So thank you so much. We can call it a day and then have a good time.
Hello and welcome back to the lesson. Today we are going to discuss mergers and acquisitions in the Kenyan, regional and global context. Mergers and acquisitions in the context, in the Kenyan, regional and global context. There are three things. First, we have the Kenyan context. And Kenya candidates has seen a rise in mergers and acquisitions which are driven by various factors like economic growth, like market consolidation. And one reason for mergers and acquisitions is increased foreign investment. You understand? Kenyan context. Let's first briefly analyze mergers and acquisition in the Kenyan context. Here in Kenya, we've seen companies merging, we've seen companies acquiring others, and the reason has been because of the economic growth in the country, because of market consolidation. We've had also increase in foreign investments. And there has been mergers and acquisitions in various sectors, various industries. We've seen banks merging, that is the finance sector. We have telecommunications, we have areas to do with the consumer goods and so on. So one reason for the mergers and acquisitions in the Kenyan context is a growing market, because market has been growing. Growth in the general market. Now, in trying to understand mergers and acquisitions in the Kenyan context, you may also need to look at the regulatory framework. The regulatory framework, for example, we have the Competition Authority of Kenya, which plays a crucial role in ensuring fair competition. We also have other regulatory bodies such as the Capital Markets Authority, the Central Bank, and so on. These bodies oversee mergers and acquisitions in the respective sectors. So again, we have regulatory framework. Kenya has put in place regulatory framework that oversee mergers and acquisitions. That's why we've had successful mergers and acquisitions in the Kenyan context. In understanding mergers and acquisitions in the Kenyan context, you may also have to maybe discuss something to do with strategic drivers. Companies pursue mergers and acquisitions to expand their market share, to diversify their operations, and also gain access to new technologies. All right, we have strategic drivers, which I've mentioned. Strategic drivers. Mergers and acquisitions are driven by certain factors. You understand? Mergers and acquisitions in the Kenyan context. Then you have regional context. Mergers and acquisitions in the regional context. And regional context, here we are referring to the East African integration or community. The East Africa community promotes regional integration, leading to increased cross-border mergers and acquisition activities. And Kenyan companies are actively expanding into neighboring countries, And also companies in neighboring countries are also expanding their operations into the Kenyan market. So we have the East Africa integration, East Africa community. We also have COMESA, the common market for Eastern and Southern Africa. COMESA also influences mergers and acquisition activities. COMESA also has regulations that apply to transactions involving multiple member states. You understand? Then you have also regional banking expansion. Kenyan banks have been particularly active in regional expansion through mergers and acquisitions. An effort which seeks to tap into the larger Eastern African market. Global context, mergers and acquisitions in global context. Mergers and acquisitions in global context. These mergers are influenced by global trends. Global trends. Global trends. What do we mean by global trends? Now, the global mergers and acquisition trends influence activities in Kenya and even the region. Factors like technological advancements. We have factors like the economic conditions, the geopolitical events. Such factors play a significant role in mergers and acquisitions in a global context. You understand? So global trends are influenced by technological factors, technological advancements. We have factors like the geopolitical events, the geopolitical events which influence mergers and acquisitions in the global context. Economic conditions also play a crucial role. Global economic conditions. Global economic conditions. You understand? So, apart from what we've discussed, we also have cross-border deals. All right? Cross-border deals. Kenya is increasingly involved in cross-border mergers and acquisitions, both foreign companies acquiring Kenyan businesses and Kenyan companies acquiring foreign businesses. I've talked about also the technological influences. We have global technological advancements which are driving mergers and acquisition activities. Companies are merging to gain access to new technologies and also digital platforms. So do you understand, candidates? So that's what we can say about mergers and acquisitions in the Kenyan, regional, and global context. Kenyan, regional, and global context. In this lesson, we've learned that Kenya has seen a rise in mergers and acquisition activities, which are driven by many factors. I've mentioned growing market. Kenya has put in place regulatory framework. We also have certain other strategic drivers where companies pursue mergers to expand market share, to diversify their operations, and also to gain access to new technologies. We've gone ahead to discuss mergers and acquisitions in the regional context. In the regional context, here we are referring to the East Africa community or East Africa integration. The Africa integration and COMESA. Right? The East Africa community we know promotes regional integration, which to some extent has led to increase in cross-border mergers and acquisition. We have Kenya companies now operating in Rwanda, others are operating in Uganda. We have banks that have opened branches in Tanzania and so on. Then we have COMESA also, which promotes regional integration. COMESA, the Common Market for Eastern and Southern Africa. It influences mergers and acquisitions. COMESA has regulations that apply to transactions involving multiple member states. We've seen Kenya banks which have been particularly very active in regional expansion through mergers and acquisitions. You understand? Then you have the mergers and acquisitions in the global context. We have global trends, which influence activities in Kenya and even the region. Due to factors like technological advancements, we have geopolitical events and economic conditions. All these influence mergers and acquisitions. So candidates, that marks the end of today's lesson. We briefly discussed mergers and acquisitions in the Kenyan, regional and global context. Thank you. I'll meet you in another lesson where we continue to share knowledge in advanced financial management. Bye-bye. I greet you all and welcome you back to the Manifested e-learning platform. The subject is meetings. We are studying the governance standards and guidelines. Today we are moving to guideline standard number 006 on registers and records. Governance standard GS 006, registers and records. This is a standard that governs the corporate memory. We are talking about records, candidates. Previously, we studied minutes and resolutions, which record decisions. Minutes, resolutions. Minutes is a record of what transpired in the meeting. Right? Resolutions, we say these are the decisions that are made during the meeting. Today we are moving to records or registers. Registers record the status and identity of company stakeholders. They record the assets of the company and legal obligations. And under this standard, the company has a statutory duty to maintain specific books that are accurate, that are up to date, and available for inspection. That is the requirement of this standard. Understand? Yes. Registers and records. The standard ensures that the company remains transparent to the regulators, to the shareholders, and also to the creditors. It is a legal requirement. The company has no option but to maintain records and registers. So first of all, let's analyze the statutory registers, which is a mandatory requirement. Statutory, number one, statutory registers. Every company is legally required to maintain certain statutory books or registers. This is mandatory. Mandatory. The first book is known as register of members. Register of members. Members are just the shareholders. These are shareholders. Register of members. The definitive record of who owns the company is what we are referring to as the register of members. That's the first mandatory book that is required to be maintained by a company. Who owns that company? We can tell the owner of a company by reading the register of members. Who owns the company? A person is generally not a legal shareholder until their name is entered in this register. Until your name is entered in a register of members of a company, you cannot claim to be a member of the company. It is a statutory register. If you want to tell the owners of a company, then you make reference to the register of members. There you will find the shareholders of the company, those who own the company. That's the first book. The second register is register of directors. Register of directors and secretaries. These are the officers of the company. The officers of the company. Register of directors and secretaries. This register details the leadership. It provides the details of the leadership, including their names, their addresses, their dates of appointment, and also resignation. If they resigned, if you are a director of a company and you resigned, that record, you can find it in the register of directors. You are appointed, then you must appear in the register of the directors and secretaries. Then the third book is register of directors' interests. Register of directors' interests. The company is also under legal obligation to maintain a register of directors' interests. This records any shares that is held by directors or contracts where they have a personal stake. If you are a director and you own shares in the company, that has to be part of the register of directors' interests. If you are a director and there is a contract that was issued to you, or a contract where you have interest, then that has to be part of the register of directors. That's the third statutory register. Or register of charges. This is yet another important register, the register of charges, and this could also be mortgages. Register of charges or mortgages. This is a list of companies' assets that are used as security or collateral for loans, and this register is crucial for the creditors. If the company has taken loans and it has charged the company's assets, then that information must be recorded in a register of charges. Those assets that are used as collateral must appear in the register of charges and mortgages. Understand? Yes. 3. Register of beneficial owners. The register of beneficial owners is The fifth register, which identifies the persons with significant control who may own shares through holding companies or through trusts. Those who have significant control. They could be owning the shares of a company through other companies, and that has to be documented in the register of beneficial owners. Register of beneficial owners. Understand? Yes. So these are mandatory registers. Mandatory statutory registers. Then let's discuss location and inspection rights. Location and inspection location and inspection rights. We are talking about the inspection of these records. First of all, we have identified the records. So we want to discuss analyze the location and inspection. Now, GS006 defines where these records live or are located and who can see them. And the first location is the registered office. 1. Registered office. The registered office. Records must typically be kept at the company's registered office or a designated single alternative inspection location. If it is not the registered office, then it has to be the designated single alternative inspection location. So that is where the records are required to be kept. Then number 2, we have public inspection. Public inspection. Public inspection. Shareholders usually have a right to inspect registers for free, but the general public may often do so for a small fee or upon stating the proper purpose for wanting to inspect the documents. 3. Digital versus physical. Digital versus physical. Most modern standards allow for digital registers, provided they are secure, they are backed up, and can be printed upon request. So if the records are digitally located, then the records should be printable. The records should be secure, and they are supposed to be backed up. There ought to be a backup for the digital records. You understand? Yes. So this is ABC. ABC. Then 3, retention. Retention. We have to discuss retention as per GS006. Retention. How long must records be kept? Now, while laws vary by region, the standard generally allows for certain benchmarks. Okay, we are going to have the benchmarks here. Let's have a column for record type. And have a column for record type, then another column for retention period. Retention. The laws of the country may give direction or provisions on a retention period. So the laws vary by jurisdiction, but the standard 006 registers and records, they provide a benchmark. So let's begin with the statutory registers. The first record type is statutory registers. Statutory. The statutory registers. The retention period for statutory registers is for life. These records are stored permanently. The record cannot be deleted. It is retained for the life, permanently for the life of the company. Before the company dies, these records must be maintained. That is statutory registers. These ones here. Register of members, register of directors, register of directors' interests, register of charges, register of beneficial owners. Permanently retained. Then we have minutes and resolutions. Minutes and resolutions are often permanently stored, but at least 10 plus years. This is 10 plus years, 10 years, 11 years, or permanently. That means they are not stored for less than 10 years. 10 years permanency. Then number 3, we can have accounting records. Accounting records. This could be the income statements, the financial statements. Accounting records are required to be kept. The standard recommends 6 to 7 years. They have to be kept for a period of at least 6 to 7 years. Employee records. Employee records be kept for a period of 4 to 7 years. 4 to 7 years post termination. After termination of a contract of employment, then the record of the employee has to be maintained for a period of not less than 4 years and not more than 7 years. 4 to 7 years. It will be 4 years, 5 years, 6 years, or 7 years at least. So that is information on retention periods. Retention periods. Then candidates, let us discuss the role of the corporate secretary, because the secretary plays a key role when it comes to registers and records. In fact, the corporate secretary is the custodian. The custodian. This candidate is just retention periods. This is retention. Let me title this as retention of records. The record type is here. So what is the secretary's role? This is number 2, number 3, then number 4, role of the corporate secretary. This is the role of the corporate secretary in relation to the registers and records. Now under GS 006, The secretary is the custodian of the records. The corporate secretary, the company secretary, is the custodian of corporate records, of company records. And their duties include updating. The duties include: 1, the first duty is to update the records, updating the records. The secretary should ensure changes like the share transfers are recorded within the legal window. And the legal window is most of the time 14 days. All right? Updating. Before we talk about filing, there is validation. Validation. Before the documents are filed, the company secretary has a role to carry out validation, to verify that information provided by directors and shareholders is accurate before entry or before filing. Before entering information in these registers, it is the role of the corporate secretary to ensure that the information is accurate. Then number 3, filing. Filing. It is also the responsibility, the legal responsibility of the corporate secretary to notify the national registry, like the register of companies, whenever a register is updated. Whenever a register is updated, the corporate secretary is to ensure that that updating, that change is communicated to the register of companies. Okay, that's the end of today's lesson on governance standards, governance standard number 006, registers and records. In this lesson, we have identified the statutory registers which are mandatory. 1 is register of members, 2, register of directors and secretaries, 3, register of directors' interests, 4, register of charges and mortgages, 5, register of beneficial owners. We've also discussed the location and inspection rights of these records. These records we've seen must be kept at the registered office of the company. There is also public inspection. The shareholders have a right to inspect these records without any charge. The members of the public may be required to pay a small fee or to state the reason why they need to inspect the records. We've also made mention of digitalization and physical of these records. We say that if the records are digitally kept, then they should be secured, they should be backed up. These records should also, the company should ensure that the records are safe, right? Then there is retention. And of course, in this lesson, we have studied the retention periods. We have retention periods. For statutory registers, they are permanently retained as long as the company is in existence. Then we have minutes and resolutions which are retained for a period of 10 plus years. Accounting records are kept according to the standard between 6 to 7 years. Employee records 4 to 7 years post termination. That is, after termination of employment, these records must be kept for a period of 4 to 7 years. Then we've, in closing this lesson, discussed the role of the company secretary. The first role is updating, validation, and then filing. So it's important, candidates, that a company maintains these registers, because failure to maintain these registers is often a criminal offense for both the company and its officers. And in many jurisdictions, the register of members is the only evidence of the title to the shares. So if it is lost or inaccurate, then ownership disputes can paralyze the company. So thank you for attending this lesson on GS006, registers and records. We continue to learn more on governance standards and guidelines in our next lesson. Important for you to also remember that over and above the video lectures, we have prepared for you study texts which contain notes for the entire syllabus. We also have revision books where we have answered past KASNEB question papers. The answers are topically arranged in the books. All these materials are available in hard copies. You can visit our shop or you can place your orders using our official lines. Thank you. God bless you. Bye-bye. Now allow me to move to the next part of the question, which is on CVP. CVP. Let's move to the next part of the question. Part C of the question reads, Tinga Limited manufactures and sells a single product named T140. The following information relates to the product. Selling price per unit is 180. Variable cost per unit is 80 shillings. Fixed cost per annum 5 million. Required Roman 1, break-even point in shillings and in units, 4 marks. Roman 2, the total number of units, the number of units to be produced to earn a profit of 1.2 million. That is the question. We need to calculate, first of all, the break-even point in units, then the break-even point in shillings. So this is part C. We are to calculate the break-even point in units. To calculate the break-even point in units, we know the formula is fixed cost over contribution margin. Just fixed cost over contribution margin. So what is the fixed cost in this question? 5 million. The fixed cost here is 5 million shillings. What is the contribution margin? We know the contribution is equal to selling price minus variable cost. Contribution margin is equal to selling price minus variable cost. The selling price here is 180. The variable cost from the question is 80. So that will give us the break-even point in units. This will be equal to 5 million divide 180 minus 80 is just 100. It's just 100. This is equal to 50,000 units. Now, this is the break-even point in units. That means that if the company is to produce 50,000 units, the company will not make any profit, because at break-even point, profit is equal to 0, which means that the total cost equal the total revenue. At break-even point, total revenue is equal to total cost, and we know profit is equal to total revenue minus total cost. So total profit is equal to revenue minus the cost, which will be equal to 0. If the company produces 50,000 units, there is no profit at this point. This is the break-even point. The first shilling of profit will be made after the 50,000th unit. That will be 50,001 unit. So that's the break-even point in units. Then to calculate the break-even point in shillings, that will be equal to the fixed cost over contribution margin ratio. Contribution margin ratio. So we are going to have it at 5 million minus the contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin ratio is equal to the selling price minus variable cost, that gives us the contribution. Then we divide by the selling price. So this will be equal to 180 minus 80 over 180. So that will be the contribution margin ratio. So 180 minus 80 is equal to 100. 100 divided by 180. This is equal to, the contribution is 0.555555. So we divide the 5 million. This gives me 0.55555. So I'm going to divide the 5 million by that ratio. 5 million divide 0.55555. So roughly I'm getting 9 million. When I round off in shillings, this will be 9. That is the contribution margin. I mean the break-even point in shillings. The break-even point in shillings is equal to 9 million shillings. So that is how candidates should calculate the break-even point in shillings and in units. Then the second part of the question reads, look at the question. The number, this is Roman 1, C1, C2, we are to calculate the number of units to be produced to earn a profit of 1.2 million. Number of units to earn a profit of shillings 1.2 million. Now this will be determined, the formula to the number of units. You have to calculate the number of units to earn a profit of 1.2 million. This will be equal to the fixed cost. You remember the formula we gave in our class. This will be equal to the fixed cost plus the target profit. We get the fixed cost plus the target profit. Then we divide by the contribution. We divide by the contribution margin. We divide by the contribution margin. So we know the fixed cost is 5 million. We know the target profit is 1.2 million. This 1.2 million, 1.2 million. We know the contribution margin. Of course, it's supposed to be units. The contribution margin, we had calculated it. Contribution margin is 100. This is the contribution margin, 180 minus 80, which is equal to 1. So this will be equal to 5 million plus 1.2 million, that's 6.2 million. That will be equal to 6.2 million. 6.2 million divided by 100. This is 62,000 units. 62,000. So if the company intends to earn a profit of 1.2 million, then the company must produce 62,000 units. And you can see 62,000 units is greater than the 5,000 units at break-even point. So profit is made after 1,000 units. At 50,000 units, there is no profit. If the company is to make a profit of 1.2 million, then the company has to produce 62,000 units. That is the meaning. So it's possible to calculate the number of units at a given target profit. So that's it, candidates, for today's lesson. We've answered the question that was tested in August 2024, question 3. On our website, we have provided more questions. Our intention is to answer all questions that have been tested before. If you go to our website, you'll find all these questions have answered, and we subsequently revise our content to ensure that we capture all present sittings. If you have any questions, please feel free. You can get us directly. We have our numbers online. If you have questions, if you need special attention, please call us, and we are ready to help you pass your exams and to gather knowledge that will be useful as you build your career. Bye-bye. Greetings, candidates, and welcome back to the lesson. The subject is meetings, compliance, and administration. We are continuing with the topic on governance, standards, and guidelines.
So far, we've covered guideline standard number 001, 002, 003, 004, 005, 006. Today, we move to governance standard number 7, GS 007. This is filing annual returns. Filing annual returns is our today's focus. That is governance standard number 007. And this is the standard that ensures that public record of a company is kept current. It is done what? It is kept current. Because while many mistakes an annual return for say tax returns, the GS 007 focuses on statutory compliance. Many mistake an annual return for tax returns. But GS 007 focuses on statutory compliance. That means confirming that the company's structural details, like directors, shareholders, and their addresses with the government register are accurate. So GS 007 is a standard that mandates that an organization provides a periodic health check to the registrar of companies, and that is to ensure transparency for the public, for the creditors, and for the investors. You understand? Yes. So do not mistake annual returns for tax returns. Here we are not discussing tax returns. We are discussing filing annual returns. All right? The standard focuses on compliance, statutory compliance, because the law mandates companies to make certain returns. So what is an annual return? If an annual return is not a tax return, then what is an annual return in the context of governance standards? Now, an annual return, candidates, is a statutory document that summarizes the company's legal structure as of a specific date. Let me define it. An annual return is a statutory document. Statutory document. First of all, it is a statutory document. An annual return is a statutory document that does what? That summarizes the company's legal structure. That summarizes the company's legal structure as at a certain date. All right? That summarizes the company's legal structure as of a specific date. As of a specific date. As of a specific date. That is the meaning of a statutory annual return in a snapshot. In a snapshot. That is the meaning. It is a statutory document that summarizes the company's legal structure as of a specific date. It is not a financial report, but a confirmation of, say, registered office. It's a confirmation of the company's registered office, It's a confirmation of the company's registered office. This is the physical and postal address of the company. It is also a confirmation of the company's officers. It is a confirmation of the company's officers. This is the current list of directors and the corporate secretary. It is a confirmation of the company's share capital. It is a confirmation of the company's share capital. That is the total number of shares issued and their value. It is also a confirmation of the company's shareholders. It is a confirmation of the company's shareholders. These are the owners of the company, names of members, and any share transfers that occurred during that year. It shows the list of shareholders and any transfers that were made during that specific year. Understand? Yes. It also confirms the company's indebtedness. It confirms the company's indebtedness. It details any mortgages or charges secured against the company's assets. Mortgages or charges secured against the company's assets. Indebtedness. You understand? So that is an annual return. Because you recall in our previous sessions, we covered the documents, the statutory documents, the statutory documents, the statutory paper, the statutory documents, registered office, company's offices, company's officers, the share capital, the shareholders. So an annual return, it is not a financial report. Neither is it a tax return, but it is a statutory document that confirms or summarizes the legal structure of a company as at a specific date. It confirms the company's registered office, the company's officers, the company's share capital, the shareholders, and indebtedness. Now let's discuss the deadlines and timing. Deadlines and timing. This is number one. Number two, deadlines and timing of filing annual returns. Okay, so in analyzing the deadline and timing, we are going to have the milestone and the requirement. Let's have the milestone and another column for requirement. Milestone and requirement. We begin with the return date. Return date. The return date. This is usually the anniversary of the company's incorporation. These documents or confirmation must be done during the anniversary of the company's incorporation. The requirement is usually the anniversary of the company's incorporation. The company's incorporation is the birthday of a company. It is the day the company is born. So after the first anniversary, after the first year of incorporation of a company, then the company has to file annual return. Then there is the filing window. Filing window. there is a window within which the filing has to be made. And most jurisdictions require the return to be lodged within 20 to 42 days of the return date. 28 to 42 days. 28 to 42 days of the return date. That is 42 days or 28 days after the return date. The return date is exactly 1 year after the incorporation of the company. Understand? So filing has to be done by 42 days. Okay? Within 42 days, not more than 42 days. And it could be after 28 days, between 28 and 42 days after the anniversary. So it could be first anniversary, second anniversary, third anniversary, and so on. So that if a company was incorporated on 1st January 2024, the first anniversary would be 1st January 2025. So the filing date, the filing window, there is a window. It's supposed to be between 28th of January, then not more than 42 days after 28th day of January 2025. That is the filing window for a company that is incorporated on 1st January 2024. That is the filing window. Then another milestone is the AGM link. AGM. The AGM link. In many jurisdictions, the return is made up to a date shortly after the annual general meeting. That is General Standard number 001, annual general meeting. The return is made up to a date shortly after the annual general meeting. The date shortly after the annual general meeting, because general meetings are also held annually. That's why they are called AGM. This A stands for annual. So shortly after the AGM, these returns are supposed to be filed. Understand? Yes. So that is the deadline and timing of filing annual return. The GS 007 also has what we call a compliance check. To fulfill this standard, there are steps that must be undertaken. So what is the compliance check? So this is number 3. Number 3, compliance check. There are steps that must be followed when filing the annual returns. To fulfill the GS007, there are steps that must be undertaken. The first step is verification. Number 1, verification. 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 This is to ensure that information in the return matches the internal statutory records. Because what is filed is just information in the statutory records. If the company is to confirm the registered office, then the name of the registered office in the return should be the name in the register or in the name in the statutory records. So what is filed here is what is contained in the statutory records. So there has to be verification. What is contained in the annual return should be what appears in the statutory records. That is what we are calling verification. And that is the work of the company secretary. Company secretary should ensure that the information in the return matches the internal statutory registers that we covered in our last session, that is GS006, registers and records. Because what is being filed is confirmation of what appears in the records and files. You understand? Yes. Number 2, after verification, there is certification. After verifying, then there has to be certification. The return must typically be signed by at least one director and the company's secretary. Then, of course, there is the aspect of financial statements. The financial statements. What do we mean? For many companies, there ought to be a certified copy of the audited financial statement, which must be attached to the return. In some countries, in some regions. Then the 4th item on the compliance checklist. This is a compliance checklist. Is payment. Lodgement is only considered complete once the statutory filing fees is paid. So that's very important. And candidates, here we are discussing statutory matters. What we are discussing here, these are requirements of the law. And there are consequences of non-compliance. If the company does not comply, if the company does not file annual returns, then there are consequences of non-compliance. Consequences. Let's discuss the consequences of non-compliance. Consequences of non-compliance. Because these are statutory responsibilities, then the company that does not comply then faces certain consequences. Because GS007 is heavily enforced because the registrar relies on this data for public transparency. The registrar of companies relies on the data that is provided under GS007 for the purposes of transparency. And failure to file results may lead to automatic fines. This can lead to automatic fines. Automatic fines. The company may be fined for non-compliance. The company can be fined for non-compliance. There could be a daily penalties that accumulate until the return is filed. Understand? Yes. Number 2, dormant status. What do we mean by dormant status as a consequence of non-compliance? The company may be listed as not in good standing, which may affect bank accounts, which also may affect bank accounts. The dormant status may also affect contracts that are entered into by the company. The contract may be declared null and void because the company is dormant. It is not in good standing. That is a consequence of non-compliance. That is a consequence of failing to file annual returns. Another consequence is striking off. The company may be struck off. Persistent failure can lead to the registrar of companies. The registrar of companies may possibly dissolve the company and seize its assets. It can lead to striking off of the company. The company may be dissolved because of failure to file annual return. Consequence number 5 is personal liability. Personal liability. What do we mean by personal liability? Personal liability. Directors can be held personally liable, and in extreme cases, they could be prosecuted. Understand? Yes, so these are consequences of non-compliance. And that effectively brings the lesson to an end. The topic is governance, standards and guidelines. Today we are studying GS007, filing annual returns. We've defined what an annual return is. We've said an annual return is not a tax return, but it is a statutory document that summarizes the legal structure of a company as at a specific date. It is just a document that confirms the company's registered office, the company's officers, the share capital, the shareholders, and the indebtedness of the company. In this lesson, we've studied the deadlines and timings of making annual returns, of filing annual returns. The first milestone is the return date, which is usually the anniversary of the company's incorporation. The second milestone is the filing window. The filing has to be done between the 20th day to the 42nd day of the return date. Then there is the AGM link. These returns could be made shortly after the AGM is conducted. Then in this lesson, again, candidates, we have outlined the compliance checklist. Before the filing is done, the company secretary has to verify that what is contained in the annual return is what appears in the company's records. Then there is certification. At least one director is required to sign the annual return. Number 3, in certain jurisdictions, the financial statements are required to be attached to these annual returns. Then number 4, the compliance checklist. The 4th one is payment. You've said that lodgement is only considered complete once the statutory filing fee is paid. Then, of course, lastly, we've discussed the consequences of non-compliance. Non-compliance can lead to automatic fines, dormant status, striking off, and also personal liability. That's the end of today's lesson. Thank you for attending the lesson. Make sure you go through the video again, take notes, then go to our revision partners. We have questions on this topic, governance standards and guidelines. Attempt the questions without looking at the answers that are provided at the back of the book. You understand? At the end of this topic, please get hold of our revision partners. We have analyzed KASNEB past paper questions, topically arranged for your ease of revision. Attempt questions on governance standards and guidelines before looking at the answers at the back of the book. Thank you for taking your time to study with us. In our next session, we are going to the next governance standard, number 008 common seal. Bye-bye. Hello and welcome back to the lesson. The subject is finance for decision making. We continue with the topic budgeting and budgetary control. In our last session, we discussed the nature and purpose of budgets. Today, we are going to discuss the limitations of budgeting. And we saw that we can now say that while budgeting is essential for financial planning and control, it may also have drawbacks. It has its own drawbacks, which we are calling limitations of budgeting. And these limitations can be categorized into issues like inflexibility, behavioral problems, technical difficulties, and so on. That is our focus for our today's lesson. We're going to discuss the limitations of budgeting. And the first limitation is in relation to inflexibility. Inflexibility and rigidity. From the word rigid. Okay? It may be difficult in adapting to change after preparing a budget. Difficulty adapting. It may be difficult to adapt to change after a budget has been drafted. Budgets are typically prepared for a period. It could be 1 year, it could be a month, and so on. And if economic conditions or market demands or technology or even government policy changes within that period, a static budget can then become obsolete and lead to poor decision making or even missed opportunities. That's what we mean by inflexibility. Budgets also encourages short-term focus. Short-term focus. Managers may concentrate only on meeting the current year's budget targets, potentially neglecting important long-term strategic goals such as new product development, maintenance, and even staff training. And they may do that in order to cut on costs and so on. So that is one drawback. There are also behavioral and human factors. Behavioral and human factors as limitations of budget. Behavioral factors. It could be budgetary slack. This could be budgetary. It could be budgetary slack. What do we mean by budgetary slack? Now, managers may deliberately overestimate expenses or underestimate revenues to create an easier target which they can achieve or easier target to hit. Okay, and this slack provides a cushion against poor performance and ensures favorable variances, but it results in an inefficient allocation of resources for the company as a whole. That is a behavioral and human factor. There is also the spend it or lose it mentality. Spend it or lose it mentality. That is another disadvantage. Near the end of the budget period, a department with the unspent funds may rush to spend it on unnecessary items, for example, buying new furniture or just excessive supplies. And the manager may fear that an underspent budget will lead to a lower allocation in the next period. That mainly happens towards the end of the financial year when the manager discovers that they have money that has not been spent throughout the accounting period. That is one disadvantage. It may also lead to departmental conflict or rivalry. Departmental rivalry. Departmental conflict, rivalry. Okay? Departmental rivalry. Now, the process of allocating limited resources can lead to intense competition and conflict between different departments, which may damage interdepartmental collaboration, and it may also determine the overall organizational harmony. That is a human or departmental factor as a limitation of. There is a point on demotivation as a behavioral and human factor. This is demotivation from imposed or from unrealistic targets. Okay, if a budget is imposed on a lower level managers without their input, or if the targets are too high or too tight and are perceived as unattainable, that can lead to frustration. It can lower morale and also lack of commitment to achieve such high goals. Demotivation. Do you understand? Another category of limitation is technical and practical difficulties. Technical and practical difficulties. How is that a limitation? Now, budgets rely heavily on forecasts for future conditions. And if these underlying assumptions are inaccurate, the entire budget becomes unreliable as a tool for planning and control. Okay? So that is a limitation which is based on estimates. Based on estimates or assumptions. Budgets are futuristic. Budgets are projections. They rely heavily on forecasts of future conditions like sales, costs, prices, and so on. And if these underlying assumptions are not accurate, then the entire budget becomes not unreliable for planning and also for the purposes of control. 2, time-consuming and costly. Budgets can be time-consuming and costly. The process of preparing, coordinating, and also revising budgets, especially in large and complex organizations, can be a highly time-intensive and expensive exercise, which consumes significant management time. It may also consume significant effort. The budgets also focus on financial aspects only. Focus on financial aspects only. Budgets focus on financial aspects only. That is a limitation. Traditional budgeting primarily focuses on financial outcomes like revenues and costs, and may overlook critical non-financial or qualitative factors like customer satisfaction, product quality, employee morale, things like innovation, which are crucial for long-term success. Then lastly, we have preparation, or let me just say inefficiencies. 4, we have inefficiencies. Perpetuation of inefficiencies. Perpetuation, inefficiencies. Inefficiencies. Perpetuation of inefficiencies. Now, if a company uses an incremental budgeting approach, which is based on the new budget, that means basing the new budget on the previous one. Because sometimes the current year's budget may be based on the previous year's budget. That's what we call incremental budgeting. If that happens, then any inefficiencies or waste built into the prior budget will be carried upon or carried forward and perpetuated in the subsequent budgets. So there could be perpetuation of inefficiencies, especially where we have incremental budgeting. This happens in case of incremental budgeting. So currently, these are the limitations of budgeting. We have categorized the limitations into 3: inflexibility and rigidity, behavioral and human factors. Then we have technical and practical difficulties. And that's the end of our today's lesson. Thank you. In our next session, we continue to discuss more in relation to budgeting and budgetary control. Bye-bye. Hello there. I'm glad to welcome you to the platform. The course is Certified Secretaries. The subject is meetings. We are moving to the third topic, which is governance standards and guidelines. This topic has 11 subtopics, namely GS001, general meetings; GS002, meetings of the board; GS003, minutes; GS004, resolutions; GS005, board papers; GS006, registers and records; GS007, filing annual returns; GS008, common seal; GG001, professional ethics; GG002, role of the corporate secretary; GG005, virtual meetings. These are 11 subtopics. Now, before we move to the first topic, which is GS001, meetings, it's important for us to first understand what are these governance standards and guidelines. These are two things: standards and guidelines. Governance, standards, and guidelines. That's where we get the prefix GS and the prefix GG. Look at the standards and guidelines once again. We have GS001. That prefix GS stands for governance standards, and it runs up to GS008. Then after GS008, which is a common seal, we have GG001. That prefix GG stands for governance guidelines. Look at the board. Governance guidelines. G, G, and GS. GS, G, G. So these are two things: governance standards and governance guidelines. And in the professional governance framework, such as the one established by the Institute of Certified Secretaries of Kenya, governance standards and governance guidelines are two distinct but complementary tools that are used to ensure that an organization is managed effectively and ethically. So these are standards, these are guidelines. They are used as a guide to ensure that an organization is managed effectively and ethically. And together, these two, they form the governance framework. The governance standards and governance guidelines, they form the governance framework, which provides the structure for decision making, accountability, and transparency. It is these governance standards and guidelines that help the board in running the organization effectively and ethically. You have to get that understanding, candidates, before we get into the nitty-gritties. So first of all, we have governance standards, right? Governance standards. Governance standards. What are governance standards? GS. Now, governance standards are the mandatory technical requirements that establish uniform practices across an organization. Mandatory. Underline the word mandatory, right? They define the minimum bar for compliance. They do what? They define the minimum bar for compliance. The governance guidelines, on the other hand, are just best practice, recommended best practices. These are recommended best practices. They are not mandatory. These are, in other words, advisory statements that provide qualitative framework for how the board and officers should behave. So governance standards are mandatory requirements. Governance guidelines are recommended best practices or advisory statements. All right. Now, you may have a question. What is the origin or the source of these guidelines and standards? Who is the creator? Now, the Institute of Certified Secretaries is the statutory body in Kenya that is responsible for regulating the profession of corporate secretaries, and it is the institute, and it is this institute that developed these rules to ensure that there is uniformity, there is professionalism, and also enforcement. They were developed, right? But we know candidates, the numbering, the specific numbering and structure that we've seen in the syllabus here, that is GS 1 to 8 and GG 1 to 5. This numbering is mostly aligned with the governance standards and guidelines issued by the Institute of, this one was issued by the Institute of Certified Secretaries of Kenya. They were developed to provide a standardized framework for corporate governance that goes beyond the requirements of the law. That goes beyond what? The requirements of the law. We know the Companies Act and the CPA of Kenya Act. There are certain provisions, but those provisions are not comprehensive. So the institute, which is a statutory body, developed these guidelines and standards to help organizations to ensure that the organizations are run with uniformity. Uniformity means that every corporate secretary in the region has to follow the playbook. Uniformity. So all company secretaries for, say, public corporations are required to follow these guidelines in carrying out their work. These guidelines also and standards, they ensure that there is professionalism, because governance isn't left to best guesses, but follows rigorous documented standards. These are rigorous documented standards which must be adhered to by all company secretaries. There's also the issue of enforcement. The reason why these standards and guidelines were developed is to ensure that there is enforcement, because by creating specific codes like this GS003, this one is on minutes, they provide benchmark against which a secretary's work can be audited or judged. So the standards here, apart from helping the corporate secretary, for example, know how to document minutes, it also helps in enforcing, so that if the corporate secretary does not adhere to this standard, then we can judge their work, or they can be corrected, or they can be punished, and so on. Uniformity, professionalism, and enforcement. So let's begin with the governance standards. Having understood, candidates, what the topic is all about, let's get into the first topic, first subtopic, which is GS001 general meetings. GS001 general meetings, right? But before then, again, candidates, let me emphasize that governance standards, these are the hard rules, the mandatory requirements. These are prescriptive mandatory procedures that a corporate secretary or board must follow to be in compliance with the law, and also to be in compliance with professional regulations. The hard rules, mandatory. And they focus on mechanics, legality, and documentation. So if you skip a standard, like not keeping a register of members, a standard like not maintaining board papers, a standard like filing annual returns, a standard on common seal, all right? If the company does not adhere to these standards, actions could be declared legally invalid. For example, we are saying if you skip a standard like not keeping a register of members under GS006, then the meeting or the company's actions could be declared legally invalid. These are hard rules. We also have GS003 on minutes. GS003 on minutes is not a suggestion to companies. It is a requirement that a legal record of the meeting must exist. It's not a suggestion. If that is not done, if minutes are not kept, GS003, then the resolutions that are made in that board meeting or general meeting could be declared invalid. So these are not suggestions. This is standard. But the guidelines, these are soft rules. Guidelines, on the other hand, are best practices. They provide qualitative framework for how to apply the standard. So you have the standard, then you have the soft rules. So the guidelines helps on how to apply the standard. These are best practices, the soft skills, right? They focus on ethics, they focus on quality of leadership. Guidelines focus on professional conduct, and so on. And while you might not go to jail for a minor breach of a guideline, failing to follow them, like ignoring GG001, ignoring GG001, like which is professional ethics, ignoring professional ethics, candidates, leads to bad governance. It may lead to loss of investor confidence and trust. Okay? Not adhering to professional ethics, 001, could lead to corporate scandals. There is also GG005, virtual meetings, which provides the best way to handle digital attendance in order to ensure that everyone is on board, in order to ensure that it remains an effective and an in-person meeting. That is GG005, virtual meetings. It's not mandatory that a company should hold virtual meetings, but it's mandatory for a company to maintain proper minutes. So that is the difference. I'm just ensuring that you understand the difference between the governance standards and governance guidelines. So let's get into governance standards GS001. GS001. GS, today we'll start the GS001. This one is on general meetings. This is a standard on general meetings, GS001. This is the highest level of corporate decision making. The highest level of corporate decision making is made in general meetings. This standards guides how shareholders, who are the owners, interact with the board of directors to approve major company meeting changes, or to elect leaders, to review financial records, and so on. Those are the decisions that are made in general meetings. It's a high level. It is the highest level of corporate decision making. So GS001 deals with general meetings. This is a standard that ensures that every shareholder has a fair opportunity to participate in the governance of the company. And there are two types of general meetings. Types of general meetings. Types. There are two types of general meetings. The first one is the annual general meeting. Annual general meeting, the AGM. Annual general meeting is a mandatory yearly gathering to present the annual report and the financial statements. We all know that the board of directors have delegated authority to run the company on behalf of the shareholders. At the end of every year, annually, that's why you get the word annual. At the end of every year, the directors are required mandatorily to present financial statements or reports to the shareholders, who are the owners. A mandatory yearly gathering. It is a mandatory yearly gathering to present the annual reports and financial statements. That's the first category of meeting. Then we have the extra. Apart from the AGM, we have the extraordinary general meeting. Extraordinary general meeting. Extraordinary general meeting is a meeting called for urgent matters that cannot await the AGM, that cannot await the next AGM. That's why it's called extraordinary. The AGM is an ordinary meeting because it's held annually. It is expected to be held annually. But there are certain meetings that meeting like the extraordinary meeting cannot await the annual general. Cannot wait until there are decisions that may be needed to be made before the next annual general meeting. Right? Cannot wait the next AGM. For example, we may have a merger or removal of a director. or the director has resigned who needs to be replaced, that cannot await the decision of the shareholders in the next AGM. That has to be done in another meeting known as extraordinary general meeting. Types of meeting. Then number 2, we have meeting cycle. Meeting cycle. Meeting cycle. Now, a compliant general meeting must follow a strict chronological sequence to remain legally valid. Candidates, we are studying the GS001 standard on general meetings. This standard helps us understand that there are 2 types of general meetings, the AGM and the EGM. Then it's important that the management of a company understands the meeting cycle. For a general meeting to be compliant, then it has to follow a strict chronological sequence to remain legally valid. So let's highlight this cycle. So we have phases or stages, then we have the key requirements. So we'll have phase, the cycle, or stage. Then there is a column here for requirements. Are you following, candidates? Yes. Yes. So the first phase is what we call notice period. Notice period. Notice period. What is the requirement in relation to notice period? A general meeting must have a notice. And this notice is typically 14 to 21 days, depending on the jurisdiction and the types of resolutions. There are certain resolutions that may require a notice of 14 days, typically 14 to 21 days. There are certain resolutions that require a notice be sent to the shareholders 14 days. A notice be sent 14 days before the meeting is held. So depending on the resolution, which we covered elsewhere, candidates. So that is the first important aspect of a general meeting. There has to be a notice for a meeting to be to remain legally valid. Because if a meeting requires a 21-day notice and the 21-day notice is not issued to the attendees, instead the notice is say 10 days, then the decision that will be made in that notice, in that meeting, can be challenged. The decisions may be legally invalid. Notice. Then number 2, we have quorum. Quorum. This is the minimum number of members required to be present in person or by proxy for the meeting to start. If it is a general meeting, there is a number of members that is required to be present. If it is a EGM, if it's a special meeting, you understand? The minimum number of members required to be present, either in person or in by proxy, for the meeting to start. So if a meeting is held and it is required that a third of the members must be present, and a third of the members are not present, the meeting goes on before the quorum is reached, then the resolutions that are made in that meeting may be declared invalid. Quorum. The minimum number of members. This is the minimum number of members required to be present before the start of the meeting. Minimum number of members required to be present before the start of the meeting is what we are referring to as quorum. That is the standard. Next, apart from notice period and quorum, there is the agenda. Agenda. There's also a standard in relation to agenda when it comes to general meetings. Agenda. Now, when talking about agenda, the standard items for general meetings are financials, director appointments, auditor appointments, dividend declarations, and so on. The agenda for general meetings, remember we said that general meetings is the highest level of corporate decision making. This is a meeting where the owners or shareholders interact with the board of directors. When this interaction happens, what is the agenda? The agenda could be on financials, financial reports, approving financial reports, appointing auditors, appointing directors, director, stock, auditor, appointments. The agenda cannot be anything else. There is specific item agendas that the two must deliberate on. There are certain agendas that when they happen in a general meeting, they may also be declared invalid. So there are more like dividend declarations. Dividend declarations that may form part of the agenda at a general meeting. Then there is also a standard on voting. There is also this item called voting that we have to discuss. Voting. Voting. What is the key requirement when it comes to voting? When it comes to voting, decisions are made via show of hands. Decisions are may be made via show of hands. You lift up your hand if you are in agreement with the decision, show of hands. Okay? Or even a formal poll may be taken. Or formal poll. Voting. You vote. It could be electronically or whichever way. Taking a poll. That's the requirement. When it comes to voting, then the standard requires that a decision be made by show of hands or formal poll be taken. You understand? So these are requirements in the cycle, the meeting cycle. Whenever a general meeting is called, the general meeting must follow a strict chronological sequence to remain legally valid. And here is the sequence. First of all, there has to be a notice period, which is stipulated by the law. The law is very clear on the notice period to be given before different types of general meetings are called upon, or different resolutions are to be made. There are resolutions that require 14-day notice, others 21-day notice, others 31-day notice, and so on. Within this chronological cycle, there is also a quorum. What is the requirement when it comes to quorum? The quorum is the minimum number of members required to be present before the start of the meeting. Each resolution requires different quorum or minimum number of members to be present. The agenda of general meeting is also clearly stated in standards and in law. It must be on financials, director, auditor appointments, declarations of dividends, and so on. Then we've also talked about decisions that are made via show of hands during voting. So that is the standard. And to adhere to the GS001, the company secretary must verify validation of proxies. For there are certain times when there are shareholders who may appoint proxies to attend these meetings on their behalf. So it is the role of the company secretary to ensure that proxy forms are submitted 48 hours before the meeting. And also part of an important feature of the general meeting is the role of the chairman. The chairman must ensure the meeting stays on track and allows for a reasonable opportunity for members to ask questions. Again, apart from what we've discussed, there is also the aspect of adjournment, which we discussed in our earlier topic on adjournments of meetings. There are also adjournment rules. There are procedures when a quorum is not met, or when the meeting becomes disorderly or unruly. The meeting may be adjourned. Remember, we talked about adjournment and postponement earlier on in our previous session. General meeting may be postponed. That postponement only happens when the meeting has not started. For example, the meeting has yet to start, the quorum has not been met, that meeting has to be postponed. But the meeting may have started, but it becomes disorganized, unruly. Such a meeting may be adjourned. All right? And there are procedures for adjournment. There are procedures to be followed when a quorum is not met, or when the meeting becomes disorderly. And failure to comply candidates to the GS001, as we discussed earlier, failure to comply to 001 general meeting standard can lead to the meeting's resolutions being declared null and void by a court of law, which can cause significant legal and financial risks to the company. You can imagine calling a meeting of 2,000 shareholders, and because of one technicality of, say, quorum or agenda or notice, then the meeting is declared invalid or null and void. That can be quite expensive to the company. And that's all, candidates, for our today's lesson, the first lesson on governance standards and guidelines. We've said that in professional governance framework, like the one that has been established by the Institute of Certified Secretaries, governance standards and governance guidelines are complementary tools that are used by organizations to ensure that organizations are run effectively and ethically. You understand? Yes. That's all for today's lesson. In the next session, we are going to study the second GS002, meetings of the board. 001 refers to meetings of the members. The second one is meetings of the board. We will look at that standard when we meet in our next session. For now, thank you. God bless you. Bye-bye.
We pick it up on illustration, that is the taxation of trustee. Our first question comes from April 2023. April 2023. Question 5C. Question 5C. April 2023, question 5C. We'll read the question. Malezi Trust was formed in the year 2021 for the benefit of Alex Malezi's two children, Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expense for the year ended 31st December 2022. Additional information 1. The trustee reported trading profit of 160,000 for the year. This was after deducting the following expense: printing and stationery, 1 million shillings, legal fee out of which 1,200 was in respect to defending, out of 1,200 was in respect of defending one of the trustee involved in illegal business deal. Then we have tax consultancy, a figure of 2.4. We have the next, that is purchase and installation of a software, a figure of 2 million. We have trustee salary as per the trust agreement, that was 10 million. Then you have loan repayment, into bracket, interest included, a figure of 1.1. The total was 8 million. Then you have lease charges were shillings 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. Then we have what we call preliminary expenses in respect of the trust formation was 3.4. Then we move to the additional information number 2. The trading profit was before taking into account the following capital expenditure: a warehouse, that is from 1st April 2022, a figure of 3.5 million. Then we have delivery van from 5th May 2022. We have a figure of 1,750,000. We have saloon vehicle from 1st January 2022. The figure is 3.8 million. Then we have the sports pavilion from 1st September 2022. The figure is 1.2 million. So we're being told that trustee received a gross rental income from the commercial properties of 120 million. And the gross interest income from fixed deposit of 20 million. Then you're being told that fee paid to investment manager in charge of the rental property was a fixed deposit amount of 12 million. Additional information number 4. We're being told that each beneficiary is entitled to a quarter share of the net distributable income. That each beneficiary, we know that there are two sons, that is Mona and Nora, is entitled to a quarter share of the net distributable income. Then you're being told that the fixed annuity of each beneficiary was shillings 10 million. The figure is gross. Then you say that trustees made 6 million to Nora and 3 to Mona and 3 million to Nora as discretionary payment as per the agreement. Then required. One is that compute the income tax payable on the trust income for the year ended 31st December 2023. Then compute the amount due to each beneficiary for the year ended 31st December 2022. We begin the analysis. Malezi Trust was formed in the year 2021 for the benefit of Alex Malezi's two sons, that is Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expenses for the year ended 31st December 2022. So the first additional information, we're being told that the trustee reported a profit of 160 million for the year. This was after deducting the following expenses. At that very point, we noticed that for this particular question, the method that we need to get the taxable income is basically what we call the net profit method. And the reason that underlie that is because we have been provided with the accounting profit. So the first expense that was subtracted, we are being told that printing and stationery, a figure of 1 million, that should be allowable expenses, that should not be adjusted. Then I have our number 2, additional information 1.2, legal fee of 6 million, out of which 1.2 was in respect to defending one of the trustee involved in a legal business. So there's a 1.2 that we treat as an allowable. If we have a 1.2 that we use to defend a trustee that was engaged in a legal business, then that should be what we call a non-allowable expense. And note that we say that for this particular question, we are using the net profit method. It means that we need to add back a figure of 1.2, which is a non-allowable expense. The implication of subtracting a non-allowable expense is that you understated the net profit that was provided as 160. So we need to add back that figure of 1.2 to get the right position of profit. Then we have what we call tax consultancy fee was 2.4. We say from tax expenses like the tax consultancy, those should be non-allowable expenses. By subtracting that 2.4, you underestimated the profit. So the correction would basically be to add it back. Then the next we have purchase and installation of accounting software. We know that accounting software that we've been told that is a capital expenditure. So we need to add back that figure of 2 million. Then you're being told that trustee salary as per the trust agreement, that's 10 million that should be allowable. Then we have loan repayment. We are told that out of that there's an interest of 1.1. So the loan repayment total was 8 million. So interest on loan is allowable expenses, but loan repayment is a non-allowable expense. So we can do our first amount. We get our first working. We say that loan repayment. We need to get the figure of the loan repayment. Loan repayment, less interest on loan, less interest on loans, less interest on loans. So we say that loan repayment is a non-allowable expense, but the interest that accrues from a loan is allowable. So if we had a figure of 8 million, we need to less minus 1.1. So this figure of 6.9, which is loan repayment, the figure of 6.9, which is loan repayment, that should be non-allowable. So non-allowable, we need to add it back to adjust it to get the taxable profit. Then the next, we're being told that a lease charge was 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. So when you talk about a 10-year lease agreement, when you're drafting, renewing or drafting a lease that is less than 99, then that should be allowable. So the figure is allowable expense, so we do not need to adjust it. The next is what we call preliminary expenses. In respect to the trust formation was 3.4. Expenses that are incurred before the inceptions of the trust are basically an allowable expense. So the figure of 3.4, that is a non-allowable expense. The figure of 3.4 is a non-allowable expense. Then we have additional information number 2. The trading period was before taking into the consideration of the capital expenditure. One thing that we need to understand that when you talk about the capital expenditure, we need to claim what we call investment allowance. In taxation, we do not have an expense called depreciation, but in place of depreciation, we claim what we call investment allowance. So being told that we have assets, we have a warehouse, we need to understand that warehouse qualify for an investment allowance called IBD, industrial building deduction, that we claim at the rate of 10%, at the rate of 10%. But mark this, he said from 1st April 2022. I know this is a lot of time based on the present rate. We need to not to apportion. Initially, we used to apportion wear and tear, and the IBD. But don't apportion, claim the whole amount. For that warehouse, we have a figure of 3.5. So we claim 10% of the 3.5. I know if you look at some of the areas previously based on previous question, and sometimes you'll find these ones who are being apportioned, but based on the present rate, you need to claim the whole amount. Very important for learners to understand. Then we have delivery van, delivery tract. Remember that is wear and tear because that's motor vehicle at the rate of 25%. We need to claim it at the rate of 25%. At the rate of 25%. And we also claim the whole amount. We don't apportion. Previously, it was being apportioned. Then we have saloon car. Very important, you need to understand for saloon car and SUVs. We said that for saloon cars and SUV, if the value is more than 3 million, we restrict to 3 million. So we're going to claim 3 million out of that. We are going to claim 3 million out of that. That 25% of the 3 million. Then lastly, we have what we call the sports pavilion. Sports pavilion in this case, that is also IBD at the rate of 10% on the straight line. So then additional information number 3. The trustee received a gross rental income from commercial property of 120 million. That is additional taxable income, and a gross and what you call gross interest income from fixed deposit. That is an interest income that is subjected. We call it the non-qualifying interest, still subjected to further taxation. Fee paid to investment managers in charge of the rental property. We need to understand that we need to get the net because fee paid to investment manager, that is allowable expense. We need to less it from what you call the gross rental income to get the net rental income. Then lastly, on additional information number 4, we are being told that each beneficiary is entitled to a quarter share of the net distributable income. But there's a fixed annuity. Those are contribution to the beneficiary, who in this case is Mona and Nora. So there's a fixed annuity for each beneficiary, that is Mona and Nora. Each is going to get 10 million. Then we have trustee made 6 million. Trustee made 6 million to Mona and 3 million to Nora as a discretional payment as per the agreement. That is tied to the amount that is due to the beneficiary. So we begin with our first calculation. Compute the income tax payable on trust income for the year ended 31st December 2022. So we begin it on this other part. So we begin it on that other part. So we have trustee, that is for and Nora. Taxable income. Taxable income for 2022. Taxable income for 2022. So we say we use the net profit method, accounting profit provided. So accounting profit provided, we have shillings here, but we can round it off to 1,000. We had a figure of 160 million. So we have it as 160, we round it off to 1,000. Then we say add back. Why are we adding back? Because this accounting profit was already provided. What do we add back? Non-allowable. Allowable expenses. Expenses in P and L. Non-allowable expenses in P and L, comma, taxable income, not in the P and L. Not in the P and L. Taxable income not in the P and L. So the first one is what we call, we say that printing and stationery, that was allowable. We don't need to adjust that. We have what we call legal fee, 6 million, out of which 1.2, 1.2 was in respect to defending trustee on illegal business. Defending, that is an allowable defending what you call trustee. Trustee on what you call illegal business. So we add that back. The figure, that figure was, we rounded to thousands. So if you round it to 1,000, that should be 1,200. That was 1.2. Then the next we have what we call, purchase and installation of accounting software. Before that, there's tax consultancy. We say expenses related to tax are non-allowable. Tax consultancy. 2.4, we round it to 1,000. That is 2,400. Then we have the next. Which we call purchase and installation of accounting software. That's capital expenditure. Purchase and installation of what we call accounting. Purchase and installation of accounting software. That should be 2 million. But we round it off to thousands. So we proceed to this at the end. So the next one we have, we're being told that trustees' salary as per the trust agreement, that is okay. Then we have what we call loan repayment. So loan repayment, interest on loan is allowable, but the loan repayment is not allowable. So we have loan repayment. So loan repayment, that was 8 million. We round it off to 1,000, then we less 1,100. Interest on loan is allowable, that should be 6,900. So then we have lease charges worth 3 million, out of which 600 was in respect to drafting a 10-year lease, that is allowable. Then we have the last one, preliminary expenses. Preliminary expenses. Expenses incurred before the formation of a trust, those should be what we call non-allowable. So we add them back. So those are the non-allowable expenses. Unfortunately, we do not have taxable income that has not been included. So we add 1.2 plus 2.4 plus 2 million, rounded to 1,000, plus 6, plus 6,9, plus 6,9, plus 6,9, then plus 3.4. Giving us a total of 15,900. Then we say less allowable expenses, not in the P&L, allowable expenses not in the P&L. We have taxable, non-taxable, what you call non-taxable, taxable, operating incomes in P&L. Then you have what you call investment incomes in P&L. For the exam scenario, this is for the purpose of learners understanding what you're doing. But for an exam scenario, just say less. You don't need to write the whole thing. But for the sake of learning, we need to understand what needs to be less. We are saying allowable expenses which are essentially in the P&L, non-taxable operating incomes in P&L, and investment incomes that are in P&L. That is what we less. We pick our paper. And we are saying the first one that we have is investment allowance. Remember, investment allowances. we have the investment allowances. So the first one was non-allowable, the one that we had as non-allowable. That was purchase of installation of accounting software. Accounting software. Remember, that is investment allowance at the rate of 25%. So 25% times 2 times 2,000, that should be 500. That should be 500. Then we have the next, which is warehouse. Warehouse. So warehouse, those are buildings, IBD. That is IBD. IBD. IBD, that should be 10%. So 10%, 10%, the figure is 10% times 35. Initially, we used to apportion this figure based before the rate changes. We used to apportion this figure. For example, for the IBD, if it was April, we would have looked for about 9 months. So April, May, June to April to December, that should be 9 months, and say times 9 over 12. But with the present rate, we don't apportion, so we have it as 350. So when you get somewhere, it's a portion. Notice that with the changes that were effected, we don't apportion. Then we have what you call delivery track. We have the delivery track. Remember, these are motor vehicles again at the rate of 25%. So 25% times 1750. 25% times 1750. 25%, 0.25 times 1750 times 1750. So that should be, we have it as 437.5. We have it as 437.5. We have the next that we call saloon car. Saloon car. Saloon car. Remember, this is restricted. Saloon car is restricted. If the value is more than 3 million, you restrict to 3 million. So we have, that is 25% times, and that should give us 750. That should be 750. Then lastly, we have what you call sports pavilion. Sports pavilion. So sports pavilion, that's also IBD, that should be 10%, but I have emphasized that based on the present rates, you don't apportion this figure, you claim the whole amount. Previously, these figures were being apportioned, but with the changes that were effected, you claim the whole amount. So times what you call 1.2. Remember, the figures are rounded to thousands. The figures are rounded to 1,000. So that should be 120. So these ones were less. There's not any investment income that were included. The investment that were there are treated separately. So what do we less? The total that we less. So we have 500 plus 350 plus 437.5 plus 750 plus 120. So this should be 2157.5. So the only allowable expense were investment allowance that were essentially not included in getting the accounting income, which is 160. So we have net operating incomes. So we have the 160 plus 15,900, then minus 2157.5. So that gives us a figure of 173,742.5. That gives us 173,742.5. Then you add what you call other taxable income. Add other taxable income. We proceed and have it. Add other taxable income. So we read the additional information number 3, trustee received a gross rental income from commercial property. So other taxable income, we have the gross rental income. Gross rental income. So that should be a figure, that was 120 million, so that we have 120 at that. Then we also have what we call gross interest from fixed deposit. Gross interest from what we call from the fixed deposit. So if it was net, we get the gross. So that is a figure of 20 million. So we have 20,000, rounded to thousands. Then you're being told lastly that fees paid to investment manager in charge of the rental. We need to less that fee paid. That should be to get that fee paid. Fee paid to investment managers in charge of rentals, in charge of what you call the rental. So we less that figure. That is a figure of 12 million. So we have it as 1,000. So what is the net operating income? Net operating income, we had a figure of 173,742.5. Then you had plus 120,000 plus 20, then minus the 12. So this should be, this is a figure of, we have total taxable income, total taxable income. So we have the total taxable income, that is 301,742.5. That is what you have as the total taxable income. But if you look keenly to that question, income tax payable, after getting that, we get the income tax payable, the income tax payable, the income tax payable. So the income tax payable, we say that the taxed at the rate. So tax payable, we have it at the rate of 30%. Tax payable, we have the tax payable. Tax payable in this case, we have 30% times 301,742.5. We round it now to the whole figure. So we multiply by 1,000, so that is 500. So that is 301 million. The essence of this is, remember, we're rounding to 1,000. So when I come here, use the old figure, that will basically be 301,742,500. We get the 30% of that. So 301,742,500 times 0.3. So what do we have? We have a figure of 90,95,22,750. Then we less what? We less tax credit. So the tax credit is on gross interest from fixed deposit, withholding from what you call interest on fixed deposit. So the key thing is not the answer, but the key thing is a learner being able to understand that what is being checked there is the ability to understand that we tax them at 30%. So we get that. So the gross dividend, that was 15% times 20 million. So 15% of 20 million, 0.15. So that should be around a figure of 3 million. So we have the net tax payable. So the net tax payable, so we have 90,522. So that should be 87. So that is the net taxable for the trustee. That is how we sort part one of that particular question. So very important, just a recap of what we did. that one of the most important things as we do these questions is to focus. The focus is essentially on the entries that emanate from these particular questions. So at the end of the day, we got the tax payable. So we move to what we call compute the amount due to beneficiary for the year ended December 2022. So we say amount due to beneficiaries. 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 So we have Mona. One of the beneficiaries, Mona, Nora, and we have the totals here. Remember, we round these figures to thousands so that we don't have a huge figure. We round those figures to thousands. So we look at additional information. Number 4. Each beneficiary is entitled to a quarter of the net distributable income. We need to get that net distributable income. So we have a fixed annuity to each beneficiary. So we have the first one is fixed. What is distributable fixed? What we call fixed annuity. Fixed annuity for each. That was 10 million, so we're rounding it to thousands. That is 10, so that should be 20. We have 20. Then we have the next, we have discretion of payments. Trustee made 6 million to Mona and 3 million to Nora as discretion of payment. So we have discretional payment. So for Nora, that was 6 million. So this should be 9. So then we get what we call the net distributable. Distributable income. So net distributable income. What we call the net distributable income. We have the net distributable income. So being told that the net distributable income, each beneficiary is entitled to a quarter share of the net distributable income. So what is the total taxable income? The total was 301,742.5 minus to get the net distributable, that is 20, then minus 9,000 in order to get that net distributable. So we're saying to get the total taxable income was 301,742,500. So that when you less the fixed annuity and the discretion of payment, we get what we call the net distributable income. So on that net distributable income, the examiner tells us that each beneficiary is entitled to a quarter share of the net distributable income. So we get the net distributable income, then we get a quarter for each. So that is 742.5 minus 20 minus 9,000. So that is 272,742.5. Then we multiply a quarter, we get a quarter. Each was entitled to a quarter. So a quarter of that, that should be 68. That should be 68. We have 68. 68. 185.63. So 68, 185.63. The total for that. We have the total for the two. The total for the two times. So that should be about 136. 136. 371.25. So the total amount due. Total amount due to each person. total amount that is due to each person. Total amount that is due to each person. So we have just have it as it is. So total amount due to each, so that is 10 plus 6 plus 68, 185.625. So that should be 84, 185.625. This should be 81. That is for Mona. Mona. We have it there, sorry. Mona and Nora. So we have 81, 185.6. So that should be 165. So that is amount that is due to each. That is amount that is essentially due to each beneficiary, which is Mona and Nora, the figure that they get. So that is how we essentially get the part 2, the amount that is actually due to the beneficiary. So that marks the end of that question. We pick it on our next illustration.
Let's now talk about number E, or the fifth method of dealing with CVP, where you are uncertain, which is probability tree diagram. Probability tree diagram. So you will allow me to do away with this, your probability tree diagram. Your probability tree diagram, is where you simply draw a tree diagram, almost similar to when you're dealing with probability trees. From your mathematics, you must have done probabilities. So we'll be drawing a similar tree. And for us to be able to draw that or to illustrate that, there are certain items we must be given. One of the items that you must be given is your probability. You must be given your probability, and you must be given your variables. You must be given your probabilities and your what? Variables. Your variables here may be labor cost, maybe material cost, maybe direct expenses, variable overheads, maybe the variable cost, maybe the fixed cost, maybe the units to be produced and sold. But they must give you some variable that you're going to represent in your tree diagram so that it can help you to get a decision. For example, if they're asking you to draw a tree diagram to determine your contribution, you know your contribution is the difference between your selling price and your variable cost. So one of the items that they must provide is your selling price. The other item they must provide is your variable cost. They must also provide your what? Quantity sold. If they ask you to represent or to determine profit using probability distribution again, they will give you selling price that they must provide and the probabilities. They must also give you what? Variable cost with the probabilities, the units sold, the fixed cost. So we're saying when you're dealing with a probability tree diagram, there is some certain information you must be done what? Given that is uncertain, and that is why you're going to be drawing a what? A tree diagram. And I want us to look at an illustration on the same, on a tree diagram. And the question I want us to talk about specifically is on April 2024. Let's go to April 2024. April 2024. The question we want to tackle is question 2A. And the company name is what? Joe Mwinzi. That is the name of that company. Joe Mwinzi, the management accountant of Vera Enterprises that makes and sells products alloy, has made the following estimates. You have your sales, you have 3 conditions, which is the worst, the most likely, and the best. You have your probability of the sales. You also have your variable cost under the conditions that are worst, most likely, and best. You have your costs or variable cost per unit under those conditions, and you also have the probability of variable cost under those conditions. Additional information. The selling price of alloy product is 1,000 per unit. Fixed cost attributable to alloy product is 24 million. Vera Enterprises intends to achieve a target profit of 6 million. Using a probability tree, compute the expected profit of Vera Enterprises. Number 2, compute the probability that Vera Enterprises will fail to break even. Number 3, determine the probability that Vera Enterprises will not achieve the target profit. The target profit. So they're telling us to determine your expected profit using your tree what? Diagram. Remember, from the previous working, we know how do you get expected values. You simply take your variable, you multiply by your what? Probability. So even in this particular circumstance, to get our expected profit, we will take our profit, you multiply by your what? Probability. But you know, how do you determine your profit, class? Your profit, we've talked about it so many times. It is determined by your selling price minus variable costs. You multiply by your units, and then you subtract your what? Fixed cost. You subtract your fixed cost. They are telling us that the selling price is 100. Your variable cost has been provided, and various costs have been provided with various what? Probabilities. So it basically means you are uncertain of the true cost of the variable cost. The units to be sold after production, you have been given under various conditions and their probabilities. And so this is how you're going to draw this tree diagram. This is how you're going to draw this tree diagram. Let's start by determining the units. There, there, and there. Your units, you have 45,000 units with a probability of 0.3, and those are the worst conditions. That is worst condition. The next condition is when it is most likely. Most likely. And most likely, your probability is 0.6. Then you have the best condition. The best condition, you have a probability of 0.1. Of 0.1. 0.1. How many units are these of most likely? 50,000. And best conditions was how much? 55,000 units. 55,000 what? Units. We have represented the units to be produced and sold. So these are your who? Units. These are your units. The other uncertain item that we don't know about is your variable costs. Your variable what? Costs. And your variable cost, we will have it in 3 market conditions. 3 market conditions. Let's draw it nicely. 3 market conditions. The first market condition is 0.3, which is what? The worst. So let me write this here, the worst condition with a probability of 0.3, and your cost is 350. Most likely is the next market condition. With a price with a probability of 0.5, but a cost of how much? 400. You have the best condition with a probability of 0.1 with a price of how much? 550. You repeat this. Worst, your probability is 0.3. Most likely, your probability is 0.55. The best condition, your probability is 0.15. 0.15. Then we also need to analyze what? Worst, 0.3. Most likely, 0.55. The best is 0.15. Your prices are 350, 400, 550, 350, 400, 550. That is your variable costs. These are the units, so these are your variable costs. Very important that you capture that. That is your variable cost there. Okay? Then we can then determine your contribution margin. Your contribution margin multiplied by the units will give us what we refer to as total contribution. Remember, how do you get your contribution margin? It is simply the difference between your selling price, and remember, your selling price was set as what? 1,000. Your selling price was set at 1,000. So to get your contribution margin, you simply take your selling price minus your variable cost. And how will that be? You're going to take 1,000 minus 350. 1,000 minus 350. 1,000 minus 350. Let's say 1,000 minus 350. Then you multiply by the units. And how many units were you selling? 45,000. So please confirm that that is 45 million times 650. This is 29 to 50,000. So my values are in thousands. My values are in thousands. Then again, determine your contribution margin by taking your selling price 1,000 minus 400. I believe now you have understood that. Times your units, and your units were 45,000. 1,000 minus 550. How many units again are you selling? 45,000. 1,000 minus 350. Your selling price is not changing. You multiply by who? Your units now for the most likely scenario are 50,000. 1,000 minus 400. Again, your units are 50,000. 1,000 minus 550. You multiply by 50,000. That will give you your contribution. 1,000 minus 350. Your units under the best scenario is selling 55,000. 1,000 minus 400 by who? By 55,000. 1,000 minus 550 by who? By 55. Then we now get our who? Totals. We then now get our who? Totals. We need to get our totals. We get our totals. 600 by 45,000. That must be 27 million. 1,000 minus 550 by 45,000. That must be 20 to 50,000 times 50,000. That must be 32,500. That must be 30 million. 1,000 minus 550 by 50,000. That is 22,500. 1,000 minus 350 times 55,000. 35,750 million. 1,000 minus 400 by 55 is 33 what? Million. 1,000 minus 550 times 55,000. 24,750,000. That will give you your who? Contribution. That will give you your total who? Contribution. Which is your contribution margin times your units. Then you then subtract your who? Fixed costs. So let's have our who? Fixed costs. And I will have my fixed cost in thousands of what? Shillings. So you need to indicate that. Your fixed cost, what were they saying? Note number 2. The fixed cost attributable will be how much? 24 million. So this should give you 24,000. 24,000. 24,000. 24 again. 24. 24. 24. 24. And lastly who? 24. Now with that, we then need to get our who? Profit. Remember they wanted us to get our what? Expected profit, which we know for us to get our expected profit, we need to get our profit, we multiply by our probability. So let's start by getting our profit. 29,250, which is your contribution, minus your fixed cost of 24 million. This will be 52,50. 27 million minus 24 million. That will give you 3 million. 22,50 minus 24 million. That will give you a negative profit of 37,50. 32,500 minus 24 million. That is 8,500. That is 6 million.
22,500. Is that 1,500? Yes, it is. Minus 24 is 1,500. 35,750. Minus 24 million. That must be 11,750. 33 million. Minus 24 million. That is 9,000. 9,000 or 9,000,000. 24,750 minus 24 million. That is how much? 750. We then will introduce our joint probability. Our joint probability, which we simply denote as JPO. Why are we doing that? We are doing that so that we now take our profit by our joint probability to get our expected profit. Our expected profit. Your joint probability will simply take the probability of units. You multiply by the probability of your variable cost. For example, 0.3 by 0.9. 0.3 by 0, it should be 0.3, eh? The other one is what? 0.3. You multiply by who? 0.55. I'm indicating this because it is necessary so that you together 0.3 by 0.15. Very nice. Must indicate this. 0.6 by 0.3. 0.6 you multiply by who? 0.55. That was 0.6 by 0.55. 0.6 by 0.15. Best 0.1 by 0.3. 0.1 by 0.5. 0.1 by 0.15. Sorry about that. We then get our joint probabilities now. Our joint probabilities. 0.3 by 0.3 is 0.09. Then 0.3 by 0.55 is 0.165. 0.3 times 0.15, 0.045. 0.6 by 0.3, 0.18. 0.6 by 0.55, 0.33. 0.6 by 0.15, 0.09. 0.1 by 0.33, 0.30. 0.03. 0.055, 0.015. Wonderful. Let's then get our expected profits. Our expected profit by taking your probability, you multiply by your who? Profit. Your probability, you multiply by your profit. So 5250, and this was in thousands of shillings. Remember that is in thousands of shillings. 5250 by 0.09. 5250 by 0.09. That is 472.5. 3000 by 0.165, 495. 3750 by 0.045. This will be 168.75. 8500 by 0.18. 1530. It is very, very necessary. As much as it looks exhausting and very involving, you need to do this. 1500 by 0.09. 130. 11750 by who? 0.03. 352.5. 9000. 55. 495. 750 by 0.015. 11.25. Once you've gotten the product of your probabilities and your what? Your profit to determine your expected profit, you then now get your totals. So you must get your what? Totals. And this, remember, is your expected who? Profit. Expected profit. So you now simply add 472.5 plus 495 plus 168 plus 0.75 plus 1530 plus 1980 plus 135 plus 352.5 plus 495 plus 11.25, which will give you 56.40, which will give you 56 what? 40. 56.40. So therefore, we can say that, and this was a loss, this was a loss, 22 minus 24, that is a negative profit. The same case with this one. We have left out those negatives. Is there any other negative? That's a profit, a loss, a profit, and a profit. So let's compute this answer again because of the what? Of the negatives, of the negative profits. We left out that, but the good thing is that we have captured it. So let's add again. 472.5 plus 495 minus 168.75 plus 1530 plus 1980 minus, this is a negative, 135 plus 352.5, which was a positive, plus 495 plus 11.25, 5032.5. That will give you your expected what? Profit. That will give you your expected profit. That is the first part of that question. The first part of that question, you're saying using a probability tree, compute the expected profit of what? Vera. The next part of that question, part 2, that was part 1. Part 2 of that question, compute the probability that Vera Enterprises will fail to break even. Compute probability that Vera will fail to break even.
to break even. The probability that Vera will fail to break even is here, 0.045 plus 0.09. Why? At break-even point, your profit is equal to zero. Okay, so anything less than zero basically means your company is not able to break even. And as you can see, with a probability of 0.45, your profit is negative. With a probability of 0.09, your profit is negative. So you have not been able to cover your costs. So this will be given by 0.045 plus 0.09. 0.09. It should be 0.045 plus 0.09, 0.135. You're not able to break even from here. The third part of that question, lastly, the last part of that question, determine the probability that Vera Limited will not achieve a target profit. Compute probability that Vera will not achieve. How much is your target profit? Your target profit, they were saying, was 6 million. 6 million. So where will you not be able to achieve your target profit of 6 million? That first is not achieving. You're also not achieving that you have achieved, that you have achieved, that you have not, that you have, that you have, that you have not. So we take the joint probabilities. The first one is 0.09 here. The second one is plus 0.165 here. The third one is already a loss, plus 0.045 plus that is a profit of more than 6. That is also okay. That is a loss with a probability of 0.09. That is a profit of more than 6 is okay. That is a profit of more than 6 is okay. That is less than 6 million. So 0.015. So then what do? We simply now get the total. So for the company not to be able to achieve a target of what? Of 6 million profit, the probability is 0.405. 0.405. And that is all that is required in that particular question. That is all that is required in that particular question. All right. That is how you deal with probability tree diagram. So as far as your conditions of uncertainty is concerned, in the next lesson, we are going to talk about continuous or normal distribution method. Continuous or normal distribution method. And I would like for us to attempt a question. And from your previous illustration questions, you can attempt November 2017. So your assignment, this is an assignment. This is your homework. This is an assignment. So you can attempt a question of November 2017. November 2017. And the specific question is question 4A. BPO Limited. BPO Limited. BPO Limited. Right. So thank you so much. We can call it a day and then have a good time.
Hello and welcome to the lesson. The subject is business and data analytics. Today we are going to study the various types of data analytics. By the end of this lesson, you should be able to explain at least 3 types of data analytics. Types of data analytics. Types of data analytics. Data analytics, learners, is a broad field, and there are 4 main types of data analytics. There are 4 main types of data analytics. Number 1 is known as descriptive analytics. Number 2, diagnostic analytics. 3, predictive analytics. 4, prescriptive analytics. 4 types. Descriptive analytics, diagnostic analytics, predictive analytics, and prescriptive analytics. Now, each type here has a different goal and a different place in the data analytics process. Descriptive analytics is the first one. Descriptive analytics helps answer questions about what happened. Answer questions about what happened. What happened. And the techniques here summarize large data sets to describe outcomes to the stakeholders. And by developing the key performance indicators, all right, the strategies can help track successes or failures. And we may also have specialized metrics that are help to track the successes or the failures in an industry. We could have metrics such as return on investment, which is used in many industries, and so on. So the process here requires the collection of relevant data. Here it requires the collection of the relevant data, the processing of the data, data analysis, as well as data visualization. And the process here provides essential insight into the past performance, because data analytics answers the question, what happened? It looks into the past, the history, what happened in the past, what is the past performance, and so on. So descriptive analytics looks into the history, into the past, what happened. The second type of data analytics is diagnostic analytics. And here, diagnostic analytics helps answer the questions about why things happened. Why things happened. This is what happened. Diagnostic answers the question, why things happened. And the techniques here supplement more basic descriptive analytics. They take the findings from the descriptive analysis and digs deeper into the cause of what happened. And the performance indicators are further investigated to discover why they got better, why things got better, why things got worse, and so on. And there are various steps in the diagnostic analytics. The first step being the identification of anomalies in the data. And the anomalies may be the unexpected changes in a metric or a particular market. The second step in the diagnostic analytics is the collection of relevant data. Collection of relevant or related data. This is data that is related to the anomalies. Okay? So first of all, I've said the first step in the diagnostic analytics is to identify anomalies in the data. Then number two, data that is related to the anomalies is collected. Identify anomalies in the data, then collect data related to the anomalies in the data. Then after that, statistical techniques are used to find relationships, to find trends that explain the anomalies. That is diagnostic analytics. I repeat, identify anomalies, step number one. Step number two, collect data related to the anomalies. Then number three, use statistical techniques to find relationships, to find trends that explain the anomalies or the cause of the anomalies. Let me put that down. One, identify anomalies in the data. Two, collect data related to anomalies. Three, use techniques to do what? To identify the, or to find relationships, to find trends that explain the anomalies. Use mathematical or statistical techniques to find relationships and trends in the anomalies. The third type of data analytics is predictive analytics. Predictive analytics, on the other hand, helps answer the question, what will happen in the future? Predictive analytics helps answer the question, what will happen in the future? And the techniques, the techniques here use historical data to identify trends, then determine if they are likely to recur. The predictive analytical tools provide valuable insight into what may happen in the future, and its techniques include variety of statistical as well as the machine learning techniques, such as the neural networks, the decision trees, the regression, and so on. So based on historical data, the predictive
analytical tools can help the firm answer the question, what will happen in the future, by looking at trends in the historical data, the past performance, predictive analytics from the word predict. These tools may help a company to answer the question, what will happen in the future? Tools such as regression, machine learning, and so on. Do you understand? Yeah, that is pretty clear. Predictive analytics. Then the last type of data analytics is prescriptive analytics. Prescriptive analytics helps answer the questions about what should be done. What should be done? What should be done? Prescriptive analysis helps answer the questions about what should be done. What should be done. And by using insights from the predictive analytics, data-driven decisions can be made. Data-driven decisions can be made based on predictive analytics. Data-driven decisions can be made, and that allows businesses to make informed decisions in face of uncertainty. And candidates, prescriptive analytics techniques rely on machine learning strategies that can find patterns in large data sets. And by analyzing past decisions, by analyzing past events, the likelihood of different outcomes can be estimated. All right? Prescriptive analytics help answer the question, what should be done? This type of data analytics provide insights about insights that businesses need to make effective and efficient decisions. They provide insight that businesses need to make effective and efficient decisions. So these are 4 types of data analytics. We've said data analytics is a broad field. We've briefly described 4 types of data analytics. The first one being descriptive analytics, which we've said answers the question, what happened? Diagnostic analytics answers the question, why things happened. Number 3, predictive analytics answers the question, what will happen in the future. And lastly, prescriptive analytics helps answer the question, what should be done about what should be done by using insights from predictive analytics. We've said also that data-driven decisions can be made. Data-driven decisions, because the decisions are based on past data, on past big data. So these are 4 types of data analytics: descriptive analytics, diagnostic analytics, predictive analytics, prescriptive analytics. Here is your today's assignment. Explain 4 types of data analytics, and when doing the assignment, make sure your notes,
You don't make reference to notes, you don't make reference to videos. Try and see if you can recall what you have learned from your memory. Thank you. Bye-bye.
We proceed to the illustration on computation of VAT, that is August 2024, question 5C. We read the question. Explain the term reverse charge, that is basically already given on notes. Then you go to 2. The following information related to lessor. The following information related to lessor limited, a company engaged in supply of taxable goods for the month of May 2024. The company was registered for VAT on 1st May 2024. So we have inventory in trade as at 1st May 2024, valued at 813,000. So we, on the opening stock, we can claim input VAT. So the second, we are being told that the company purchased goods on credit. The company purchased goods on credit and cash worth on credit. So credit is 4,750,000, and on cash is a figure of 2,980,000 respectively. So when you talk about purchase and the opening stock, those are basically input VAT. Those are VAT on purchases and expenses. So goods purchased on cash worth 180, goods purchased on cash worth 180 did not have supporting fiscal receipt. So when you have these goods purchased on cash, we can do our working. Purchased on cash, goods purchased on goods purchased, we say purchased on cash. So basically these goods purchased on cash did not have supporting documents. So those cash, we had a figure of 2 million. We had a figure of 2,980,000. We less the ones that did not have documentation. That's a figure of 180. A figure of 180. We pick our calculator. We basically have 2,980 minus 180,000. Minus 180,000. So we have a figure of 2.8. 2.8. This is where we are going to claim input VAT. The ones that do not have the documentation, a figure of 180, we cannot basically claim input VAT on them. So then we proceed to additional information, number 3. The company sold goods worth. The company sold goods worth 8,768,000 during the month. During the month of May, the company basically sold goods worth 8,768,000 during the month. These goods included exempt sales of exempt sales worth 3,670,000 and export to South Africa, which was 1.5. So we can get the standard rate sales. So we have our working two. We are getting the standard rate sales. Standard rate sales. So it tells me the total sales is basically what we have as 8,768,000. 8,768,000. We less the exempt, which is 3,670,000. This is basically exempt, and exempt, that is 3,670,000. Then we less the zero rated. Zero rated in this case is about a figure of 1.5. Zero rated is a figure of 1.5. So we get the standard rate. We get the standard rate. We get the standard rate. So for the standard rate, we pick that, and we will say 8,768,000 minus 3,670,000 670 minus 1.5 minus 1.5. So we have the standard rate sales to be 3,598,000. 3,598,000. An explanation on that. So we know that standard rate, those are taxable, and the zero rates are also taxable or vatable. But zero rate, we know we claim VAT at 0%. Exempt rate, exempt sales, we do not charge VAT at all. But we're saying that these figures on sales are basically what we call output VAT, and I've explained that exempt, we don't charge VAT, not chargeable to VAT. Zero rate, import, export is zero rated. Then standard rate, we charge VAT at a standard rate of 16%. So then we're being told that the company received a credit note. A company received a credit note and a debit note worth 600,000 and 540,000 respectively. So if I just indicate here, just to indicate working three, we say that a credit not received, credit not received. Remember this, credit not received affect purchases, affects purchases. We know that this basically affect the purchases. This basically affect the purchases, and credit note will reduce the purchases. That will definitely reduce the purchases. Then the second, we have debit note. Debit note received. Debit note received. That also affect purchases. And we know that debit note is used to correct an undercharge. So this definitely will increase purchases. This will increase the purchases. That is analysis for that. That definitely will increase what you call purchases. So then we are being told that during the month, the company purchased a motor vehicle on hire purchase at shillings 4.5 million to be used in business. The cash price was 3.8. If you have the hire purchase and the cash price, we basically use the cash price to claim input VAT. So the input VAT will be on the 3.8 and not 4.5 So we proceed to the additional information number 6. Additional information number 6. The company imported goods valued. 2.4. That is cost, insurance, and freight. They incurred clearing. They incurred what you call the clearing. They incurred the clearing. The company incurred the clearing and transport of for 50,000 and 150 respectively. Respectively, this import was not included in purchases above. The import duty rate during the year was 25%. The import duty rate was basically 25%. So we go to working for on import. Remember, when you talk about import, we say that import basically has a cascading effect, meaning that we charge VAT after charging import duty. So import duty is charged. Import duty is charged on what you call the CFI, cost, insurance, and freight. So we have the cost, insurance, and freight to be a figure of 2.4. So 2.4 to get the import duty 25%. So we get 25%, we can get the 25% and add, or we just have plus 125 over 100. Instead of getting 25, then we get 2.4, we get 2.4, 125 over 100, meaning the figure plus the import duty. We can test that with our calculator. So we have that 2.4. The figure is 2.4 times 125 over 100. So the figure is basically 3 million. But you know that imports are exclusive of VAT. Imports are exclusive of VAT. Imports are basically exclusive of VAT. And when you look at the figure for the transport and clearing, those are also input, but we're going to charge them. Those are basically input. VAT. So we proceed to 7, additional information number 7. So the company incurred the following expenses. Expenses are basically input VAT. So the first expense is what we call legal expense. Legal expense is vatable. We charge input VAT. Salaries and wages are exempted from VAT. Office rent, that is chargeable to VAT. That's how we claim an input VAT. Then we have water from the county. Water from the county, that is basically exempted from VAT. Water from the county, that should not be charged to VAT. Then we have electricity, that is chargeable to VAT. Then we say 8, the company could not identify. We're being told that the company could not identify a goods sold as exempt when they purchase, and therefore restricted deductible input VAT. So we have restriction in that. Then the last additional information, that is additional information number 9, transactions are inclusive of VAT at a standard rate of 16%. So when you're told transactions inclusive of VAT, transactions inclusive of VAT. So means that VAT is already charged. So we say into bracket use 16 over 116. Use 16 over 116. If the transactions are inclusive of VAT, it means that VAT is already charged on that. So we basically use 16 over 116. So we proceed to what is required. Determine the value added tax payable or refundable to lesser limited for the month of May. So we can say VAT payable or refundable to lesser. We say to lesser limited, payable or refundable to lesser limited. Particularly on questions that we have restriction, one of the best approach to take, especially on questions that you have on restriction, is basically to do the output separate and do the input separate. Sometimes students mix them, but the best approach to take when it comes to questions that basically deals with restriction is to have the output separate and also do the input separate. So we go to the output, we get the output VAT. So on the output VAT, we have standard rate. We have amount here. Then we have the VAT rate. Then we have the VAT. So we have item on that. So the first item is standard rate cells. And the standard rate cells, we had done the figure as we rotate the camera. As we rotate the figure for the standard rate, we less the exempt and zero rated. We had the figure of 3,598,000 times 16. Transactions are inclusive of VAT. So we have our calculator, and 3,598,598, then times 16 over 116. So the figure that we have for that should be a figure of 496,276. That is for the standard rate cells, a figure of 496,276. 96 to 76. The next items on sales, we have what you call zero rated, zero export. And when you read the additional information number 3, export to South Africa. So export was a figure of 1.5. Export was a figure of 1.5. Remember zero, that's zero rated. So that is zero. That is zero on that. Then you have exempt. Exempt we have at a figure of 3,670,000. We don't charge VAT at all. So then down here we have what you call total output VAT. Total output VAT. That should be a figure for 96 to 76. For 96 to 76. We proceed to the input VAT. We get the input VAT. We proceed to what we call input VAT. We have what we call input VAT. So on the input VAT, we have item on this. Item, amount. We have the VAT rate. Then finally we have the VAT. And we move sequentially. So the first item that we had was credit sales, credit purchases. We charge VAT on the credit purchases. So credit purchases a figure of 4,750,000. The VAT rate, because it's inclusive, 16 over 116. So we pick our calculator, and we have that. We pick our calculator. So we basically, as we pick our calculator, we know that 4,750,000 times 16 over 116. So we have, on that we have a figure of 655. 655 to all number, that should be 172. 655, 172. We proceed to what we call the cash. We call it cash purchases. So on the cash purchases, there is a working basically on the cash purchases. There's a working on the cash purchases. We say that some of the purchases did not have physical document. So the working basically will list 180. So for the cash purchases is a figure of 2.8. So we have the 2.8 at this point. Then we multiply by the rate which is 16 over 116. We get the figure on that. So we have 2.8 times 16 over 116. So that should be about a figure of 386, 207, 386,207, to rounding it to all number. We proceed to the next. We had what we call credit not received. That's the reduction of purchase. So we have credit not received, credit not received. We had a credit not received. So on the credit not received, the company received credit note and debit note. So credit note received was a figure of 600,000. That is additional information number 4. So credit note basically reduces the purchases. So times 16 over 116. So what do we get when you have that? So 600,000 times 16 over 116. So that should be about a figure of 82,759. Then debit note received. That is used basically to correct an undercharge. An undercharge that should increase the purchases. So we have a figure of 540. A figure of 540, 16 over 116. A figure of 540, 16 over 116. So 540 times 16 over 116. So the figure that you have, that should be about 74, 483. 74, 483. 483, 74, 483 as the figure, 74, 483 as the figure. Then there was an entry that was not basically added, opening inventory. So we had the first entry on opening inventory. On the first month, you can claim that opening inventory. Opening inventory. So the opening inventory was, we had a figure of 813. 813 times 16 over 116. The opening inventory. 813 times 16 over 116. So that should be a figure of 112, 130, 112, 138 as the figure. 112, 138 as the figure. So proceed to the next. We had, during the month, the company purchased motor vehicle on hire purchase. We use the cash price. Motor vehicle. We have the motor vehicle. So motor vehicle is basically a figure of, we use the cash, which is 3.8, 16 over 116. 16 over 116. So we have the 3.8 times 116 over 116. So that should be about a figure of 524. That should be a figure of about 524. 524, 138. 524, 138. 524, 138. The next item was basically on import. We know that import, we have done the working. As we rotate the camera, import, we basically are done the working. Import plus import duty, we have a figure of 3 million. And you know that import are normally exclusive. Even if the question is inclusive, they're normally exclusive. So we have